Time now for today's AFLAC trivia question. The Legoland theme park opened in 2011, replacing what park that was on the property until 2009? The answer when CNBC Squawk Box continues. Now the answer to today's AFLAC trivia question. The Legoland theme park opened in 2011, replacing what park that was on the property until 2009? The answer? Cypress Gardens. The sale price for the property was $22.3 million.
The Department of Energy is authorizing LNG facilities on the Gulf Coast to ship additional products around the world. Our next guest says building more LNG facilities in the U.S. is the first step of the energy transition. Joining us now, Charlie Riedel is the Executive Director of the Center for Liquefied Natural Gas. And Charlie, I imagine you've got some strong opinions on this, given what you do for a living. But would an objective person say that if not one of the main ways to make this transition, one of the main energy renewables of not a renewable, but one of the things we're going to be using to make this transition, it's either the primary one or one of the top ones would be, is there any denying it's going to be natural gas?
No, Joe, I don't think so. I think that this is absolutely one of the critical building blocks that we'll see going forward for the foreseeable future. LNG is going to play a critical role in that, not only here domestically with the build out of additional LNG exports, but also as we're seeing with the crisis that's unfolding with Russia invading Ukraine, Europe now also looking to make long-term plays for natural gas and mostly coming from LNG. So I think that LNG is here for the foreseeable future and going to play a critical part of that building block.
Would you say that that notion has gotten a lot more interest or more people would say that that is the case in the last 3 months? And if that's true, have we dropped the ball and not done enough prior to the war in Ukraine on what we should have been doing with building out this type of?
Well, our facilities right now, we currently have 7 that are operating, 6 that are commercially exporting, and the 7th is just starting with cargoes commissioning out of that facility. And we're sending almost all of our LNG that we're currently producing to Europe. So last month we loaded 25 cargoes, and of those 25 cargoes, 20 went to Europe, and the other 5 will likely wind up there just given the current price spread. So the ball hasn't been dropped. We've been exporting LNG to Europe since 2016. But there's more that we can be doing, right? The Department of Energy just approved those 2 facilities earlier this week. There are 4 more. Those would send strong signals to the rest of the world that the United States is stepping up the commitments that the administration has been suggesting, that we're going to be exporting more LNG and that we can be doing more.
Charlie,
there are more projects. Go ahead.
Has it been in the top 3 energy alternatives for the climate lobby? LNG, is it one of the top 3?
I think absolutely. I think we have to be in that space.
Has it been with the climate lobby? Let me ask you in a different way. When do you find natural gas? Are you drilling for hydrocarbons when you're finding natural gas? And if we're trying to leave hydrocarbons in the ground and fossil fuels in the ground, you're not going to get natural gas, are you?
Well, I think that's the sort of underscores the critical importance that we continue to keep producing natural gas, that it's going to be there. And we do have the resources here domestically to keep producing. So we're going to have to keep doing that in order to meet the demand, not only here domestically, but globally as well.
I feel like I have to lead you to say some. I'm not going to lead you into it, but do you see where I'm getting or not? Is it not clear to you? Just a nice guy? You're a lobbyist, or you're trying to, I don't know, toe the fine line. We have not been promoting fossil fuel discovery. We've been doing the opposite of promoting that. We had an executive order at the beginning of this administration that said climate change is the primary thing we're going to focus on. We're not going to have if we need natural gas to power the grid for all these clean EVs, aren't we going to need natural gas? And don't we need a complete mindset change on whether we continue to find and produce hydrocarbons?
Without question, we're going to need to continue to find and produce hydrocarbons. I think that the administration is finding that to be the reality, not only here, but also internationally, right? The continued demand that we're seeing.
The Biden administration?
Absolutely. We're seeing the comments coming out of the Department of Energy that are supporting LNG exports. We saw it last week during SARA.
Okay,
we'll continue to see those comments.
A sea change but it's new in the last 3 months.
Yeah, absolutely. Yes, absolutely. We're seeing that shift.
Right. Okay. You're a nice guy. All right, Charlie. I want you to. You're representing LNG. I want you to get out there. There's no doubt. There's no doubt. The wind stops blowing. The sun stops shining. People need. We don't want to freeze. Europe's going to freeze because of the going down that path too quickly to transition to these virtuous renewables.
Well, the reality, right, is exactly that. If Europe doesn't start to replenish their storage this summer, the idea that this large amounts of LNG that we've been sending from the United States isn't guaranteed. So we need Europeans to also step up on their side of this.
All right. Thank you, Charlie. Thank you.
Thanks.
I'm available if you want to. If you need it, I'll go out on some of these calls with you.
We'd love to have you.
All right, Mike. Do you think I need a commentary flasher at the bottom at times?
I think it's implicit. Yeah, I think we're okay with that.
Okay.
Still to come, NASA Administrator Bill Nelson talks the push to get people back on the moon. Plus, stocks on pace for a winning week. Take a look at futures right now. They are backing off after 3 days of pretty significant gains. Dow's up about 1,500 points in 3 days, now giving back about 200 in the pre-market. S&P up about 230 points. It is down 30, and the NASDAQ off 111 or 12 at this hour. Stay tuned. Squawk Box will be right back. NASA's massive new moon rocket making its debut. Morgan Brennan joins us now with more on this historic moment and a special guest. Morning, Morgan.
Good morning, Mike. Well, more than a decade in the making, the world's most powerful rocket, the Space Launch System, has for the first time ever rolled out to its launch pad an 11-hour slow-moving journey overnight, where the Boeing-made rocket and the Lockheed Martin-made Orion capsule on top of it will now undergo several weeks of tests before a maiden launch as soon as May. It stands 322 feet tall. It's taller than the Statue of Liberty. SLS is a system that will, under the Artemis program, fly Americans back to the moon. So joining me now, NASA Administrator Bill Nelson, live from the Kennedy Space Center. Administrator Nelson, thanks for being with us this morning. And I know you're right near this rocket, or it's in your background, I should say. Major milestone. We're entering a new era, one in which Americans are now poised to return to the moon, this time to stay, to enable more deep space exploration. But in some ways, is this also the final chapter of another era, one in which NASA actually owns its own rocket?
Well, first of all, Morgan, I've got to apologize for the Florida weather. It is now fog, and you can't see the rocket that's over my shoulder back there on the launch pad. No, we are getting NASA out of low Earth orbit. We're going to explore the heavens. And this rocket, a government rocket, is going back to the moon. We're going to hitch up with the commercial marketplace. In this case, the first lander, SpaceX. It will, in lunar orbit, the crew will transfer from the Orion capsule into the lander, go down to the surface. And this is just the beginning of about one crew a year that will go to the moon, and we will build infrastructure on the moon. We'll build a habitat. We'll learn how to exist in a very hostile environment for a long period of time in preparation to go to Mars.
Yeah, and we have several missions scheduled. This first one as soon as May, which is uncrewed, but several missions over the next couple of years. And hopefully, if all goes according to plan, the first human boots, or American boots, back on the lunar surface as soon as 2025. Is it really going to cost $4 billion per launch, as the Inspector General of NASA has suggested?
When you get to flying one a year, the answer is no. The cost will come down. You've put into that a lot of other costs to get started. And of course, when you build something this big, this technologically superior, this defying the laws of gravity, going to a hostile environment, there's a lot of research and development that goes into that.
Yeah. I need to shift gears here. Russia very much in focus, given the invasion of Ukraine. It has really thrown the future of the civil space partnership between the U.S. and Russia into question. How are you navigating that, and what is the longer-term plan moving forward now?
It hasn't thrown it into question at all. The cosmonauts and the astronauts are getting along as usual. Today marks a significant event because 3 cosmonauts will launch on a Soyuz from the Baikonur Cosmodrome in Kazakhstan to the International Space Station. And the cooperation in civil space, as opposed to military space, that cooperation continues, and we expect it to continue.
So just to put a fine point on that, then, Russia is committed to the International Space Station until 2030, and more near term, because there's been a lot of speculation, and I know NASA put out a statement earlier this week, but Mark Vande Hei, who is the American who just broke the record for longest consecutive space flight by a U.S. astronaut, is actually going to be returning back to Earth via Russia next week.
He is returning with 2 Russian cosmonauts, and the significance of today's launch is that the Russians are still committed to the International Space Station by virtue of the fact that they're going to lift off from Baikonur today.
Okay. So we just got the 2022 budget finally appropriated. We're expecting any day now, really, the 2023 budget proposal as well. How quickly can you field commercial space stations, which I know you've begun to fund development of, to eventually replace the ISS?
There are funds in this 23 budget that's coming that starts the process of encouraging the commercial sector to build a replacement space station. We're going to keep the International Space Station going until 2030, and then it's NASA's intent we're going to turn this over to the commercial sector. We will have maybe several commercial space stations at that point. But NASA wants to get out of low Earth orbit and get on up as we explore the cosmos.
Administrator Nelson, thank you so much for joining us this morning, and congratulations on this major milestone for the SLS rocket, which has been so many years in the making.
It's a big deal, Morgan. Thank you so much.
Joe?
All right, Morgan, thanks. Coming up, despite the futures being lower, the S&P 500 is still on track for its best week since 2020. We're going to talk markets and what investors need to watch after the break. A reminder, you can always watch us live on the go on the CNBC app. Not while you're driving, though. We'll be right back.
Let's talk markets now. Joining us for that is Virginie Maisonneuve, Global Chief Investment Officer for Equity at Allianz Global Investors. Virginie, great to speak with you this morning. Wonder just initially what your read is on this market comeback we've had. There's been a big flow into risk assets after this correction. Do you think that pullback has run its course, or is this just a bounce?
I think we're still in for some fair level of volatility, but clearly as markets had adjusted a lot and some of the valuations are becoming more attractive, you have those bounce periods, if you want, when you see some pressure coming off the global environment. And of course, we had some of the discussion or talks with Ukraine and Russia, as well as some of the other issues, such as more clarification on the Fed, tightening, the UK tightening, etc. So there's a lot of unknowns. So anything that doesn't get worse, but that clarifies things, if you want, can help the market. But that can be very short term.
Is clarity or greater clarity on what central banks are up to enough? I mean, you think the markets can withstand this what is shaping up as a bit of a global tightening cycle?
Yeah, I think clarity is very important. So if you think of the environment we are in currently, there are three really important points. One, of course, is the geopolitical picture. And this is, we are witnessing a shifting world, and I call it fragmentation in the global village. And it is, if you want, going in tandem with this third phase of China's role in the global geopolitical world, and that's very important, right? The second one, of course, is the economic landscape. And the economic landscape, we knew we would have a post-COVID slowdown, and we had some post-COVID inflation. But of course, this bout of inflation around commodities is, if you want, destabilizing the markets in the short term. And of course, the third factor is monetary policy normalization. And that we know is necessary. But of course, the concern is the uncertainty around the duration of the commodities market volatility with the Ukraine and Russia crisis, and how far will rates have to go to reining that abnormal inflation, if you want, like a hill that you have in front of you. And the bond markets is very clearly telling that to us.
What are the practical implications as an investor of this deglobalization and perhaps the related persistence of inflation, if that is one of the results?
Well, so inflation, let me tackle the second one first. Inflation is going to be a very interesting concept to watch, because if in fact the Ukraine-Russian situation could be resolved quite quickly, you still have, from an oil standpoint, the equation of the green calibration to be resolved. And you are seeing, in light of the events, recent events, a lot of focus, particularly in Europe, on energy becoming a question of national security, acceleration of a renewable potentially. And of course, also, if you look at the recent plan put forward by the International Energy Agency to try to lower consumption of oil over the next 4 months by 2.7 million barrels a day, a lot of new initiatives, if you want, that are there. Beyond that, you still have, a world that is technology-driven, and that is still deflationary, that is, if you want, growing in a much more sustainable way, but in a world that I call the digital Darwinism world, where you have that competition from AI and technology, that's going to be very important. And there you have budgets that will be very inflationary in order to be part of that safe cyber world, if you want.
Virginie, appreciate your thoughts this morning. Thank you very much.
Thank you.
All right, coming up, the problems at the ports persist, but appear to be getting a little better. Coming up, the head of one of America's biggest ports, Gene Soroka, executive director of the Port of Los Angeles, is here to let you know that the supply chain woes are really getting better. And then Federal Reserve Governor Christopher Waller will talk inflation, pressure, the economy, and everything in between. That's coming up in a big interview at 8:45 a.m. Eastern. It's 7:53 in the morning here on a Friday. We're back on Squawk right after this.
FedEx earned an adjusted $4.59 per share in the latest quarter. That missed analyst forecast by about 5 cents per share. If you take a look at the stock has actually backed off just a little bit in the after hours.
That's Mac's fault because Mac is upstairs doing something. I think we have a guest upstairs, so he would normally cue you.
Oh, I'll take the.
You will? What's are you going to get fined or something? I think you're fine.
Yeah. There we go.
All right. You want, look at Brian Sullivan's talking. They don't have his mic on. What, Brian?
Yeah, I'm like flat. Well, I talk with my hands, Joe, so I don't even need the microphone. You know that. You can just kind of read me. I was saying Santoli was so dialed in to look at the Mets schedule, and he was just caught off guard. I mean, it was just watching it was magic.
So close. The Yankees, but yes.
I'm excited about Mad Max.
Get the tickets down.
I'm just glad they're playing. You know, they're playing already. Exhibition games.
Yeah.
New issues causing factory slowdowns and pushing freight costs higher. Can retailers absorb another inflationary pressure point? Courtney Reagan joins us now with more. Hey, Courtney.
Hi, good morning, Joe. So supply chain issues were so 2021. Guess what? They're also so 2022. The Russian invasion of Ukraine, subsequent higher energy prices, and new COVID cases in China are further adding more time and cost to the already very clogged global supply chain. Adidas, Children's Place, Crocs, American Eagle, Gap, Levi, and Under Armour are just among those names that have used more air freight than typical to circumvent congestion in the ocean ports. Crocs said it's using air freight for $75 million worth of merchandise, for example. Now, air cargo is already much more expensive in normal times, and this is far from normal times. So freight booking platform Freightos says that the same shipment costs $1,000 by air versus $195 by sea. And right now, the air freight rate to ship goods from Asia to the U.S. West Coast is 196% higher than it was a year ago. Air freight for goods from Asia to the U.S. East Coast is up 241% in a year. Air cargo rates from Shanghai to Northern Europe are up 34% just this month of March. That's $8.37 per kilogram now from $2.35 per kilogram pre-pandemic. Now, some carriers are grounded, others are just taking longer, more expensive routes to avoid Russian airspace. That's part of the issue. Of 190 consumer companies that reported fourth quarter results, 182 of them called out supply chain issues, according to Refinitive's count. And while retailers saw nearly 49% earnings growth for the fourth quarter, earnings growth is expected to drop to 1% in the current quarter. I should say it should be a 1% loss, not growth at all, pointing to a slowdown in consumer spending, particularly at department stores, mall stores, apparel, and specialty retail. Brian?
All right, Courtney Reagan. Courtney, thank you very much. Well, joining us now with his perspective on this and everything else that is going on in the world is the head of one of America's biggest ports, really the biggest port in the United States, one of the biggest in the world. Gene Soroka is Port of Los Angeles Executive Director, and we welcome him back in. Gene, yeah, you heard Courtney talk about it. I know that the backlog of old containers, because that fee has not been implemented, but the scare of the fee pushed down that backlog by, I think, 64% combined with you and Long Beach. So that's working. But I still, when I look at the maps, see a lot of ships either offshore or sort of down in Mexico waiting to come up. How much better, if at all, has the port backlog really gotten over the last couple of weeks and months?
Good morning, Brian, and it is great to be back in the studio. You're right. The metrics that we look at very closely are improving. Of the cargo ships that have left Asia, traversing the Pacific, but not yet here into the port complex, that number is down from a peak of 109 vessels to 43 as of last night. Now, in more normal times, the Port of Los Angeles has about 30 services that call on a weekly basis. If you add the new entrants to the trade and the one-time charter hires by some of the retailers, you're almost in that weekly service slot. We've got to focus now as an industry on getting those ships back onto a fixed weekly service schedule that delivers certainty into the market.
Yeah, the backlog seems to have gotten better, in part because of slow steaming. Ships are literally slowing down as they come from China. We moved some there to Mexico. I know that your crews have been working around the clock, the truckers, everybody, the ILWU. working their cans off to literally get the cans out, as they call them, of the ports. But now we've got this new pseudo lockdowns in China, not hitting the ports quite yet, but it's always that specter. If we get another lockdown in Shenzhen or one of these major ports, Gene, what's going to happen?
I think what we'll see, Brian, is a short-term lull with shutdowns of factories, which we're watching most closely. On the ocean side, you can move ships around from terminal to terminal, from port to port, especially in South China in the Pearl River Delta area. But if a factory shuts down, that's it. Hopefully it's for a short period of time, and that'll be met with a pretty quick return to catch up on purchase orders and get back into the groove on moving the cargo off the factory floor and into containers. On the ground in Los Angeles, as an example, over the last 30 days, cargo moving out into the domestic economy here in the U.S. is up 16% versus where we were back in the fourth quarter of last year. So what you rightly said about those aging containers, we've worked those down. There's still much more to do in that area, but we're starting to see real push on the domestic side.
Can you, Gene, I think honestly the biggest underreported story in America right now with regards to supply chain may be your contract negotiations with the International Longshoremen's Union. That contract expires July 21st. I know you've been talking. If they go on strike, then the West Coast shuts down. Can you give us an update?
Yeah, I'll give you my qualifying statement as always. I don't speak for the union or the Employers Association, but here are my views. The contract expires on June 30th. Both sides will have seasoned negotiators at the table, and each know what's at stake here for the U.S. economy. The 29 West Coast ports make up about 12% of our nation's GDP. The contract will not be signed before then. They'll sit down first in May to begin negotiations. Both sides have planned out their contract priorities, and they'll run into the summertime. The DNA of both is they want to get the best deal for their members. What we have seen, record-breaking profits, liner shipping companies, terminal operators, and the longshore folks need to be paid what they're worth. I also see that the administration of Washington will keep close oversight on this, but they will let the experts negotiate in a fair bargaining manner.
And so it's June 30th. I think the contract combined with the Pacific Maritime Union may be July 21st, but whatever the date is, this is maybe the single biggest economic negotiation since 1971, I believe it was, and the last time we were kind of here. So good luck to both sides, Gene, because the American supply chain is counting on it. It's literally counting on it. Otherwise, it's going to make COVID lockdowns look small. Gene Soroka, thank you. Good to have you back in the studio. Wish I was. All right. It is just after 8 a.m. in New York, and you are watching Squawk Box. Becky and Andrew off today, so I'm not either one of them. I am Brian Sullivan, along with Joe Kernan, who's a regular on this show, and Michael Santoli as well. Futures right now, they are, hi guys. Futures right now, they are down across the board. Hey, we've had a strong week so far coming into today. In fact, it's been one of the rare good weeks of the year. Dow futures now down 218, NASDAQ futures off on a higher basis. And Mike, I don't know, I'm sure you know this, and Joe probably knows it. I didn't know it until I read it this morning from JP Morgan. We have the 5th worst start to a year for the S&P 500 since 1927. I knew it was rough, Mike. I didn't even with the good gains we had this week, I didn't realize it was that bad.
Yeah, 09 is on that list, I would imagine. I think 1935. Now, I did see some work there, though, when it's been this bad, this fast in a new year. Usually there's been a turn, and they actually didn't always end that badly, although, 09 was no fun along the way.
Yeah. So did you, I almost said welcome back to Squawk Box, Chippendales edition. I don't know, is that overstating it, do you think, Brian? I'm just totally out of my mind.
No, it's like that Australian Thunder show you see advertised in Las Vegas. We're the backups.
Yeah, I think.
Well, since Chippendales is kind of an 80s thing, I mean.
I saw it again, though. I just saw it on a Sam Elliott quote of something. I love that guy. He's really funny. He was talking about something Power of the Dog.
Yes.
Yeah, that's right. All right. I didn't want to take
this. I've not seen it, but it's on my list.
Yeah.
All right, guys. Yeah, we're gonna move on.
Much of a Western,
folks, you can vote. Hold on. We should screenshot this. Vote now. Who has the best tie? Oh, we could just do like a thing. All right.
Good.
Meantime,
I can deal with
here
that.
are the stories. Here are the stories making headlines this morning outside of our cravats. Moderna is asking the FDA to approve a second booster shot of the COVID-19 vaccine. That comes a day after Pfizer and partner BioNTech made a similar request. However, Moderna's application is for all adults 18 and older. The Pfizer application only asking for approval for those 65 and older. American Airlines plans to resume alcohol sales on flights next month. Those sales will resume April 18th, the same day a federal mask mandate for airline flights and airports, thankfully, is about to expire. American is the last of the major airlines to announce a restoration of those sales. And Burger King is running into difficulties in trying to pull out of its business in Russia. Here's why. Parent company Restaurant Brands says it has not been able to close the 800 or so Burger Kings in Russia because the independent operator of those restaurants is refusing to do so. The company says it would need the help of the Russian government, good luck, to close those restaurants, something that is obviously it is not expecting to happen as well. Mike.
All right, some members of Congress may apparently be looking to make a profit off the war in Ukraine. Prior to Russia's invasion, some elected officials snatched up stocks that could benefit from the conflict. Elon Moy joins us now with those details. Good morning, Elon.
Good morning, Mike. Well, the crisis in Ukraine has rattled investors on Wall Street and in Washington as well. Our CNBC analysis of financial disclosures from members of Congress found that more than a dozen reported trades, either their own or by their spouse or child, in sectors that were directly affected by the war in Ukraine. We estimate that those trades totaled $7.7 million since February 1st. Almost all of that was in energy and utility stocks, $7.4 million in names like Exxon, Kinder Morgan, and Occidental Petroleum. Next were cybersecurity stocks like CrowdStrike and Akamai at $220,000, followed by defense, including Lockheed Martin, as well as Raytheon. Now, GOP Representative Marjorie Taylor Greene purchased shares of Lockheed along with Chevron and NextEra Energy 2 days before the Russian invasion. On the day of the attack, she tweeted this, quote, "War is big business to our leaders." Now, a spokesman said all her trades are conducted by an investment advisor, and she didn't even know about them until they got reported in the media. However, all of the members who responded to our question said that their portfolios are handled by third parties and that they are not personally or actively trading, but they and their families do get the benefit if these bets pay off. And so, guys, that's why there's been so much pressure from the public and from within Congress's own ranks to tighten the rules. Back to you.
All right, Elon, thank you very much. Coming up, much more on markets this morning as stocks aim for a winning week. Futures right now, going to give back some of the three-day gains. S&P set to open up down about 30 points, less than 1%. Dow's down around 200. NASDAQ off by 117. Plus, Federal Reserve Governor Christopher Waller will talk inflation pressure and the economy. Squawk Box will be right back.
Major averages on pace for their best week in more than a year, but our next guest doesn't think the market has yet bottomed. Says there's a good chance the S&P eventually approaches the 3,800 level. Joining us now is Sam Stovall, Chief Investment Strategist at CFRA Research. Sam, what does this, in any way, are your targets affected by what's happening in Russia and Ukraine, or is it a general market call based on Fed or the inflation, the outlook for inflation, or just technicals?
Morning, Joe. Well, actually, it's a combination of all of those items. I mean, if you look to what's been going on with the Federal Reserve, looking at Ukraine, looking at inflation levels, et cetera, basically an awful lot of challenges continue to lie ahead, and we have yet to see a capitulation day. So if you look to the fact that we will probably hit an inflation peak in March or April at about an 8.6% level, if we look to oil prices that are likely to remain above $100, and we're looking at PE ratios right now that are back to close to 20 times forward 12-month earnings. I think that there still is the possibility that we have a bit of a shakeout before this decline is finally over.
You talked about the geopolitical situation in light of oil prices. So you don't think that it's an existential...
and provide assistance to Russia, but that certainly could increase the likelihood of supply disruptions around the globe, et cetera. Now, my impression is that we could still end the year at a new all-time high. Let's face it, we have had 4 times since World War II that bear markets ended up getting back to break even in 7 months or fewer. So even if we do touch that 20% decline threshold, we still have an awful lot of time to make that up and to get back to break even and beyond.
So the correction that you're seeing, or that if it's 20, that's actually, I guess, that would be a bear market. But what you're seeing, all the work that's already been done in certain sectors of the market on the downside, even before the war in Ukraine, does that mean we're closer to the end of this downward cycle that had already started at that point? And does that set us up for a more long-lasting move higher afterwards?
Yes, I think that because we have seen the NASDAQ already fall into bear market territory along with the Russell 2000, because the Dow and the S&P are in correction territory, we are part of the way there. But when you look to the percentage of stocks that are trading above their 10-week and 13-week moving averages, we recently saw a 52-week low when looking at the 30-week moving average. And neither of these indicators have hit oversold or even semi-oversold levels. So there's an awful lot of damage that needs to be repaired. And usually you do have a retest of the prior low. And I think that the 4,200 level found on March 8th for the S&P 500 will be challenged and possibly could end up being eclipsed to the downside. So I believe that investors should tread carefully. Longer term, I'm still bullish, but in the near term, I still think that volatility is likely to be elevated.
Right. Well, we're seeing that, that's for sure. And we got the Fed involved as well. All right, Sam Stovall, I appreciate your time this morning. Happy Friday. We'll see you again soon.
Thanks, Joe.
Okay.
All right, coming up, at the end of a big week for the Federal Reserve, we'll hear exclusively from Fed Governor Christopher Waller. Stay tuned for that. Plus, big Chinese tech stocks were volatile all this week. In just a few minutes, investor Mitch Green will help us make some sense of the moves. Stay tuned. You're watching Squawk Box on CNBC. Welcome back to Squawk Box. Take a look at the futures right now. S&P 500 comes into today up almost 5% for the week, about to give back about 0.75% of that at the outset. Dow Jones Industrial Average down 200 points. It's up about 1,500 points just in the last 3 days. Brian.
Mike, thanks. Meantime, a likely boon for Ukrainians who've endured weeks of war. PayPal says that citizens and refugees will be able to receive payments from overseas. That would make it easier for people to support friends and family in and around Ukraine. In a letter, PayPal CEO told the Ukrainian prime minister that Ukrainians would also be allowed to transfer funds to some credit and debit cards. One senior Ukrainian official at the International Monetary Fund told Reuters this would make, quote, a huge difference for his people.
President Biden, Brian, at this time, and Chinese President Xi Jinping set to speak at 9 a.m. Eastern. Eunice Yoon joins us from Beijing with more. Good to see you again, Eunice. Good morning.
Morning, Joe. So U.S. officials say that President Biden is going to be preparing a tough message for President Xi, that any support for Russia that goes beyond words would come with consequences. Well, China is planning a stern warning of its own. State media has been quoting an unnamed Chinese official as saying that President Xi will have a solemn message that China will never accept U.S. coercion. It will retaliate against any U.S. action, that China would demand the U.S. recognize its role as a so-called initiator in the Ukraine crisis. The Chinese president is also expected to press President Biden to honor his word that the U.S. is not seeking a Cold War, a conflict, or Chinese regime change, and that the U.S. does not support the independence of Taiwan, an island that Beijing claims as its own. The foreign ministry continues to insist that China is a neutral and objective player on Ukraine. This is coming even as one of its diplomats met with the Russian ambassador here to discuss what the state media has described as anti-terrorism activities and coordination of it. Also comes as state media has been amplifying Russian talking points. And so far what we're seeing, Brian, is really China's game plan to support Russia, to nurture the anti-West partnership, but at the same time appear neutral enough to maintain economic ties with the U.S. and Europe. I think the question, though, is whether or not China can maintain that without risking a hard break from the U.S. and its allies. Brian?
Yeah, and it's unlikely we're going to get any major developing headlines out of it, but at least, as we said earlier, Eunice, the two sides are talking. We are engaging. We may not see eye to eye, but at least that conversation is being had. Eunice Yoon in Beijing, thank you very much. All right, coming up, back to the markets, and GameStop, ouch. Shares diving in the pre-market, down about 7% after fourth quarter results. How far, though, can NFTs, if at all, to lift the fortunes of GameStop? We're going to dig into what is really the original meme stock. When Squawk returns, futures, they're down, oil is up, and we're back right after this. All right, welcome back. GameStop slammed right now. The stock down more than 7% to 81 and change. Keep in mind, this was a $300 stock just 9 months ago. The video game retailer shocking investors with an unexpected loss last quarter and said it will not provide any financial guidance. Maybe there is a little bit of hope for all the diamond hands holders out there, because GameStop says it is looking for new ways to make money, including launching an NFT marketplace by the end of the second quarter. CNBC tech correspondent Steve Kovac joining us now. Steve, I got a lot of questions. I'll start with this genius question. What the heck happened?
Oh, what the heck happened? Well, they posted a loss, and they largely blamed supply chain issues and Omicron, like we've been hearing from so many retailers. But you also got to keep in mind, Brian, that GameStop, forget the NFT stuff that we were just talking about. GameStop is a hardware business, and they sell collectibles and physical video games. That's what they rely on. And the latest generation of consoles, the PlayStations and Xboxes that came out a year and a half ago, you can't find them. There's just no supply. They come out in little bursts, and they can sell them out immediately online. And that's pretty much what hit them last quarter.
All right, so let's think about going forward, because the stock's gotten crushed, 300 down to 81, but there's a lot of people that still believe in this company. They're using all the right buzzwords, kind of like ESG. We're going to be ESG next quarter. Like, this is, now they're saying all the things. Web 3.0, non-fungible. I mean, they're using all the right language. Do people actually buy into this bet?
Well, it's really hard, because the call yesterday only lasted 11 minutes, Brian, no questions. So
what?
Yeah, exactly. It was an interesting earnings call to listen to. So there was no one pressing the CEO, like, how is this NFT marketplace going to work? But here's what we do know, that NFTs aren't really popular among gamers. They feel like if they have to bid against each other for some kind of unique digital item to play the game better or have an advantage in the game, they feel like they're being nickeled and dimed. Some game studios independently have announced intentions to do NFTs within their games, and the gamers are revolting at that. So, you know, maybe they sell NFTs, maybe they can convince some of the developers to get onto their platform and, you know, sell little NFTs of Super Mario or something like that. But, you know, that's going to be their challenge, is convincing people to, hey, come to this platform and develop for it. I don't see gaming companies doing that.
They don't care, but they're not going after the gamer. Steve, they're not going after the gamer, right? They're going after the investor, right? GameStop serves the gamer, but they're trying to get the investor to buy the stock.
Right, they're trying to, but they're not telling the full story here about this NFT platform, which is, how is it going to work? What developers are on board? I mean, it's fine they have some partners to help them build it, and there will be content in there to buy. Yeah. But as far as like the core of them, GameStop, gaming, they don't have those game developers really working on this NFT platform.
And the stock has fallen now, down 7%. It's off huge in the last 9 months. Steve Kovac, thanks very much.
Thanks, Brad.
Mike.
All right, coming up, an exclusive conversation with Federal Reserve Governor Christopher Waller. But next, Lead Edge Capital's Mitch Green joins us to talk about a head-spinning week for Chinese tech stocks and where the biggest names could go from here. Stay tuned. You're watching Squawk Box on CNBC. a volatile week for Chinese tech stocks. COVID restrictions, China's ties to Russia, an ongoing regulatory crackdown, and fears over possible U.S. delistings combining to put pressure on some of the names investors know best. But we did see a bounce back begin midweek after China's vice premier signaled support for markets. Joining us now to talk about where he sees opportunities, Mitchell Green, founding partner of Lead Edge Capital. Mitch, great to talk to you. I mean, we just went through the list of influences on this area of the market, on Chinese tech stocks. You think you're just buying, a good company serving a huge market like Alibaba, and you have to worry about all these other forces. How do you approach it right now? JP Morgan earlier in the week said it's an uninvestable area. Do you agree with that?
It was interesting. I think they came out with that Tuesday, right? And then the stock, jumped 35%. So you're always got to be skeptical of the, of the sell side. I don't know. It's really hard right now. I think if you look, Alibaba, I think now is trading like at 10 times next year's earnings, and 10 cents, maybe like, mid-teens next year's earnings. They're certainly cheap. I think before the bump too, take a third off those stock prices. If you buy stocks at 7 times earnings for stuff that grows fast, you tend to make money. I don't think China is invading Taiwan anytime soon. But what the heck do I know? I'm not a macro economist. I'm not everything that I don't know, but like they sure are cheap from a risk-adjusted reward if you have a long time period, I think.
What about the, and this goes back to the very beginning from Alibaba's IPO, the questions of what a U.S. investor even owns when you buy a share of Alibaba, right? You kind of own a piece of an entity that sort of has a claim on the earnings of the mainland company. Does that concern you, or how do you navigate around that?
Yeah, the structure of all of these things and these offshore entities, I'm not worried about that at all. And by the way, it's not only Alibaba; it's every one of these Chinese listed ADRs. And look, we own a bunch of Alibaba stock. I do personally on the fund, both at you can own them in Hong Kong, or you can own them in the ADR, and it's like remarkably easy to actually convert your ADR shares into Hong Kong shares. And most of these Chinese big internet companies are now dual listed in Hong Kong. That
is a piece of it that seems like the relatively easy part of the workaround there. You're invested just in general too, though, in a lot of the fast-growing tech. You've had that area been on the outs for going on a year now, really. True bear market, pretty deep. People comparing it to the bust after the 2000 NASDAQ peak. Where do you see it heading from here in terms of high growth software and e-commerce names that you own?
Yeah, so we've spent a lot of time both on the private side and the public side focused on software companies as well. And, we've been private investors in lots of companies like Toast and TransferWise. I like to joke that, I think before the IPO, we had invested about $35 million several years ago. Before the IPO, we'd taken about 170 off. Toast goes public at 40, trades to like 67, now trading at like $19 a share, which I think is like 13.5 times next year's gross profit, which is cheap given how fast it grows. Mm-hmm. It probably shouldn't have ever been 67. It probably shouldn't be 19, and it should probably be somewhere in between. Mid to high 30s is probably like the most kind of rational pricing, and I think that's the case for a lot of software companies. HashiCorp, probably the same thing. MongoDB, there's tons of companies. I think a lot of software valuations as of last fall had gotten way ahead of themselves. But the carnage or things tend to get over too expensive and then too cheap. But we love companies right now. We like a company called Yext. It literally, we were buying it in the last week at 1.5 times ARR. That's just absurd. Company called Everbridge that makes crisis management software, grows nicely. Maybe a high teens grower. I think it trades at 4 times next 12 months revenue right now. We think TransferWise is a really interesting business. Why is it trades on the London Stock Exchange? It's like a next generation Western Union that doesn't fleece consumers. So we think there's a lot of interesting value out there right now. Look, you got to be patient. It's going to be volatile, but tech is massively at least earlier this week, tech was massively oversold and hated. And when you tend to buy things that are hated, you tend to make money over the long run.
Yeah, well, we'll see if it plays out from here. Mitch, appreciate it.
Absolutely.
All right, thanks.
Thanks again.
All right, Mike, thank you. And coming up next, we're going to get Jim's first take on the markets on this Friday morning after what's been a pretty good start to the week, but futures, they're down. Plus, we're counting you down to our exclusive interview with Fed Governor Christopher Waller. Just 2 days after the Fed, raised rates. You might have heard about that. Dow futures down, oil's up. Glad you're up with us. And we're back right after this.
Get down to the New York Stock Exchange. Jim Cramer joins us now. Jim, the Dow is down. Boeing is up nicely, and I don't know whether you have any insight on this, but there is a report from Reuters that the company is going to get a huge order, or is in talks for a huge order with Delta, which would be the first in 10 years from Delta, the last carrier that hasn't ordered the 737 MAX for 100 of these babies. That would be a big deal, wouldn't it, for Boeing?
Yeah, but it's not confirmed. I think Boeing likes its chances in getting the deal. It would obviously be incredibly important for the company. Charitable Trust owns it, but we absolutely cannot confirm that yet.
No, it is a people familiar with the matter, a Reuters exclusive, and all they're willing to say is Boeing is edging towards a landmark order for Delta Airlines. Edging.
That's the same as like our chances, I guess, edging.
Yeah, but it has been. Why was the relationship with Delta so frayed over past years, Jim? What did that revolve around? They were an Airbus customer.
Everyone's been a little afraid there with Boeing. Boeing can give you some good deals. They have a lot of planes that are parked. But yeah, I mean, I'd love to confirm it, but all I can say is that the chances
like something's going
continue.
On, right?
Delta's momentum, Delta's momentum would be incredible. It would be really, really important for Boeing. I mean, I'm sorry, Boeing's momentum. And look, I've got to tell you, I mean, Boeing has been a drag on the Dow for ages, and it's also been the drag on GE. Steve Tusa, by the way, does not really care for the GE breakup. It has hurt Honeywell. It absolutely must come true. There's just a lot of, look, if we could get something China for Boeing, would that be incredible? we'd be happy just if they don't.
So
back
let's
up.
move on to so the apes. You keep tweeting about AMC. I hadn't really.
Well, the apes are so great. I mean, there's like 4 of them left. They're endangered with the diamond-enhanced, purely zirconium. They were all look. They were always nice people, except for when they attacked me. But look, I don't want anyone to lose money. But I do think that their attitude of like, if we can destroy people who are on the other side of our trade, that's a zero sum. It's not the way it's played.
GameStop. Those are both. We mentioned them the same. Do we remember I mean, they stayed high for so long that we kind of forgot. We kind of forgot that they might have been meme stocks, right?
Well, they're losing some good money. I mean, I think that's terrific. They still owe 40 point. They have some long-term debt to France, the French government. So that's not bad. They did lose more money than we thought they would. The revenues are the same as they've been for the last 2 years. I had Jane Goodall on the show. We actually talked about trees, but I mean, Jane Goodall's very pro-ape.
She's very pro-ape.
We didn't talk diamond hands.
The board apes are not bad. These are different than the board apes. These are the angry apes that you, for some reason.
I think Jane Goodall is the head of research for the apes.
All right, Jim.
And they're terrific, and I really wish them well in their next endeavor. I think they tried to get on DraftKings last night after the big win to get their money, and they couldn't do that either. But I think they're sensational people.
I know you do. All right, Tim. That's very tactful. We'll see you in just a couple minutes.
With malice toward all and charity toward none. I'm just like Link.
I want to remind everyone about your new CNBC Investing Club. You can sign up, find out more about it at CNBC.com/join the club, or just point your phone at that thing. We are going to be back with Brian Sullivan and Magic Mike Santoli. Yes, from the movie. We'll be right back.
All right, welcome back to Squawk. This was, of course, the week that the Federal Reserve finally pulled the trigger on raising interest rates. And now we have one of the people behind that decision. Steve Leisman joining us now with a special guest. Steve.
Brian, thanks very much. We're pleased to be joined by Federal Reserve Governor Christopher Waller. Governor Waller, thanks for joining us.
Hey, Steve. Nice to be on the show this morning, and you can just call me Chris. You don't have to call me Governor.
Okay. Want to show respect as is needed here. So, Chris, you had advocated going into this meeting for a 50 basis point rate hike, and yet you voted in favor of a 25 basis point rate hike. Could you explain your reasoning behind that?
Well, yeah, Steve. I mean, the data is basically screaming at us to go 50, but the geopolitical events were telling you to go forward with caution. So those two factors combined pushed me off of advocating for a 50 basis point hike at this meeting and supporting the 25 point hike that we enacted. So going forward, that'll be an issue whether to think about going 50 in the next couple of meetings or not. But the data is certainly seeming to suggest that we move in that direction.
What are you going to be looking for in terms of the impact of what's happening geopolitically to make that determination?
Yeah, we'll have to see. Other than oil prices, we'll have to see if it's starting to create further problems down the line. I mean, the U.S. economy directly is not that exposed to Russia and Ukraine except through food and commodity prices. But our trading partners such as Europe, they're going to feel things much more. I kind of think that this is probably going to knock off, a 0.5% off growth this year. But the U.S. economy is still going to be growing at a very, very healthy pace this year, even with this. So despite the stuff in Ukraine, we still have to keep our eye on the ball here in the U.S. and worry about getting our own house in order.
You said earlier 50 at the next couple meetings, and I guess I need to kind of parse that. Are you saying that the Fed ought to do a series of successive 50 basis point rate hikes?
Well, as I've said before, I really favor front-loading our rate hikes, that we need to do more withdrawal of accommodation now if we want to have an impact on inflation later this year and next year. So in that sense, the way to front-load it is to pull some rate hikes forward, which would imply 50 basis points or at one or multiple meetings in the near future. I just think it's better to have a strategy of just do it on the rate hikes rather than just promise it.
Where would you like to see the Federal Reserve funds rate at the end of this year?
Well, I would like to see the Fed be much closer to what we think of as neutral by the end of the year or sooner. I think we need to get rates up to where they should by any kind of policy rule you can think of would tell you that we should be much higher than we are right now. So I think we can do that with some aggressive rate hikes earlier in the year, and then we can pull back a little bit towards the second half of the year to see how things are going. And then if we need to continue, we'll just keep going. So that's my view, is to try to get the rates closer to neutral.
Chris, we have a chart up that it just went down that showed that the year-end forecast, at least in the Fed funds rate, is 184 for this year. When you say neutral, do you mean 2.5%? Is that where you'd like to be by the year end? I'm sorry, but I'd love to put a number on that.
Yeah, well, my own personal is somewhere between 2 and 2.25, so maybe a little less than the median on the SEP. So that's kind of where I'm at, and my own projection is to try to be above that by the end of the year.
Chris, what about the balance sheet? Fed Chair Powell said, or the statement itself said, that you'll be reducing the balance sheet or announcing the reduction of the balance sheet at coming meetings. When should the Fed begin reducing the balance sheet, and by how much, at what pace do you believe?
Well, I've said earlier, I advocated that we start balance sheet runoff before the July meeting, so that would be in the next meeting or two. And I think, and I've laid this out before in previous statements, that we're in a different place than we were before. We have we have a much bigger balance sheet. The economy's in a much different position. Inflation is raging. And so we're in a position where we can actually draw down a large amount of liquidity out of the system without really doing much damage. Now, we might, again, proceed a little more cautiously because of the Ukraine thing and worrying about markets. But at the same time, we still have the room to go much faster than we did last time, much sooner and much faster than we did.
Are you concerned at all about, I don't know how to put this in the way, but putting a lot of rate hikes down on the market right now, and that creates a systemic risk issue, doesn't give the market time to adjust? Are you concerned about the impact of faster rate hikes? And also the idea that on the other side of that you have an inflation problem that could be very related to the rebound from COVID and supply chain issues that could resolve themselves. Could fast rate hikes really put the Fed off sides on the other way and create a recession that doesn't need to happen?
Well, a couple things. First of all, the markets have already priced in over 100 basis points of hikes. Part of it's just advocating, validating those hikes now. Furthermore, we've learned since we started this pivot back in November that the markets, as long as we're clear in our communications to the markets, that the markets adjust pretty quickly. So there hasn't been a lot of market turmoil since we made a very abrupt pivot by Fed standards in the last few months. So I think we can do the same thing with the rate hikes, partly because they're already priced in. We're just bringing them forward to validate those expectations. As far as a recession, I don't think that there should be a great concern on this. I mean, we're talking about mainly getting to neutral or slightly above it by the end of the year. That shouldn't be any cause for concern in terms of causing a recession. We're coming off 0. We're not at 250 and saying, let's take it to 4, which is what I think people have in mind. We have huge excess demand for labor, both because of a shortage on the supply side and demand on the other side. Housing excess demand, shortages of goods and services. You can pull back that demand and put downward pressure on prices and wages without having any effect on the quantities or very minor effects on the quantities.
Chris, I asked this question of Chair Powell, and I'd love your answer to it as well. When I look at the median forecast of the Fed, they see the funds rate going to 2.8%, which is above the median neutral rate. And yet inflation over that time period, 23 and 24, remains above the target rate of 2%. Is the Fed really kind of the median forecast telling us that the Fed is going to remain behind the curve with high inflation and a hot economy for several years to come? And why is the Fed willing to settle for that?
Well, like I said, from my view, I would like to front load a lot more hikes to get policy closer to neutral or actually above neutral by the end of the year. And that should start putting some downward pressure on demand and therefore prices and inflation. I still think that supply chain issues will start to resolve themselves by the end of this year, beginning of next year. That will take off some pressure on inflation. The stimulative effects from monetary and fiscal policy from last year at some point have to wane. They have to stop. So I think these temporary factors, which are not so temporary anymore, at some point they do have to resolve themselves. I mean, this would be a massive new theory of inflation if one-time supply shocks and one-time demand shocks cause long-term permanent inflation. So I do think we'll see some pullback in inflation next year, and that by keeping rates above neutral through 23, we'll have the downward pressure on inflation get it closer to target.
Chris, my rudimentary knowledge of monetary policy is that you guys have two principal channels in the real economy that you can work through. Housing is one, autos is another. Both seem to be dancing to their own tune. Housing has a huge supply problem that goes back maybe more than a decade. Autos right now are running 4 million or so units below where it should be. Is it a concern of yours that two sectors that you might operate through and try to slow the economy look like they're going to remain hot despite what the Fed does?
Yeah, trust me, I'm looking for housing in D.C. right now, so I know all about a hot housing market. But you know, the thing is, policy affects the demand for autos and the demand for housing. And right now, those prices are exceedingly high and have been rising. So even if we can't affect the quantity, we can put downward pressure on prices through tightening monetary policy and raising rates. So yeah, we can't produce any more houses, but we can certainly try to lower the demand and lower the prices that then feed through into our price objectives.
Chris, we have about a minute left. The Fed called inflation transitory. It didn't react when The fiscal side, the Biden administration did an additional $1.9 trillion of fiscal stimulus. Does it have a credibility problem with Wall Street and with Main Street when it comes to predicting and fighting inflation here?
Well, I would be more concerned with that if I saw inflation expectations 2 years out becoming unanchored. I mean, everybody has high inflation expectations for the next year, and that's valid given what we're seeing in the data. But if you look at inflation expectations 2 years out, they're not that high. So clearly the markets and households trust us to do our job and get inflation down over the next 12 to 18 months. And that's what we're going to do.
Chris Waller, Governor Waller, Governor Chris Waller, thanks for joining us.
All right, thanks, Steve. Nice talking to you.
All right, Joe, back to you.
Thanks, Steve. A story we've been following all week, the price of nickel plunging again, hitting its new trading limit, falling by 12% on the London Metal Exchange early this morning. Remember, trading was suspended on March 8th after the price more than doubled in a matter of hours. Then it was locked the limit up, and they stopped trading. Now it's been locked the limit down. It reopened Wednesday, was quickly shut down after a systems error allowed trades to go through the limit, below the limit down, and that limit was expanded, as they do, in commodities to 8% down in yesterday's session, and now it can go down as much as 12%. We'll take a quick look at the markets now. Final check on things. The Dow Jones now down 183 points. It's about where we've been most of the morning. It's down more than 200, but up for the week. S&P up for the week, best week in a while. Right?
It actually firmed up, the market did, as we had the Governor Waller interview there, and it was relatively hawkish in terms of front-loading some of those rate hikes anticipated by the Fed. So we'll see. Maybe the market's kind of gotten there, and the Fed's just kind of rising to meet it, as he suggested.
Yes, the 10-year,
by the way,
10 years, 2 and change.
Love his comments on housing.
On housing, 2 and change, and oil. Brian, are you done for the day?
I hope so.
All right, there's that Chippendale shot again. Magic Mike will be on the 10. Stay tuned for that, and on the 3. You got that to look forward to. I'm rounding third and headed for home in the baseball announce. That was Joe Nuxall, the youngest pitcher, one of the youngest ever. Make sure you join us. Thanks, guys. Next week, Squawk on the Street is next.
Good Friday morning and welcome to Squawk on the Street. I'm David Faber with Jim Cramer, Carl Quintanilla, finishing a week off. Let's give you a look at the futures this morning, of course, as we get ready for the final trading session of the week. You can see we are set up for what would be a lower open. And our roadmap does start right there, as you see it, with those futures pointing to that lower open. But the Dow and S&P still on pace for what would be one of the best weeks since November of 2020.
Incredible.
Plus, President Biden and Chinese President Xi are set to speak this hour, and they will be discussing the ongoing Russia-Ukraine crisis, of course. Important phone call. GE CEO Larry Culp, he's taken a $10 million pay cut. That's in response to shareholder feedback. We're going to talk about that and the responsiveness of that GE board to what their shareholders
discussing,
wanted. Yeah. But let's start with the markets here on this final trading day of the week, of course. A strong week, Jim, despite what may be some initial weakness today. And we say initial because we've all seen the volatility that can occur during the course of one trading day. Your thoughts on this final day of the week?
I think that this week was a week where we were gratified. Now, I should say CEOs were gratified that maybe the inflation cycle can be broken. It started talking about 7 rate hikes. Most CEOs I talk to say, you know what, the idea that we have to endlessly pass on our costs means that our whole business will be devalued, our gross margins won't be any good. Now, there's a lot of regular people who watch the show, and they think that it's ridiculous that the CEOs want this. But I think that I am in the camp which just says eventually everybody's purchasing power is eroded and just continues. So, you know, I'm with Jay. Am I a sycophant for Jay? I just think he's done a good job.
Did you listen to Steve's interview with Waller? Any thoughts on that?
I don't know. They're too focused on recession, non-recession. David?
Well, what do you want to be focused on?
What do I want to be focused on?
Yeah.
The defeat of Putin. and that the idea that what we need is we can't give in. The only truce must include that Putin resigns.
Must include Putin resigns?
Yes.
All right, well, the Ukrainians are going to be the ones who negotiate what we all hope would be some sort of a ceasefire.
Look, a lot of people feel
by the Russians.
A lot of people feel that Yeltsin never recovered from the Chechnyan war.
You know, we're showing a headline here, Jim, that this is an important conversation that's going to be taking place because, of course, if the Chinese were to move to more overt support, certainly weapons or material of some kind, that could be a significant wrenching up in tensions between China and the U.S. It's a lot bigger trading partner of the U.S. than is Russia of the EU.
I want vaccines for peace because China obviously does not have the correct vaccines. We do with Pfizer and Moderna. I know you looked askance at that proposition. The Russians have historically used artillery to decimate everything. That's always been their game, and they're doing that very effectively against many of the Ukrainian cities.
It's about the only thing they are doing effectively.
But they are doing
effectively. Their military campaign has been nothing short of a disaster,
is not
as you
stopping
know.
it.
Yeah, but it's a disaster. Their logistics, their inability to get their conscripted soldiers to fight effectively. They've lost more generals and top commanders in 3 weeks. They've lost perhaps as many as 7,000.
It's almost
7,000 troops. That's according to
That's
U.S.
a lot.
estimates. Ukraine is far above that in terms of what they estimate.
It's very rare to see that number of generals. I mean, General I.D. Chernyakhovsky went in, Russian general. The first guy went into Königsberg. Very interesting. Stalin sent a Jewish general in, youngest general in the Russian army, made a statement to Germany. Unfortunately, he was killed in artillery. I do think that it's rather shocking that this many generals have been killed.
They were supposed to modernize their forces.
The war's
Doesn't
being
appear
prosecuted.
that worked as well as they thought it would.
No, the war's being prosecuted like the 1990, 1994 Chechnya, not the one that Putin ran, 1999-2000, where he chose to level.
Right.
He leveled the capital city of Grozny.
Well,
now, I think that's what you'd like to do. The artillery is a little further from what we have sent them.
That's what's happening in that city.
People say, by the way, Jim, what do you know about war? This is what I was going to do. To be a professor of military history. I was asked to be a professor, and I'm like, look, I can't. Look, you could say, well, what does that matter? I spent my life on this. I read a lot about military, and it is rather amazing that the Russians still have not figured out how to use infantry, other than when they took Berlin, and they were willing to take unlimited casualties, which is what they would have to take if they actually went in to Ukraine, because their tanks can't put their guns low enough. The barrels won't go low enough. Anyway, enough on this, other than to say that this thing is that Biden needs to convince the Chinese to isolate, and then it would be the first war that was won by actual financial blockade. Some people feel like Neil Ferguson, that Germany lost in 1918 because they ran it because of the bond market. This would be an incredible defeat for the Russians right now.
Yeah.
Incredible.
It's an important call. It's one that we'll be monitoring. We'll see what we get on the readout.
Is it bad that we spent 3 minutes on what most people are talking about?
No, it's not, because as we point out, every conversation you have, people want to get your thoughts of and/or opinion on how this is all going to play out. And of course, nobody knows anything.
That's what we talk about.
That's part of the problem.
I think you have to study the history of Eastern Aleppo.
You do.
Eastern Aleppo, they destroyed.
It can. But you know what? I do want to move on to the market. I do. And you got to let me. Will you?
Ice cream cone, diamond hands, go right ahead.
This guy Kalanovic over at J.P. Morgan seems to be positive, points out this year is the 5th worst start for the S&P since 1927, but goes on to say Fed tightening remains the strongest headwind for the economy. He thinks the market still has upside. Not just for energy, but even maybe some growth names.
I thought that was a good
Geopolitical
piece.
tensions could remain elevated. Yeah, you think?
Yeah,
Commodity supply shocks are so far less feared, and Europe is considering new fiscal measures to shore up its economy.
I felt that he's even talking about those joke stocks that came public in the last 600.
I know. Right.
That's like, you know what those are? I call them the half-a-leg stocks. Remember half-a-leg?
Yeah.
That's what those companies are,
All
half-a-leg.
right, but what's your take on the overall? Because he does seem to have some influence, this guy, on some investors. People like to cite him as one reason why when we start to see, in this case,
it's fine that he's
bit of
cited.
a rally.
I think it's fine that he's cited. I think that the market is remarkably resilient. I think that there were buyers all over the place on both destroyed growth names and growth names that have gotten through this period. The money seems to have come from banks, which are stalled, even though you think that with rate hikes, it would matter. We have every night a company that defines things. Last night was FedEx.
Yes.
This was the most impenetrable FedEx conference call I've seen in my 25 years of reading
Hold
FedEx
that
conference
thought.
calls.
Let me tell people why, as we turn to FedEx, and you can see it right there. The stock is under pressure. It was a slight earnings miss. The bottom line was impacted by worker shortages. That, of course, stemmed from the spread of the Omicron variant.
15%.
Also dealing with what Jim was talking about right at the top of the show, inflation. FedEx President and COO Raj Subramanian discussing those issues last night on the call.
What do you have, clip?
Especially as the inflation has picked up, and there's obviously consumer spending in February is already down. It's difficult to forecast in this environment, but I'm going to tell you that the big period of growth of e-commerce is now behind us, and we are planning, in that perspective, we are confident, even with the mid-single-digit growth to mid to high single-digit growth that Bree was talking about on e-commerce, that we are able to generate positive returns going forward.
All right, Jim. Now share your thoughts.
Okay, so I was trying to figure out when I was parsing this, I was thinking, okay, now is he saying that the spend for great internet e-commerce traffic is over? Because in the next sentence, he literally says that he expects 3 to 4 years of excellent e-commerce. So if it's true that the spend is over and he expects 3 to 4 years of e-commerce, then you got to buy the stock. Got to buy the stock. But the convolution of what happened here made me wish for the old Fred Smith, he would come on, basically say, listen, we're doing well or doing not. This was, when I finished it, I finished it like at 10 o'clock at night, and I said, inconclusive. It was an inconclusive conference call. To be done, TBD. There just was not enough in there to decide whether they really think that things are going to get better. They'd say ground is not doing as well. The inflation costs are bad. But the most significant thing was Omicron knocked off 15%. So let's see what happens when everybody comes back.
Yeah.
And so it's a work in progress. WIP.
I know other investors are also curious about succession at the company. That's a key issue. Subramanian was asked about that. He talked about a number of different roles that have been taken on, including the appointment of Mr. Smith's son, Richard, right, who is now leading the Americas region. He was responsible for the vaccine distribution and planning of their global network in this, this is his quote, our very interesting time that we've been through. They're confident Richard's going to take the organization to the next level. But there is a lot of focus from investors on some sort of real succession plan. Perhaps Subramanian that is expected to be the heir apparent, but there may be some shareholders who are not convinced of that, Jim.
Do you think Arthur Smith should be?
I don't know. I don't know.
Arthur Smith's the son of Fred.
Yeah, but what about,
Arthur Smith's the coach of the Falcons.
Right, okay.
No, I mean, he's a good coach. I mean, he's got to, I think he has to move on.
Yeah.
He has to move on. The quarterback position. He had Calvin Ridley. That was an interesting guy. Ridley placed bets on games. Not unlike what you tried to do in DraftKings after the first game, and then the second game, the app didn't work.
Right.
Anyway.
This is going to keep coming up, though. Not just FedEx's
No, it is,
results,
but you know what? I've
not
finished
just questions about their ability to actually expand margins. And I've made this point before in terms of the size of the company and from a revenue perspective versus UPS, and then the respective huge gap in market capitalization for the
UPS, which my charitable trust owns, Carol Tomei, had these costs better under control. But there is an upcoming next year union negotiation, which a lot of people feel is going to be one of the great tugs of war
with UPS and its workers. Yeah.
And by the way, look, I don't cast aspersions on Arthur Smith, but I hope he played the Falcons.
Got it. Still have a good quarterback. He's been a great quarterback.
He's the highest paid quarterback. Well, I don't know. I mean, Aaron Rodgers just got rid of Devontae Adams.
He's great.
Paid us. It's like, hey, I'm the greatest guy. I don't need Devontae. Yeah, he's going to get the Rodgers rate, believe me.
A lot of people talking about that, too.
The Rodgers rate
Why
is
do you
finishing
re-sign
fifth
Rodgers and then let the greatest receiver go?
I don't know, but the Commandos got Carson Wentz.
Commanders, not the Commandos.
Oh, I thought they were going. Oh,
they're not going Commando.
I thought they were the Commandos.
All right, after the break, we are going to talk about GE. Larry Culp, its CEO, agrees to a pretty
to make that trade. You can time the market so well. So do I believe that the market's bottomed? For the most part, yes. And am I willing to put capital to work? Yes, and have done that. Today or yesterday when Pete was on with you, we were buying DD, for instance, DIDI, and that stock has made a very nice move. Those Chinese internets that we talked about, or when I called into OT the other day, Scott, and I said I'm out of my S&P puts, but I have put on a big spread out in June for the VIX. That's a disaster, but not an end of the world trade, and I figure that's enough protection for that.
These moves in the Chinese stocks are absolutely insane. I didn't even mention the number. The DD is up 53% today. And the moves all across that space this week are just absolutely epic. It's something certainly to keep an eye on. There you go, the K-Web itself, and there's DD, up 53%. The one that John Najarian was just talking about. Look, the bottom line is if you're bullish and you think, in fact, we have bottomed, have you really come to grips with what the Fed is going to do, allegedly? I use the word allegedly because maybe the bond market doesn't believe that the Fed is going to be as aggressive as it laid out, or as Governor Waller told Steve Leisman just a short time ago, and Leisman's with us now, hawkish is an understatement, Steve, in terms of what Waller told you. Data screaming to go 50. Geopolitical events made it 25. I mean, I think we all understand that. Use the words front-loading rate hikes implies 50 points at one or more meetings in the near future. That's a quote. I mean, he doesn't see a recession, but he certainly sees an environment of much higher interest rates.
Yeah, he thinks the economy's in pretty good shape to be able to handle this, Scott. And what he wants to do is to get it all front-loaded, and maybe the kind of salve to that is maybe he has to do less on the back end, or the Fed has to do less on the back end. So if you look at what markets did, Scott, they pretty immediately adjusted. They shot up to a 53% probability of a 50 basis point rate hike in at the next meeting, and then they came back down. They're now at 47, so it's still elevated, still up there from where it was at 35, and you have to. I think it's prudent now to think about what was the metric he laid out. If the geopolitical uncertainties fade or become clear, then Waller wants to go 50. I don't think that's a huge disagreement with where Powell is. Powell wants to be more prudent here, but I think Powell could be convinced of the need to go 50, especially if he's got a governor, and we know Bullard is on board, and maybe a few others, that if things settle down by the time May or even June come around, I wouldn't be surprised to see a 50 basis point rate hike.
Steve, the thing that jumped out at me the most, a couple of things. The 50 at one or more meetings, and I truly wonder whether investors are going to come to grips with that. I mean, and I'm wondering what you make of the bond market and the reaction this week post-Fed, even post-Waller. It's not like rates are moving higher that dramatically. 3s, 5s, 7s are now yielding as much as the 10-year. I'm noting that, and I'm not naive about that at all. That's the first thing. But what's your reaction there? And then I'll give you the second thing that caught my eye.
Well, you got the 5, the 7 is inverted to the 10. The 20 is inverted to the 30. I think Santelli described it as all kinds of traffic jams inside the bond market. I think that's a great way to put it. Look, the bond market has come a long way and is fairly priced in, not the worst case scenario for the Fed, but a pretty strong scenario of Fed rate hikes. That 2-year at, 190 I'm looking at now. It may have another percentage point to go, but doesn't have to go there right now. So it's come a long way. And I guess the idea on the back end is the market is concerned about growth on the back end and maybe the Fed going too far. I think that's a legitimate concern. And somewhere in the 50-50 range is this idea of, hey, we have a soft landing, and then, the possibility that maybe it's not a soft landing. You have Kashkari right now on the tape, Scott. I was just reading before the intro there while listening to your fabulous discussion at the same time. Kashkari did a mea culpa on getting inflation wrong. He said he was wrong, and he points out it's a possibility the Fed may have to raise even more than he thinks beyond neutral to cool the economy.
Well, I mean, he's been literally the most dovish of Fed presidents that I can think of. Maybe, I mean, you know it better than me, but I mean, literally, if you think of Fed dove, it's like the guy's face is on the screen. The other thing that I thought was most interesting to the investment committee and people like it, those who have money invested in the market, our viewers, is Waller saying for the markets, it's all about messaging by the Fed. And as long as the Fed is clear, the market can be okay. And I give him the benefit of the doubt to this point because the market seems to be okay with the message coming from the Fed.
Yeah, I mean, I think that's true up to a point, and I think Powell is a little more, what's the word I'm looking for, maybe scared or more willing to treat the market with a little more kid gloves than Waller. Powell lived through the taper tantrum. I think he wants to avoid that. And so the idea is this. What Waller's saying is there's this dance going on, and the dance is this. The Fed says something that is going to do, the market adjusts to it. Yesterday's rate hike had very little economic consequence because yesterday's rate hike, Wednesday's rate hike, May's rate hike, and June's rate hike are already baked in. You know, we already got 130 basis points of tightening already in the market. So I think that's what Waller's talking about. And I think if the Fed begins a process, if it wants to, of telling us 50 is coming, the market will digest that. There is a point at which you shove too much down the market's throat too quickly, and it has trouble digesting it. We don't seem to be at that point right now.
No, well, maybe Waller threw a trial balloon out there today. I mean, these guys aren't stupid.
You are 100% accurate, sir. Right, 100% accurate. 100%. Right, but Scott, I've got a question for you. If you settle all the scores here on halftime, does that mean you still have to do overtime, or you're always going to do overtime? I wasn't quite sure about that.
The way these guys are, I can never settle all the scores. That's the problem. That's why there's
I see.
overtime.
So you always have to go to overtime.
Yeah,
always have to go to overtime. I just wanted to be sure. Congratulations on the new show, my friend.
Oh, I appreciate it so much. Yeah, that's the thing. There's always something going on in our overtime. Steve Weiss has a question for you, Leisman.
Okay. Yeah, Steve. I'm one score can never be settled, even in overtime. Steve, let me ask you this. When was the last time the Fed came out as this hawkish? Do you have to go back to the 70s, to the 80s? When was that period of time?
I think 94, if I'm not mistaken. Guys, can you put up FFED on a monthly basis and go back to 90 or so? I think that you would see a fairly rapid, I'm sorry I didn't have it ready for you, I should have. You see a fairly rapid rate. Like the market didn't take too kindly on it. At the same time, Bullard's point today is that that's when they did a rapid rise in rates, and they did get control of inflation, and you had a pretty good second half of the 90s there. So this is very aggressive. This would be one of the most aggressive rate hike cycles. But hey, when was the last time we had a pandemic? When was the last time we had supply shocks? When was the last time we had 7% inflation? So, you know, I think what the Fed is doing now is probably warranted, and I think arguably late.
Yeah. Hey, Leisman, I appreciate it very much, and you know I'm going to see you in overtime, so don't get too used to only this halftime thing, okay?
We'll only settle those scores in a nice way, Scott.
Absolutely. That's Steve Leisman. Appreciate you being on the program, as always.
All
And
right.
look, the conversation about the Fed plays squarely into one of the most important conversations, I think, in the market right now, and that is those ARC stocks, the growth stocks, which have acted incredibly well this week, despite what appears to be this road ahead for the Fed. The question is have those enough, which I know a lot of you who are watching this show have owned and have seen them come down, and you've sat on some pretty big losses, and maybe you're wondering whether they're going to reverse, whether I should add more. And you've had some people weigh in on that. Marko Kolanovic, I mentioned his note yesterday, got everybody talking. He said the correction in bubble sectors is now likely finished, that there are great opportunities in high beta and innovation and in technology. That's butted up against another thing that Ricky Sandler told me. Let's listen to that, and then we can discuss these stocks on the other side.
We've definitely corrected some meaningful amount of where the exuberance was. I personally don't think it's over. I don't think that we have cleaned out all of the excessive optimism on companies that are growing just top line but not profits, or companies that have large TAMs but difficult paths to attack those TAMs. So I think we've had a good amount of the damage, but I don't think we're done with it.
I mean, Doc, I'm curious as to what you think. You know, that this week has been very good. The Innovation Fund is up 16%, and many of the names within it in the exact universe of what we're talking about here have surged in some cases more than 20% each. Does this mean the worst is over? Who's right, Kalanovich or Ricky Sandler?
I tend to side with Kalanovich, Scott. I only really have recently traded one of these names, and that's DocuSign, which I would put in with that group. Other than that, I haven't really seen the institutional adoption get back in. They probably didn't want it on their sheets, either at the end of the quarter or even just the end of the month. But could we start seeing people coming back into a very battered sector like this, that, just as you cited, is up triple what the S&P is up this week, a little more than 3 times? Yeah, you could, but that's something that will play out over weeks and months. Obviously, there's been a lot of slings and arrows shot over at Kathy and her team. I think a lot of it undeserved. She's a longer-term play rather than a short one. Just like you and I've discussed, it's much more like if you're trading, you know, the triple-levered S&P 500, you know you're in for the short term. That's a very short-term trade because it resets every day. If you're in something like Kathy's ARC, you have to be giving her group the time it takes for those innovations to play out, rather than saying, oh, it's going to be 16%, 20% this week. That happens occasionally, but more often than not, that's a slow grind higher that might beat the rest of, you know, the tortoise and the hare kind of race. And I would definitely be betting on Kathy and the tortoise, especially at this level of those stocks, Scott.
Brenda, what do we think about this? And I also note that you sold a firm, which I'm going to look up right now as we have this conversation. I mean, a firm is having a nice day today, but again, we're talking about a stock that was from 176 down to 40.
Yes, and I think there is still more caution to be had amongst the group of high growth, the unprofitable companies. So Affirm certainly falls into that category. And in this case, we continue to believe in the business model here. So this was not a fundamental decision per se, although I will say that, we're believers that buy now, pay later will continue to gain market share. And Affirm is very well positioned, has great partnerships, but we think it's just going to take time and execution for the company to really prove that this is a viable model that can take share and that can potentially perform well even in an economic period of slowness or even possible recession, because there's certainly a lot of skepticism out there. And again, we're believers, we're keeping it on our radar screen, but we did decide to sell the position. We invested the proceeds into Cisco. SYY is certainly a very different company, but one where we think there is also opportunity. This is a consumer staple company. They're usually characterized by low growth, but this company has positioned itself very well, particularly throughout the pandemic, and was really able to gain market share. It still plays in a really highly fragmented market, so it only has 17% share. Also a reopening story as more large venues, hotels, restaurants continue to reopen globally. We think this company is really well positioned to benefit from that.
Here, Jason Snipe is the conundrum for some of the folks watching this show or any investor who's had these kinds of stocks is exactly what Brenda just said. She doesn't have a problem with the fundamentals of the company at all. And she can continue to make a bullish case for the fundamentals moving forward over a long period of time for a company like Affirm, but realizes that interest rates may be going up and stocks like this can't perform in that environment. At least that's what she thinks. How about that? How do I figure all that out?
Yeah, and I think Brenda makes a great point just on, the business models of these companies and playing into the narrative. And yes, Scott, I mean, these companies are hard to invest in this stage of the cycle, right? So if I look at a Shop or a Twilio that are both off 52% off over 60% off their 52-week highs, and both have bounced tremendously this week. I think Shop's up 20%, Twilio's up 14%, and I own them both And I'd like to see a little bit of a bump here, but I understand I've right-sized these positions, understanding that this cycle is going to be challenging for them, but I believe in them long term. And I think that's kind of the Cathie Wood story. And you just need to understand, how these types of companies, high beta names, perform in these types of environments.
Right, Weiss, how do you deal with that kind of question, right? You can bet on the fund, you believe in the fundamentals, but the environment just says to do something different. It's like what Ricky Sandler is saying. I mean, you can think that these companies are great, but the track of interest rates just makes these stocks not workable.
This is the period that reminds me of 2000 when the internet bubble burst. You had lots of companies with great fundamentals, and it was a moment in time. We're coming off a moment of time that we've never seen, with zero interest rates, with an insatiable appetite for the next new thing. But what has to happen now is that you can't just be a fundamental analyst, you've also got to be a stock analyst, and that's where it gets tough. So you can look at a company, say great fundamentals, they're growing, et cetera, but as a stock, it's just not going to work. So I think you're smoking dope at this point if you think those stocks can go back to where they were, or even close to where they were, because of a perfect situation that existed that got them to that point. I mean, and SPACs are, by the way, symptomatic of what we saw then. So you can't say that they'll go where they are unless you also believe SPACs go higher. And guess what? They're not either. And a lot of them won't exist. So I think move on with it. It was a moment in time. Great trade if you took advantage of it. Don't do any celebration because they're up 15 or 20% this week when they're still down quite a bit. Use it as an opportunity to get out. And that includes the Chinese stocks. The view hasn't changed that I've had. So I've been negative, as you know, and short off and on BABA from 250. Now people talking about, oh, I bought it this week and it's up 30%. I'm a hero. No, you're not. You're lucky. Get out now. So look, I'm not getting paid for the risk in this market.
Yeah.
Russia, while the human tragedy is beyond anything we could even tolerate or even look at, they're a pimple in terms of the global economy. China's not that pimple. So if China, if they assist Russia, we don't know if they will or not, then that's going to be a whole different issue. And that upsets the entire global economy. Do you really think you're getting paid for that risk in this market right now?
Okay.
I say no. That's why I continue to be cautious.
Okay. Up next, our headliner, Trivariate's Adam Parker. He says it's time to start thinking about one specific part of the market. It's our call of the day. We're back in 2 minutes.
Welcome back. I'm Rahel Solomon, and here is our CNBC News update at this hour. In the Ukrainian city of Lviv, a solemn display to honor children killed during the Russian invasion. 109 empty baby strollers set up in a square in the middle of the town. The UN has confirmed 816 civilian deaths in total, but the actual number is believed to be much higher. A Western official says he sees no evidence to suggest that Russian President Putin has changed his intentions for Ukraine, despite military setbacks. That's as Putin held a rally with tens of thousands of people to praise his troops and also celebrate the 8th anniversary of Crimea's annexation. On the news tonight, meantime, team coverage on the ground in Ukraine of the damage done and the fight to survive. That's tonight at 7 Eastern. And a former Arkansas deputy has been found guilty of a misdemeanor charge for the fatal shooting of a teenager during a traffic stop. Michael Davis, however, was acquitted of the more serious charge of manslaughter. He faces up to a year in jail. Scott, I'll send it back to you.
That, Rahel, thank you. Now to our call of the day. It comes from one Wall Street strategist who says to go small for big returns. Let's bring him in. Adam Parker is the CEO and founder of Trivariate Research. Welcome back, AP.
Hey, good to see you, Scott.
So small caps, I mean, it's a big and somewhat controversial call here. I mean, you better hope the economy doesn't weaken and that rates don't go up too much.
Yeah, I think what we do is we ingest about 150 macro variables, and we create some gauges for economic activity, industrial activity, consumer, et cetera. And our work shows that typically small caps outperform in this sort of macro backdrop. Now, you couple that with the fact that small caps have lagged a lot. They lagged a lot in the up tape last year and have not done well relative this year in the down tape. And the fact that the margins for small caps have lagged, but now look like they're holding up a little bit better than large caps from here. So what am I paying on price to sales for the gross margins? It looks relatively more attractive for small than large. So I think the risk reward is skewed there to the positive. Obviously, a strengthening dollar is bad for large, and there's some other mitigating factors. But net, I think the risk reward is skewed towards small beating large over a 6-12 month view.
What is, quote unquote, this sort of macro backdrop? How would you describe it? What do you see?
I think overall economic activity is still increasing. I think the consumer is probably peaking a little bit. Industrial activity is very high but plateaued. Generally, the dollar strengthening. I think if you look at across the board, financial conditions tightening. Generally, small caps have a little bit less non-U.S. exposure, so the strengthening dollar doesn't impede their P&L as much. Generally, the large caps had better pricing power out of the gate, and I think that's part of the reason they did well in the uptape last year. But that seems to be, balancing out a little bit here. And so as you get farther and farther from the trough, I think the lower margins, small caps can have a bit more margin expansion from here. Large caps, it's just harder for many of them to expand margins at the rate they did. So it's a little bit of a relative profit margin call.
I know, but the dollar has been weakening, hasn't it? And people like Jeffrey Gundlach think that it's going to continue to weaken.
It just depends. It depends on what basket you're looking at. Obviously, dollar euro probably matters the most for U.S. equities and aggregates, select staples, et cetera. So it really depends. I think it's just a function of the fact that you had an unusual scenario of a big risk on tape last year and small caps lagging that created this big valuation disparity. And so what I look at, and it made sense, I guess, in retrospect, right? I mean, large caps have more pricing power. They have more ways to absorb rising costs. But now that most of that, or some of that's behind us in terms of their ability to absorb it, it kind of evens the playing field out a little. And I have lower margin at a lower multiple for software. So that's, I think, the relative comparison. I think it's about relative estimate achievability, Scott. I think that's.
I mean, let's be clear, though. This all comes down to, in some respects, that you don't believe the Fed. You don't believe that the Fed is going to raise rates nearly as many times as the plot would suggest, nor what Governor Waller told Steve Leisman earlier today.
I think what matters is the perception about interest rates more than the reality. So like the Fed fund futures, and we do a lot of work looking at equity returns on changes to Fed fund futures, because that's what seems to drive stocks, not the actual 2 or 10. You're right. I don't think they're going to end up being as hawkish as they've been, or as the sentiment's inflected over the last few months. But what's interesting is, and this, the small cap universe has a more skewed constitution toward financials, REITs, et cetera. So if you do get that I don't know if directionally that hurts small versus large in terms of that one call that we're talking about. But yeah, I think they'll do less if they're as aggressive as some people say. I think they risk a recession at a higher probability. And if I'm taking a step back saying, okay, what really happened here in the last 3 months? We got more hawkish on rates and we got a growth scare. So if we're being intellectually honest, the probability 2023 earnings are above 2022 is lower than it was 3 months ago. I subscribe to that view. I still think they're going to grow, but that's a real risk that's formed in the last 3 months, and it's different than I would have viewed it.
But the flat curve, a flattening curve is what you have now, is not good for financial stocks, which are, as you said, the largest part of the small cap universe.
Yeah, I think it just depends if it's deep in summer. Look, it's funny. This morning, Scott, was the first time I thought maybe I should buy some 2-year in my personal account. Right. So it'll be interesting to see if you get demand on the shorter end of the curve, because all of a sudden you're thinking, all right, well, maybe I can buy that collect close to 2% a year for 2 years. It's not that much duration risk. So look, you could get some steepening if this happens. We'll see. I'm not a rate expert. What I'll tell you, though, is all the rate experts I know are usually wrong. And so when everyone gets super skewed on the hawkish side of the aisle, making the directionally dovish bet has been the right move most of, if not all of the last decade.
So if not 6 more,
I think your panelists will agree.
If not 6 more, and then I got to go. If not 6 more hikes this year, and you heard Waller say you could get 50 at more than one meeting, what do you say? What's your number?
Look, I'm not an interest rate strategist, but what I know is what's in the price of the stocks.
Come on, man.
No, but I'm saying
you can't say that you don't believe the Fed and then not give me your view on how many hikes you think we're going to get.
I think if what's priced in is 6 to 7, I'll take the under. I think what's more important, Scott, though, whether it's 3 or 4, I don't know. But what I think is more important is what's priced into the stocks relative to expectations. That's what we're experts at. That's what we spend a lot of time looking at. Where do you have statistically significant relationships above and beyond equity market beta? What are the relative opportunities? So if I get anything directionally dovish, like biotech rips, or I could find things that are mispriced for the innovation in that environment, and that's obviously what Trivariate's expertise is.
I understand that, but you got a doctorate in statistics trying to tell me you don't know about interest rates.
Yeah, well, they give those PhDs away for free.
Yeah.
You know that.
Okay. I'll see you soon. That's Adam Parker.
Yeah, man.
Trivariate.
Take care, guys.
All right. You as well. Up next, John's got his unusual activity. We're back after this. All right, Dr. J, unusual activity. What do you see today?
Well, Scott, starting with investment grade corporate bonds, the ETF is LQD. And we're seeing big buyers of puts in this one, Scott. This one has traded down, 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 made a little bit of a bounce this week, but people are looking for it to go significantly lower. Why do I say that? Because 10,000 of the June 118, that's the 118 strike puts, have been purchased today with this index just north of 121. It doesn't move real fast, but it has been moving from the upper left to the lower right in a pretty defined pattern. So I'm in the put spreads for this one, Scott. Second one, NVIDIA. You choose how you want to say it. This one, Scott, we talked about those 2:30 calls earlier in the week when you and I were on Tuesday, I think it was. Screamed through that. Those are now $30 in the money, and they've rolled out to the 25 expiration in March. That's next Friday, and they're buying the 270 strike at that level, Scott. Some 7,500 of those changing hands. I stuck with the NVIDIA, rolled up, rolled up, rolled up. Now I'm in these all the way up to the 260 strike and short the 275s.
All right, good stuff. Dr. J, thank you very much. Check out this mystery chart now.
Thank
it's one
you.
of the best performing stocks last year, and one of our own investment committee members now is making a move back into the name. They're going to call in, tell us exactly what it is next. Welcome back. Another one of our investment committee members making a move in their portfolio. It is Stephanie Link, and she joins us now on the phone. Steph, in what's been a busy week for you, you called into overtime. You told us about some moves there. You made some new things here in half, and now you got another one. What is it?
Yeah, so I'm getting back into Fortinet. You know I've liked the cybersecurity industry for some time. I especially like the network firewall subsector. That's a $5 billion market by 2026. And yet Fortinet is down 16%. after even beating the quarter on earnings, free cash flow, total revenues. Importantly, the biggest metric I look at is bookings, and bookings actually grew over billings, so they have very good visibility. And their guidance was very strong. Total revenues, billings, bookings, product revenue, all of them are expected to grow north of 27% for 2022, and they're doing a really good job cross-selling and upselling as their customers want to simplify their vendor base. So they're taking market share. So the operating margins are still under pressure because of supply chain issues. They talked about that improving in the second half of the year. They put 3 price increases in place since November, and you have a catalyst on May 10th. You have an analyst day. So down 16%. I like it. I've always liked it. I took my profits a couple of months ago, and I'm getting back in.
You know, I recall a conversation I had the other day in overtime with Dan Ives, the analyst who said that Palo Alto is the table pounder, and those were his words, the table pounder in this space. But why is that not, and this is?
Well, because I think that Fortinet has not been really anywhere in the enterprise, and they have new products. And as I mentioned, they're doing a better job at taking firewall and non-firewall products to their clients. And so I think they're going to continue to maintain market share. But cybersecurity, I mean, this is a place where you absolutely want to look for the opportunities on weakness. So it's not like I don't like Palo Alto. I just think that Fortinet, with their product set, is positioned better for the next 12 to 18 months.
I got you. I appreciate it. Have a great weekend.
Thanks, Scott.
All right, we'll see you soon. That's Stephanie Ling. Jason Snipe, you own Palo Alto Networks.
Yeah, I think obviously cybersecurity is obviously those are the new wars that we're fighting these days, and you know they've had really strong revenue growth over the last several quarters. And from their perspective, I look at Palo Alto as one of the incumbents in the space, and they've done a lot of reinvestment last year, which I think will come to fruition this year, and that's why we've seen some spike in the name so far this year.
Okay. Consumer discretionary stocks are leading the way this week. The man you just heard from there, Jason Snipe, is buying. He's buying more of one name in that sector. He'll tell you what it is next on The Half. I told you we have another investment committee move to tell you about, and it's Jason Snipe who bought more of that stock right there. TGT, why?
Yeah, Scott. So I added to Target. It was my final trade last week. You know, in a market where valuations matter, I mean, it's trading at 15 times forward, has a dividend of 1.64%, operating leverage really doing well here. Is trading about 18% off its 52-week high. They've really seen a lot of strength in the multi-channel consumer and flawless execution throughout the pandemic, and I think that's why they're benefiting from customer loyalty here. So I like Target, and I decided to add some capital.
Okay, so Dr. J, I know you like Target as well, obviously, and we don't need to talk about that for all the reasons why you do love it. What I'm surprised at is if you love Target, why do you have XRT puts?
Because I don't love all of retail, Scott. Obviously, XRT gives me a little broader swath. I think Target outperforms, since you and I are all about alpha. I want that alpha. I don't just want something that's going to track all those retailers. So that's why I think it's a little bit of a hedge, but it's also because I think many of them, you saw from Joann today, for instance, JOAN, they said shipping costs are up $60 million higher than they were same time last year. I think a lot of retailers can't stomach that, Scott, and I think then those are the ones that are going to be weak.
Okay, fair enough. We'll come back with final trades after this.
Are you following the Halftime Report podcast? What are you waiting for? Real debate and actionable advice from the investment committee, plus unusual activity and more. Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
Do not miss Overtime tonight on this Friday at 4 o'clock Eastern Time. We have some big interviews coming your way. Jim Chanos, the founder of Kinnikos Associates, will be with me. Is now the time to cover your shorts? Now the time to double down? I'm going to ask him that very question. He'll give me the answer, I hope. Masellam's John Duskin is going to join me, too. He has a new activist campaign we just learned about today. He's going to come on, talk about the company he's targeting now, what he wants, and what the company is saying in response to him. So don't miss that. Overtime today, 4 o'clock Eastern Time. A lot of other good stuff coming up after the bells ring. Final trades right now. Brenda, you're first.
Go with Amazon. This is a company that really invested very heavily in the business last year. A lot of those investments we think went into logistics. We don't think they're going to have to repeat the same level of investment this year. Everybody knows that we're in an environment of higher labor costs. They have them, they're baked into the numbers, but we think there could be some surprise on the margin from that lack of additional spending this year.
Okay, thank you. Jason Snipe, what do you have?
I like healthcare here, Scott. I mean, return to preventative care, return to elective surgeries, strong pharma pipelines here. So I like healthcare. Stay long.
Thank you. Steve Weiss.
FedEx, the quarter came in as I expected, but for different reasons. They were right on the money on the top line. The bottom line they missed. I thought it'd be because of labor and oil, but they managed that pretty well. They passed through anyway. It's because of Omicron. It's temporary. At 10 times earnings, I added more to it today on the further decline in the stock.
I'm going to see you in the OT tonight, Weiss, because we're having our own little version of Friday Night Fights. You and Jim Lebenthal are coming on in overtime to go mano a mano on whether we in fact have bottomed or not. I can't wait for that debate. I will see you later on. Dr. J, what do you have for your final trade right now?
Boston Scientific, Scott, DSX, April 43's medical, surgical sales, and cardiovascular, double-digit growth. Love the company.
Okay. I said we have the best week for stocks since November of 2020 for the three major averages. See what happens between now and overtime, and I'll see you then. The exchange is now.
Thank you very much, Scott. Hi, everybody. Welcome to the exchange. The hawkish headlines just keep coming from the Fed, and yet stocks just keep rallying. Fed Governor Christopher Waller telling CNBC this morning that inflation is raging. The Fed has to get more aggressive, and now markets are pricing a much higher chance of a half-point hike next meeting. Stocks unruffled. The Dow and S&P having their best week since November 2020, like Scott said, while the NASDAQ is up more than 9% from Monday's close. But we're going to hear from someone who says you might want to sell this rally. And CNBC's Next Gen 50, the stocks most appealing to younger investors, having their best week of the year. Our trader picks two names that still have a bright future and two that are past their prime. But first, let's go to Bob Bassani with the latest on today's market rally. Bob?
And Kelly, best of the week for the S&P since November 2020, as you mentioned, and it's being led higher by technology stocks. So we had a great week with big cap tech. Salesforce is up 9% this week. Apple's up 4 or 5%. Microsoft is rallying. You can see that. Intel's also on the upside. But it's very choppy trading, and a lot of stuff is still not really participating. So banks, for example, you know, there's a real problem here with the flat yield curve. 2-year going up, 10-year not going up so much. This is giving it the big super regional banks like Zions and KeyCorp a really tough time this week. So that's been very choppy. Kind of in the middle are energy stocks. You know, they've had the big run of the year, but even they topped out about a week ago, and they have been an uptrend recently, though. So the big names, the most move most on beta, Devon, those kinds of stocks, Schlumberger, for example, all on the upside. So just look at the broad trend, because it's really, really choppy the last few weeks. Look at the broad trend, what's going on. Generally, value is killing it. Value is on flat for the year. That's mostly energy stocks, but they're really up nicely if you take a look at that. Growth is underperforming, and technology stocks generally aren't doing as well. Commodity is still the big winner. If you look at the Invesco Commodity Index, that's a big basket. Widely traded DBC, that's a commodity futures basket, that's all moving as well, up about 30%. XLE is the energy sector, that's up about 25%. Take a look at the S&P 500. I just want to point this out to everybody because we are on a complete round trip compared to 1 month ago. We bottomed February 24th. That was the day of the actual invasion, but we were moving lower the week prior on concerns about that. So we've gone completely round trip. And Kelly, you want to know what's going on this week? I think the message post-Powell, post-FOMC meeting overall is it's a little too soon to panic about the Fed tipping us into some kind of recession later in the year. Powell seems to have quieted that talk down, and that seems to be the main reason for this rally in the second half of the week. Kelly?
Great point, Bob, and we're going to pick up right there. Our Bob Pisani, we appreciate it. All right, it's Friday, so let's take a quick look at and do a gut check on all the economic data we've gotten this week, the good and the ugly. Let's start with the ugly. That's going to be this retail sales report that we got. The core measure up only 0.2 versus the 1% monthly gain that was expected. But remember, this comes after a really strong spending number in January. And this is data point number 2. Consumer spending intentions from the New York Fed, we talked about this earlier this week, hit a fresh record high back to 2013. So even though consumer sentiment has been pretty weak, you actually see people spending and saying that they're going to keep spending quite substantially. Okay, also in the good camp, you know where this one's going. Jobless claims, they fell again last week. That was new claims. The continuing claim series, it's like a 4-week average at a 52-year low. So no wonder Chair Powell repeatedly talked about the strong labor market this week. And this one doesn't get as much attention, but industrial production, important to point out that we do keep chugging along here. Manufacturing was strong last month despite a slump in auto production, and total capacity utilization rose again, and it's now higher than it was pre-pandemic. So a lot in the good category this week. In fact, maybe a little too good. Let's flip over and talk about the data point on everybody's minds today. It's this rebound in inflation expectations. Here you see them collapsing after the super hawkish Fed meeting on Wednesday. Then they've popped right back up to about 3.45%. That's today. It's also compares with under 3% back in January. So a huge increase here in where the market thinks inflation is going to be over the next 5 years. Now, on that note, Fed Governor Christopher Waller told our Steve Leisman this morning that he thinks a half-point hike may be needed next meeting.
I really favor front-loading our rate hikes, that we need to do more withdrawal of accommodation now if we want to have an impact on inflation later this year and next year. So in that sense, the way to front-load it is to pull some rate hikes forward, which would imply 50 basis points at one or multiple meetings in the near future. I just think it's better to have a strategy of just do it on the rate hikes rather than just promise it.
All right, the Nike strategy. Joining me now is John Taylor. He's professor of economics at Stanford University, also a senior fellow at the Hoover Institution. It's great to have you here. And where do you think the Fed should be taking? I mean, they were pretty hawkish on Wednesday, to Powell's credit, and it's been interesting to watch the stock market appreciate that and inflation expectations still rising. What are your thoughts?
Well, I think they moved in the right direction, but not enough. They really have to move. And I think the comments you just heard, replayed, are maybe another a couple of 0.5s will bring us to close to 3 at the end of the year. Now they're still under 2 by their dot plots. So I think a little more is necessary. I think it's very important because getting behind the curve in the past and in the future will be very damaging. So we don't want that to happen.
We're talking about, and the consensus is starting to kind of come around to this idea that the Fed is going to 2% or 3%, and yet the 10-year Treasury is trading, last I saw, under 2.2%. So you're telling me they're going to take the overnight rate above that level possibly in the next 6 to 12 months? What is the long end telling us?
Well, the long end is telling us they don't know. They're thinking what various people will say at the Fed, what the Fed will do. You heard one commentary, which is unusual, but I think it's still not clear. Will their move above this 1.9, which is what the dot plot's telling you at the end of this year? I think it'd be much healthier. And I think the markets would react positively. I think the economy would react positively. You're seeing a little bit of that already in the stock market. I think there would be a positive benefit to moving a little bit more now and therefore less necessary later.
Do you sort of agree with the Larry Summers take from earlier this week? And again, he's been quite critical of the Fed for being behind the curve, but he now thinks they risk sending the U.S. into stagflation or a recession. What do you make of his comments?
Well, that's always the risk of being behind the curve. Because if you're behind, you eventually have to catch up, or inflation will just go bananas. So I think what he's reflecting is the experience. You know, we saw this way back in the past in the 70s, and people say it wasn't the Fed, it turned out to be the Fed, and we had a terrible time. So I think that's common sense. That's what we're learning, and hopefully the people at the Fed will pay attention to those statements coming from Larry and others, for that matter.
Why do you think it is that a pandemic has unleashed such a lasting shift in the labor market?
I think it's basically very unusual, and people are getting used to it. People are working at home. They're not working. They're doing different things. And I think we have to realize it's going to be a new world in many dimensions. We're using the internet more. We're using telecommunications more. I think it's going to be different, but I think we'll learn how to do with it. In the meantime, we don't want to just let inflation go, because that could be very damaging. The hope is that if there's some adjustments, not a little more than what's in the cards, that it'll be a more successful recovery, a smoother one. And that's really what we hope. We don't want another one of these crashes again, which would be very harmful.
And the Fed chair himself, you know, when he was asked about, you know, his respect for Volcker in Congress last month, he was very clear that he has huge respect for him. He, this week in the meeting, made it clear that if they need to hike more than a quarter point, they will absolutely do that. So I just want to kind of end back on this point about the markets and why they don't seem to be taking that at face value. Do the markets know something the Fed doesn't about the economy slowing? Or why else wouldn't they believe that this Fed might be as hawkish as you're describing?
Well, the Fed, their guidelines are not that hawkish, right? They're still quite low by the end of this year and into next year, for that matter. So you haven't seen this change. You know, let me say the Fed took out all the references to policy rules in its last report. I think that was kind of a shock. And now they're thinking of putting them back in. Jay Powell said, "Don't worry, we'll put them back in the future." So it's important, because those rules have been a good guideline. And when the Fed deviates them, the biggest deviation we've ever seen right now, it's damaging. And so getting back to this, I call it rules-based policy, but call it what you want, will be a better situation.
And where would your Taylor rule say the policy rate should be right now?
About 5%.
5%?
Yes.
What? Is there any reason why they shouldn't take that at face value?
Yes. I mean, Maya says let's get to 3 at the end of this year rather than still under 2. See how it goes. But if they delay, you know, there's been lots of adjustments. Even that 5 is taken into account the work that John Williams has done, which is a lower equilibrium rate, if you like. It's taken into account the different situation in the economy. It's taken into account that possibly inflation will come down. It's taken into account that some of the increases in inflation we've seen recently are related to Ukraine and Russia, what's happening. All those things say, well, let's get to 3 at the end of this year. And then I think it'll probably be a little bit more than that before we're done, but we'll have to see.
Absolutely fascinating. John Taylor, thanks for your time today.
Thank you.
We appreciate it. Well, if you're surprised by how strong the market has held up to the hawkish Fed talk this week, maybe you shouldn't be. My next guest says historically, Fed tightening hasn't been bad for markets. Paul Hickey joins me now. He is the co-founder of Bespoke Investment Group. I don't know, Paul. I mean, if we were talking about John Taylor hawkish, that would be a different story, right?
Well, yeah, that would be a much different story. And so, I mean, that's part of the point. What the Fed did this week is they basically moved up to what the market expectations were. So, sure, was it hawkish relative to this Fed? Yes, but the market was pricing in a certain level of rates and rate moves going forward, and that's basically what we got. So I think that is one thing to focus on. And then going out to the end of this year, rates will still be relatively low given the economic circumstances.
What about the fact that it might be different this time because we're not in a economic environment like we were after the financial crisis? Obviously, maybe we have to go back to something a few decades prior to that for a similar inflation landscape.
Yeah, so I mean, it's always different this time, and I think to your point, you look back. So the median gain during a Fed tightening cycle is going back to 1994 is about 6%. Well, we've done that this week, so on that point, you can say that we're already there. But I think it's always different this time. There's also a lot of things going on in the market right now that are a lot that are going to play out and have an impact on what Fed policy is. Ben Bernanke once said that, forecasting the economy is like working on a car with the engine running. This is more like an Apollo 13 mission, I think. Trying to play with all the moving parts, what you have, the tools you have, and get out smoothly. So I think there's a lot to focus on here, and no one really knows how this is going to play out here. We're in sort of uncharted territory. But what we do is, rather than give our opinions, we'll focus on what the market is telling us, and the market is pretty comfortable with with what has come out this week.
Yeah.
4 straight days of NASDAQ 1% gains after a 52-week low. That's only happened one other time back in 1980. So, and when you just have back-to-back 1% gains following a 52-week low, forward returns have been pretty good for the market. While short-term, you have tended to see volatility, but looking out 6 to 12 months, you tend to see more improved returns and things getting back on track.
And I like what you're saying here about energy and technology, and here's something that is a little unique. Typically, those sectors both do well and post gains of more than 20% in a tightening cycle. But obviously, right now, technology is sitting this one out.
Yeah, well, technology since the Fed hiked has actually done great in the last 3 days. But so it's interesting because those are the two best performing sectors. But this year, they've been more inversely correlated than probably any other point in history. Every day that energy goes up, tech goes down and vice versa. So, I mean, what we're looking at in this market in the short term is we're tending to focus on, when things start to get a little ahead of themselves, lighten up. And when things start to, be too beaten down, to, dip in and add some exposure. So in the technology sector, two names that looked interesting in the middle of the week were Qualcomm and Broadcom. They're not the highest growth semiconductor names, but they pay pretty good dividends. So they're somewhat insulated from a major swing. And the dividends are pretty safe with these companies. They have the earnings to support those dividends. So I think, if you're taking somewhat a conservative approach to add exposure, those two names look interesting.
Well, there's something intriguing in what you're describing here, because you're right. Look at technology over the past several sessions, including the session after the Fed's hike. Do you think that maybe we could be seeing a repeat of history where technology actually performs pretty well and kind of puts behind it the terrible start to the year that it's had?
Yeah, so that's a great question. So, I mean, we got to the rate hike, but everybody knew what was coming Wednesday from the Federal Reserve. We knew the rate hike was going to be. We're going to get more hawkish outlook in the summary of economic projections. So the market priced a lot of that in. So, I mean, we had one of the worst starts to the year for the U.S. equity market in history, and we had one of the worst starts for technology. Historically, when you see those through the first 2.5 months of the year, forward returns have been better. And so the market does tend to price those things in. And so, they were oversold heading into this week. You want to step in when things are getting to extreme levels. But, right here after 4 straight days of 1% gains, hold off for a little bit, make sure to see that these short-term downtrends are broken before you start to, give the benefit of the doubt more to this rally.
Love the perspective, the historical perspective, Paul. A lot to chew over there. We really appreciate it.
Thanks, Kelly. Have a good weekend.
You too. Paul Hickey from Bespoke Investment Group. All right, coming up, higher rates have already started weighing on housing, that's for sure. According to last month's data, where we saw home sales take a dip and the average rate on a 30-year fixed mortgage now at 4.5%. Will it spoil the spring selling season? We'll ask the CEO of Coldwell Banker next. Plus, the CNBC Next Gen 50 Index on pace for its best week in a year. There are all its components. Ahead, we'll tell you the names driving the gains and the ones our trader likes for the longer run. And as we head to break, a quick check on markets at session highs right now. That's a 25-point gain for the Dow. But there's the NASDAQ once again up more than 1%, as we were just discussing. We're back in a moment.
This is The Exchange on CNBC.
Welcome back. Existing home sales slumping more than 7% in February just from the prior month. They're now down about 2.5% from a year ago. These sales were also likely underway back when mortgage rates were hovering around 3.25%. Look at that increase behind me. Rates have been on the rise. They're now around 4.5%. And how much should we expect that to further dent the housing market? Joining me now is the CEO of Coldwell Banker, Ryan Gorman. Ryan, it's great to have you. And it's like the best of times, and I guess the best of times for, well, but you still don't have any inventory, and a lot of people feel like they still can't afford, or get into a house. So do we need this correction?
I wouldn't say correction. I think we're still in a boom, certainly not a correction, definitely not a bust. But I do think what you cited is true. Home demand, buyer demand is so incredibly strong that the most common reaction I've seen so far from buyers to rates ticking up is, I hope this keeps other people home so that I'll have less competition in bidding, because we still definitely have multiple offer scenarios are absolutely the norm. Demand's way outstripping supply. As you mentioned, inventory is extremely low. Homes are only staying on the market for about 18 days right now. That's the biggest driver. It's not as though no one's selling their home. More than 6 million home transactions are taking place. But once they put that listing on, it's only staying on for about 2.5 weeks. So buyers certainly have their work cut out for them.
And how does that 18 days compare with normal? And where was it at the absolute sort of low point? Or is 18 days the low point?
We're pretty close to the low. I think we kind of flirted with 17 days at one point in time, but kind of in that 17 to 19 range is where we've been for a little while now, which is historic lows. So typically we're looking at twice or more than that in a more balanced market. You used to have the time to be able to go and view a number of houses maybe a week from now or set up appointments. Now you really need to strike while the iron's hot, hopefully working with a great agent who's got their pulse on the market. And when you do, you're going to be informed about an opportunity. You need to be well prepared, already underwritten, have your financing lined up, and be able to make the strongest possible offer to step into that home. So it's an extremely competitive market. But again, more than 6 million homeowners are winning in that market every year, and we're still at that rate today. So it can be done.
The quandary, I think, is well illustrated in the existing home sales report this morning, which showed, like you said, not a ton of inventory, or at least not a ton of available inventory. It turns over very quickly. And yet, home prices are still going up. So we have home prices still going up. Mortgage rates now higher, so the affordability issue is getting worse before anybody might hope it gets better.
There's certainly affordability challenges relative to the very most recent past, relative to, say, a month or two ago related to rates. But keep in mind, affordability has still increased in many areas because of the internal migration. So for the most part, the moves that we have happening today are oftentimes individuals who are accelerating moves to perhaps lower cost destinations, maybe accelerating a move that we're going to make 5 or 10 years from now as they plan for retirement, perhaps. So you have areas like, for instance, a lot of the largest multifamily players out there are reporting that even though they've increased their rental rates, the affordability of their units relative to the income of the residents has increased as they're internally migrating throughout the country. Individuals have the opportunity to work a little more remotely than they did before. So there's still an opportunity to step into a more affordable home, even though prices have increased. And of course, some real wage growth helps there too.
It's fascinating because you actually just answered the question I asked the economist John Taylor last segment, which was, why did the pandemic, a temporary phenomenon, unleash this lasting change in the labor market? And your answer about housing suggests what changed. Do you think people will be able to continue this kind of work from home trend that started, or are we going to run into, and I wonder about this with a lot of people who I know, a boomerang effect where all of a sudden they feel like they have to, or they need to, or they got to get back to those jobs in the bigger markets, and this didn't turn out to be, sort of the lasting change they
happens when people are together. So I very much believe in that. We've even converted our headquarters over to space for people to really get together and to work together, not just to show up and do solo work every day. However, I also think employers are perhaps permanently moving to a place where in a competitive labor economy, you've got to allow some flexibility. So even if someone has a workplace they're going to 3 days a week, that's a pretty big difference from 5, and it may allow them to move maybe 20 minutes a little farther out, a little farther on the train line, a little bit more by car perhaps, and that allows them to step into considerably more affordable housing, if indeed that's what they're looking for. We also have the Coldwell Banker launched our Dream campaign here on March Madness and across social, and that's really focused on coldwellbanker.com. Individuals going and being able to compare different cities and sort of dream with some data, and then ultimately with an agent what it's like to compare where I'm living today to where I might live in the future. The response has been overwhelming because I think there are people saying, if I can work a little more remotely, why don't I work where I love?
Oh, interesting. I'm now, he's going to be watching basketball. I'm going to be looking at your dream data or whatever you're calling it. Ryan, we really appreciate you giving us a sense on the ground still of what's happening. Thanks so much for your time.
Always a pleasure. Thank you so much, Kelly.
Ryan Gorman is the CEO of Coldwell Banker. Still ahead, it's the first triple witching day of the year, so-called, when 3 different sets of futures and options expire on the same day. We'll take a closer look at those contracts and what they may signal about the rally. But first is another wave of COVID on its way to the U.S. We'll bring you the latest on cases and hospitalizations in Europe and what health officials are saying about the Omicron subvariant that's gaining steam across the country. Welcome back to the exchange. 1.4% gain for the NASDAQ today. Pretty extraordinary. Meantime, the Dow has recovered from a 201-point loss to a gain of about 69. Let's check on the sectors for the week. And you see consumer discretionary, tech, and financials, the biggest outperformers. Again, if you missed it, we had a great chat with Paul Hickey a short while ago about technology, up 7%, even beating the financials. Energy having its worst week of the year, down about 4%. WTI holding above $100 a barrel today, but still down 5% since Monday. You can see some of these names there. On the flip side, the semiconductors are set to end the week higher. The SMH flirting with its best week in a year and a half. Every single component is still lower so far for 2022. And the ARK Innovation ETF, the ARK-K, it's actually having its best week ever after a rough stretch. Let's take a look at the top 5 holdings this week. Here's the chart. You can see names like Roku, Tesla, Teladoc, Zoom, and Coinbase. And Netflix is also set to snap a 5-week losing streak with its best week in over a year. Shares down about 4% for the month of March, though, and they're on pace for their 5th straight month of declines. Its worst losing streak since the year it went public. Can you guess it? Back in 2002. So again, a strong week against what's been a difficult several months. Let's get to Rahel Solomon now for a CNBC News update. Rahel?
Hi, Kelly. Here's what's happening at this hour. At the UN Security Council today, Russia's ambassador again accusing Ukraine of having a biological weapons program supported by the U.S. Speaking after the meeting, U.S. Ambassador Linda Thomas-Greenfield denounced Russia for using the UN forum to, in her words, spread its propaganda to justify its brutal attack on Ukraine.
We know this because it's a well-worn playbook. Just 1 week ago, they convened the council under precisely the same pretenses, and we heard a litany of bombastic and preposterous lies.
Gulfstream private jet used by Russian oligarch Roman Abramovich is one of nearly 100 Boeing airplanes that the U.S. says are being effectively grounded. Reuters reports that the Commerce Department is warning that any refueling, maintenance, or repair of the planes is a violation of U.S. export controls. And the House of Representatives has passed a bill banning discrimination based on a person's texture or style of hair. The legislation says that people of African descent are routinely deprived of educational and employment opportunities for wearing natural or protective hairstyles. Long overdue. And tonight on the news, Washington debates whether the U.S. needs to spend billions to develop hypersonic weapons to match Russia and China. Kelly, I'll send it back.
All right, Rahel, thank you so much. Coming up, the CNBC Next Gen 50 Index. It tracks names integral to the lives and careers of millennials and Gen Z, and it's on pace for its best week in a year. This name is the best performer, up 36% just since Monday. We'll reveal it next. Welcome back. The rally in growth names pushing our CNBC Next Gen 50 Index to its best week in a year, up more than 12% since Monday. This is chock full of names geared towards millennial and Gen Z investors, from tech to cannabis, crypto, and more. This week's top performers include an overlooked dating app and a COVID vaccine maker. Our next guest has 2 buys and 2 sells from the group. Let's bring in Gina Sanchez. She's the chief market strategist at Lido Advisors and a CNBC contributor. All right, Gina, great to see you. Let's start with Lemonade, the online insurance platform. They've been having a tough go of it lately, but they're up 36% this week. That was our little mystery chart into the break. Allstate announced it's hiking insurance rates to offset inflation costs. That has everyone excited, but you're not a big fan of the stock, are you?
Not quite yet. And, I think part of their rally just has to do with the fact that the Fed didn't come out with a 50 basis point hike. So I think that, that was just a little bit of relief because growth stocks have been getting destroyed. And this is a company that is so early in its growth story. I mean, they're just getting, they're growing their signups, they're increasing their premiums. But, the inside, they've expanded too quickly. They're bleeding cash. Activists called for the replacement of the CEO. So internally, it's still a little bit of a mess. That's not to say that the story isn't there, but they really need to get their act together.
All right. They are up 4% today. But a lot of the issues you highlighted have been a concern for the stock for some time. What about Bumble? I mean, this one's a little more straightforward, I guess, as a business model, but it's also up again more than 30% this week. What's your take? You'd still avoid it here?
Yeah, well, so Bumble is one of those stories. I don't hate it, but I don't love it either, because you have to ask yourself, can I do without this product? Can the world do without this product? And I'm not sure this is one of those that's an absolute must-have, but they are executing their growth strategy. And so, it is doing what they said they were going to do. And, from that perspective, if you are willing to take some risk, this could be interesting. The problem that you have is that rising rate environment, and it's going to discount. So it looks really, really overvalued right now.
Okay, but it's funny, a lot of these discussions or arguments could be headwinds for the whole space. A lot of these have been high multiple, high growth stocks that have come down to earth a little bit. Yeah. There's a couple names in the group, though, that you actually have kind of warmed up to. The first is Square, or sorry, I guess I should call them Block. Why this one do you think could be a better bet for the long run?
So this is interesting because, this is a company that's been around for a while. In fact, they had to fend off an Amazon attack in 2014. And so, this is one of those companies that has really made a space. It's made a niche for itself. It has good free cash flow. It's growing earnings. And yes, it looks a little overvalued, but I think that the fundamental story is very strong and it's not going away. And so from that litmus test of, can the world survive without this? I think there are actually a lot of small mom and pop businesses that are enabled by Square/Block in order to run their businesses that I think that this is here to stay and it's a stock you should consider.
All right. So that's the case for Square/Block. What about for Moderna? This one I'm a little, I wouldn't say I'm surprised to see you warm up to. I mean, the valuation reset has certainly been striking, but doesn't it still have this sort of pandemic on, pandemic off kind of trading environment to worry about?
So fair point, Kelly. This is definitely one of those pandemic darlings that then just got, taken out behind the shed and shot. And so, what you have to ask yourself is there more to this story than the pandemic? And they do have actually a pipeline, and they're really cheap. And the market right now doesn't, the market's looking for growth, looking for growth at a reasonable price, but it's also, warming up to value, and it has been for the last year just because we're expecting rates to go up. And you look at the product pipeline, and, one of their big products is going to be another flu vaccine. And the move for COVID vaccines is that they're likely going to become incorporated into flu vaccines. So that actually could put Moderna in a front runner for a vaccine that's massively, subscribed to and has enormous growth. So I think that they're quite cheap right now relative to what their opportunity set is.
All right. So 2 buys, 2 bails from the CNBC Next Gen 50. Gina, thanks for your time today. We appreciate it. Gina Sanchez with Lido Advisors. Up next, shares of Apple are higher this week despite supply chain snarls. China shutting down cities because of COVID again. We'll look at their dependence on that Asian supply chain and just how risky it is. And with cases on the rise across Asia and Europe, should Americans be readying for another COVID spike? And what about that 4th vaccine dose? That's coming up on The Exchange. Welcome back. The COVID shutdowns in China are re-exposing one of Apple's vulnerabilities, and that's its dependence on those Asian supply chains. Steve Kovac is here with more now. Stephen, will this time convince them to diversify, or is this company just almost too big to diversify now?
Well, they are very locked into China, Kelly. And in fact, Tim Cook was asked that very question on the last earnings call about a month and a half ago. And they said, are you okay having all of this supply chain locked into China? And basically said, yeah, it's great for us because we have the suppliers geographically close to where we actually build the stuff that we sell. And we can easily go from chip to factory and out the door and overseas really quickly. So that's why they're okay with it. And you got to look, let's rewind back to 2020 when the entire country of China was shut down and everyone was worried about manufacturing. Guess how long their new iPhone was delayed? Just a month.
Wow. And
so they're resilient here.
You know, it's funny because we focus on this concern so much, but it seems to be more a concern about a possible concern than an actual story. Whereas look at what's happened with the auto industry, where that's a much more obvious hit. Why is it that they've been able to move so quickly? Is it because we just showed the map of all these different sort of areas of these manufacturing hubs that they have? Yeah,
it's what Tim Cook was saying. It's the geographic how close they are. And also Foxconn, which is the company Apple contracts to build most of the devices, especially iPhones, they're nimble too. So what they did this week said, hey, we know Shenzhen shut down. We're going to move it to one of our other facilities in a city that's not shut down, and we can kind of make up for it there, and then we'll adjust back when things open up again. So they're able to be nimble and dynamic as they need to be among these shutdowns.
What are the analysts saying? Are they expressing any real concern about this?
Not really. I mean, as soon as the Shenzhen thing came out earlier this week, a couple of analyst notes came out right away saying, hey, you know, this is a concern, but let's not panic about it yet.
Yeah, and to your point, they've been down this road before.
Right.
And if the worst we're talking about is a 1-month delay to a new phone, and do you think that is the worst case scenario here?
I mean, if it's not as bad as it was in 2020, you got to think of it that way. So if it's just these 1-week shutdowns a little bit at a time, and at the same time, they are diversifying outside of China a little bit. AirPods, I should have brought mine with me, but if you look at AirPods in the back, it says made in Vietnam. That new Mac Studio that just came out this week, that's made in Malaysia. The Mac Pro made in Austin, Texas. So it's not the most of their manufacturing, but you know, they're dabbling around the world where they can.
Great point. Steve, thank you.
Thanks,
Good
Kelly.
to see you, our Steve Kovac. All right, let's dive a little deeper into some of these supply chain disruptions with someone who has firsthand knowledge of what's happening on the ground in China right now. Nathan Resnick joins me, I should say. He is the CEO of Sourcify. They match U.S. companies with factories overseas. Nathan, it's good to see you again. And where is there more impact already being felt from these shutdowns?
You know, this past week from our Guangzhou office, we saw shutdowns throughout the Guangdong province. So Shenzhen, Dongguan, Guangzhou all had shutdowns due to a COVID outbreak. China has a zero COVID, policy. So if there's any COVID cases in that area, they typically shut the whole city down. And that affected a lot of warehouses around Shenzhen and around Dongguan. Fortunately, this time it didn't close the port like it did last year, which caused huge supply chain disruptions. So, we're continuing to monitor the COVID cases closely, but fortunately, this time around, they didn't close the ports.
Which U.S. industries are most exposed to these shutdowns?
Right now, we're seeing electronics and home goods primarily. Foxconn shut down some of their facilities in Shenzhen, but fortunately, they're diversified, so there wasn't a huge effect on Apple's production. But, we're continuing to see delays trickle down, and that, might go into the holiday season depending on how COVID cases spike through the remaining of the year.
Wow, the holiday season, even though it's only March right now?
We'll see. Companies now are ordering and forecasting their inventory, more ahead of time than ever before. And so that's something that I think COVID has had a very large impact on when it comes to actually producing products in Asia.
And would you say that overall so far, let's say up to this point of the week, we've seen the lockdowns continue to intensify, or have they come off the boil a bit?
They're starting to come off the boil, fortunately. They do have a very intense lockdown policy there, but fortunately, we're starting to see light at the end of the tunnel.
Are there any industries that are completely unexposed that, those kinds of calls that you're happy to be involved with, where you can say, hey, at least you guys don't have to worry about this?
I think it depends where the production is located, right? So a lot of companies over the past few years have diversified outside of China. There's been different policies in India, Vietnam, Pakistan, you name it. But the challenge is a lot of the raw materials that those factories get outside of China, still stem from China. And so, everything is intertwined in the supply chain, and that's what we see on the ground floor. over there.
Yeah, I can imagine people so on edge after the last couple of years and what they've already been through. Nathan, thanks for joining us today.
Thank you.
Nathan Resnick with Sourcify. Up next, both Pfizer and Moderna have now asked the FDA to grant emergency use authorization for a fourth dose of their COVID vaccines as cases spike around the world. We have the details and whether another wave is headed to our shores. The Exchange is back right after this. Welcome back, everybody. COVID cases have been declining here in the U.S., but it's a very different story overseas right now, with surges across China, some of Asia, and Europe. Meg Terrell is here now with the latest and whether we should expect another wave. Meg?
Hey, Kelly. Well, unfortunately, often what we see in Europe and the UK will hit us about 3 weeks later, and some experts are expecting that here in the US. If you look at several European countries, over the past few weeks, we have been seeing upticks in cases from Germany to Switzerland, the Netherlands, the UK, and France. Hospitalizations in the UK also rising, up about 30% over the past 2 weeks. Now, the question is, of course, will this happen in the United States? And unfortunately, we have a lot of the same factors that are driving these upticks happening in the U.S. as well. Waning immunity, no longer wearing masks or social distancing, and of course, this more contagious Omicron subvariant called BA.2. Unfortunately, we also have lower booster rates than many of these European countries, so that could have provided a better backstop against potential more severe disease. The UK has 67% of its eligible population boosted, compared with 48% of eligible adults in the United States. What we have seen is that wastewater data here in the U.S. is suggesting that there might be an uptick happening in certain areas. We'll have to see whether that bears out. BA2, that more contagious Omicron subvariant, is growing in prevalence across the country and is most prevalent in the Northeast, almost 40% of cases last week, and perhaps even higher in some states. So that dynamic is playing out here as well. And a Columbia University model, now this is just a model and there's a lot of uncertainty around it, as you can see in the darker area there, suggests we may be at a trough in cases right now at about 30,000 per day, and that they could start to rise through April. So you have seen Moderna and Pfizer this week come out saying they're filing with the FDA for a 4th dose of their vaccine. Moderna just last night, for a much broader group, everybody 18 plus, saying essentially the CDC and healthcare providers should be able to decide, who this is appropriate for. Pfizer and BioNTech limited that to just 65 plus, Kelly. So we'll see how that plays out over the next few weeks.
What do we know about BA2, Meg? How does it compare with Omicron itself, with Delta, with the other strains that we've seen? And is there any reason to expect the U.S. population to react to it differently? For instance, I know Hong Kong has a low vaccination rate, a high death rate right now. What about the U.S.?
Yeah, the only major difference that experts have pointed out with BA2 versus the original Omicron is that it appears to be perhaps 30% more transmissible. There don't appear to be any differences in terms of severity or how well vaccines hold up against it. There are some questions about some of the antibody drugs that needs to be better illuminated. But essentially, studies have suggested if you've been infected with Omicron, you should have good immunity against BA2. Of course, there are folks out there who haven't been, and there's waning immunity overall, so that's the concern.
Interesting. So given that we had such a big Omicron wave in the U.S., could that provide some natural immunity relative to those countries that were doing more zero COVID policies or more insulated, where we've seen huge BA2 spikes? Is that something we can infer as to one reason why their cases have spiked so much?
Absolutely. In those countries that have tried to go the zero COVID route, now they're getting hit incredibly hard, and they don't have the backstop of a lot of their elderly population in particular vaccinated. And so that's why you're just seeing not only these tremendous surges, but in some places like Hong Kong, also a lot of mortality. The elderly population isn't as vaccinated. And there are differences, in countries that have higher vaccination rates, they are seeing lower mortality.
Yeah, anytime it's come up in conversation the past week, people just go, nope. They just put their hands over their ears. They're like, we don't want to hear it. We're not ready. We just got rid of all the mandates. Meg, thanks so much. We appreciate the updates as always. Our Meg Terrell with the latest on the COVID front. Still ahead, stocks are mixed today after 2 days of big gains, but we are building up steam as we move throughout the afternoon. The Dow's at session highs right now, up 87 points. The Nasdaq up 185. Triple or maybe quadruple witching is upon us, though. We'll talk about that next. And with more than $3 trillion worth of options set to expire, we'll look at what that means going forward after this short break. Welcome back to the exchange. All three major averages solidly positive for the week now. This actually would be the best weekly performance for the Dow and for the S&P since November of 2020, with about 5% gains. And today is a triple witching event. Trillions of dollars of stock index and stock index futures options all expiring at the same time. Is that partly driving the rally this week? Let's ask my next guest. Joining us now is Chris Murphy. He's co-head of derivative strategy at Susquehanna. Chris, first of all, is it triple or quad witching today?
Triple witching today.
All right,
you got
so
it right.
What are we not witching?
We are witching with futures, with the equity options, and with the index options, but not the commodities.
Not the commodities. Okay, thank you for clearing that all up. So do you think that has anything to do with the strong equity market activity we've seen this week?
Okay, so the equity market rebound, that's going to be based off of, China news, the Fed, all these different things. Now, the options can exacerbate the moves when options are expiring, and the market makers need to be a little bit more aggressive with their hedges right before expiration. So not the catalyst for the move, but can exacerbate the move.
It can exacerbate the moves. And, there was a lot of focus on the VIX in particular, Chris, going into the Fed meeting when people were worried about the Fed hiking if the VIX were over 30 and that kind of thing. But the Fed so far seems to have helped quell volatility, no?
Yes, I think that when we're looking at the sell-off that we've had so far this year, 10 to 15% corrections, those happen, pretty commonly in an economy that's still growing. What we were worried about was, the economy moving into a recession. That's when you see, larger than that normal 5 to 10% correction happening. I think Powell did a really good job stressing to United States investors that we're not anywhere near a recession. And if we're not anywhere near a recession, this current pullback is kind of the standard, expected, not out of the ordinary type of a pullback that we would see.
All right, so maybe, again, that is helping the VIX kind of move to a lower trend line. Where else are you seeing momentum shifts across the options market?
Sure. So the second half of this week, we clearly saw significantly less calls trading in commodity ETFs. Let's just say the GLD, for example, 50% lower than its 20-day average on Wednesday. That's been consistent the rest of the week. Then in the Qs, which tech, especially big cap tech leading the rally and the strength today, we saw a extremely notable increase in call volume there. So that could just be a sign that, the near-term option trading momentum chasing flow is coming out of the metals and into tech.
And is that typically a bullish sign or sort of a correlated sign? You want to keep chasing that activity?
Yes. I mean, we'll have to see if it has legs, but it's definitely a sign that, investors are, the near-term traders are really flocking towards that sector. Whether or not it's very near-term or not, it's not typically necessarily a sign, but it's definitely showing a sentiment change in the very near term.
All right, we will leave it there. Chris, great to have you on today for explaining what we're looking forward to and at the close and for so much else going on in the market. We appreciate it.
Thank you.
Chris Murphy with Susquehanna. That does it for the exchange, everybody. Thanks for your time. Power Lunch begins right now.
Kelly, thank you very much. We'll see you in just a few seconds. Welcome, everybody, to Power Lunch. I'm Tyler Matheson. Here is what is ahead. A key governor with some hawkish comments. Christopher Waller, not Christopher Walken, Christopher Waller says inflation is raging. The Fed is going to have to get even more aggressive to fight it. And now the markets are preparing for a half-point hike in May. So what does it all mean for stocks? We will hear from one investor who says to expect another leg lower. Plus, a big reason prices are rising so much, continued supply chain pain, folks. China's COVID shutdown, soaring shipping costs. It's all costing you more coming home to roost. Which retailers are best positioned to handle it? We will explore that one, Kelly.
Tyler, thanks. Hi, everybody. Let's get a quick check on these markets trying to close out a big week with about 5% gains so far. The Dow was down about 200 points earlier on. It is now up 87. The NASDAQ near session highs up 1.4%, and it's had a string of 1% gains this week. Paul Hickey pointing that out last hour, saying it's certainly a positive sign. Crude is having a volatile session after its more than 8% jump yesterday. We're seeing it consolidate a little bit here. WTI adding a percent, still up around 104 a barrel. It's about to turn in its first weekly loss, though, since the end of 2021 for energy. The social media names are getting a jump, led by shares of Snap and Pinterest. Those two names, plus Meta and Twitter, are up more than 15% this week. And the Chinese internet names also continuing their climb. JD, Pinduoduo, and Baidu, they're all up more than 30% this week, including those dramatic moves midweek as well. Pinduoduo up nearly 13% today. And the online retail ETF up 12% this week for its own best performance since April of 2020. Ty?
All right, despite today's move briefly dipping lower, the Dow and the S&P are now on pace for their biggest weekly gains since, believe it or not, November of 2020. So is this the all clear for investors? Our next guest says, no, not at all. There's another leg down from here that will bring a buying opportunity as investors sell everything, no matter what the fundamentals, the sort of classic washout. Joining us now is Greg Branch, managing partner with Veritas Financial Group and a CNBC contributor. Greg, you say that all the good news for 2022 is in the market right now and that the optimism is misguided. Why so blue, my friend?
Well, look, I certainly think that we are pricing in a best case scenario. I think this rally is built on the sentiment that things are improving in the Russia-Ukraine conflict. I would probably differ from that view. I think the current levels we are seeing reflects that the Fed raised the rates and now we don't have to think about that anymore, but we have 7 more increases to come. And so I think what you're seeing around the street is people are slowly taking their estimates in. You know, Goldman cut its S&P, BNP Paribas cut its S&P, other notables have, because I think consensus is coming to see that we are going to have a significant corporate earnings growth deceleration this year. And in an environment where we're having corporate growth earnings deceleration, and in an environment where the Fed is tightening, we're not going to get multiple expansion. And I think that there's further downside risk to where I'm at, even because I'm at low single digits on what I see as growth this year in terms of corporate earnings growth because of the many headwinds that we're facing, because of the many headwinds we're facing on the bottom line and the top line. But there's even further risk down. With $112 barrel oil, if the Department of Energy is right, and we're going to average $112 over the second quarter, with a tightening Fed and a flattening yield curve, that's a prescription for recession. Now, I'm not there yet at low single digits for S&P, but the likelihood that we dip into recession far outweighs the likelihood that there's an upside surprise to the low teens or 10% growth that the consensus is expecting.
So take it all together, and you've got slowing earnings growth. You've got rising interest rates, which probably in and of itself depresses the multiple that people are willing to pay for stocks. You've got rising energy prices and high inflation. And yet, I just began by saying that the S&P and Dow are having their best week since 2020. Well, where's the disconnect here? Are we just are investors just suspending disbelief?
Look, I just think that there's optimism that we've gotten past some of the overhangs without recognition that there are many more yet to come. We have not yet talked about the fact that global debt to GDP is 350%, far above where it was before the last crash / recession, which was at about 290. We have not yet talked about the fact that the ECB has stopped buying bonds as well and are reducing their balance sheet. And yet some of these countries, Italy's at 155% debt to GDP. They're going to need to issue more bonds. Who's buying that? So we haven't talked about the risk of a foreign default. We haven't talked about BA2 spreading, causing closures in China and how that's going to intensify. So the risks are decidedly to the downside to even my mid to low single digit outlook for the S&P this year. And if that's right, I'm going to dimension it for you. If that's right, right? Typically, a recession has led to about a 30% reduction in earnings. And if we take the $55 from last year, project that to be, with mid to single digits, around 240 this year, and take a 30% haircut on that, that puts us around where the S&P closed in 2019. Right?
Okay.
It puts us at about 160 of earnings with a 20 times multiple. That's a far cry from where we are today. And again, I'm not necessarily calling for that, but if energy continues to...
We have to leave it there. I'm sorry to interrupt you, Greg, but I do, for the record, want to point out that at the point at which you come back on here and say, now's the time, you like some of the big tech, blue chip, big cap companies, you like some of the cybersecurity companies and the payment companies, Visa and MasterCard. Greg Branch, thanks very much.
Durable earnings growth.
All right,
thanks,
you got
guys.
it, man. Thanks.
Meantime, GameStop reported earnings last night that disappointed nearly across the board. The numbers brought back to mind that phenomenon we saw over a year ago involving the meme stocks. Companies like GameStop, AMC, BlackBerry, costs all saw huge moves due to the rise of Reddit and Wall Street bets among a crop of young investors. Over the past 6 months, there's been a huge reversal in these names, with all of them seeing losses of 30% or more, some upwards of more like 80%. So does the bigger money no longer see value in this trade? Is there still the same level of velocity, and how has the dynamic changed? Bob Bassani is our senior markets correspondent, and Gunjan Banerjee is a CNBC contributor and markets reporter at the Wall Street Journal. Welcome to both of you. Gunjan, is this kind of the end of the era? I mean, GameStop's still higher, I think, than where it was during the meme days, right? So I guess it's not totally over.
But boy, is it different from last year. Around this time in 2021, it felt like every other day, every other week, we were staring at our screens thinking, what's driving this stock higher? And then there seemed to be a retail frenzy behind it. But this year, these stocks have been hit hard from this market turmoil, and they've significantly underperformed. And it's part of this larger trend of really speculative investments falling significantly, whether it's art or SPACs or meme stocks.
Right. I mean, Bob, when I look at all the, the memes from Wall Street bets on Instagram and all the rest of it, it's all just it's jokes about, what they would have been better off investing in. And it's been a really tough landscape. I don't know if you heard our interview with Paul Hickey last hour, though, and he talked about tech maybe regaining some of its mojo. I don't know if that would extend to the meme stocks or if the original meme crowd is still even holding them.
The investor interest is much, much lower. So she's right. We were doing 35, 40 million shares a day in GameStop January to March of last year. But then they had their earnings report, this exact same earnings report 1 year ago, and it was a disappointment. And the stock started selling off, and then by April, May, June, it was down to 4 to 10 million shares a day, and then they had another disappointing earnings report, and then it went down again. We've been trading 1 to 2 million shares a day in GameStop. It's clearly lower, and with very good reason. Look at the fundamentals don't make sense on this kind of price level at all. Look what happened to the company last night. No questions on the call again. No guidance. They're going to be losing money for several years. They had a loss in the most profitable quarter, the holiday season. On a technical basis, you look at this chart, anybody who bought this since February of last year and held is underwater. Think about that. Everyone who bought since February of last year is underwater. There's clearly less interest on a retail level on this.
Gunjan, I think of what happened last year with the meme stocks as basically a crowdsourced rally. And the crowd has now gone and left. It's left the building. And all you've then got left are the fundamentals of companies that ain't got great fundamentals in many cases.
That's right. So the Journal checked in with some of these meme stock investors from last year. And yes, you do have some traders hanging on, but one interview really stuck out to me where one meme stock trader said, look, I realized that my GameStop AMC gains, they were just luck. That was not investment savvy. And he said, I got burned on some of these trades later in the year. So you do see people kind of pulling back, and some people are saying, look, this isn't the way to trade for me, and maybe I'm better off buying and holding broader market ETFs.
Bob, that said, it did prove that crowdsourcing works. I mean, there were those of us who watched GameStop on the first day and thought, yeah, okay, this will last for a day, maybe a week. It's lasted for a year. you know, and the fact that you can have internet forums that drive, you know, real moves in these stocks, it's been a nightmare for the shorts, ironically, probably better the last 6 months, but certainly a nightmare during that period. I wonder, is there anything for the SEC to think through long term here in terms of the ramifications, or is this just the way that small investors can band together and have access to the big moves that previously you could only have access to if you were an accredited investor or maybe could get into, you know, hedge funds and private equity?
Well, there's a lot to unpack in there. So the one great insight the people who initiated this GameStop frenzy had was there's something that smells wrong when you can short more of a stock than there are shares outstanding. That does not pass the smell test. Even if there are ways it could be technically legal and okay, it doesn't pass the smell test. And people noticed that and correctly pointed out, you know, if we banded together, we could do something. I think that's a great insight. I think Gensler is very interested in looking at more disclosure around short sales that are out there. And that is something that I think realistically can come out of that. But let me just go back to something Gunjan was saying about ETFs. What I want to see here is those 20 million, 22 million Robinhood users, many of whom were involved in this GameStop. I want them to see them stay here in the market. I don't want them to throw up their hands and think, oh, this is a lot of baloney. We want those young investors in and the enthusiasm of those young investors, and we want them to stay, and we want them to be a little wiser. They're welcome here. They're welcome to stay in. They're welcome to stay in the ETF business and maybe stay a little more longer term and not do as much day trading where they can make mistakes. Welcome all of them, but don't be discouraged, and please don't walk away.
Gunjan, what's the lesson of this?
For some investors, I think the lesson is that maybe I'm better off not investing in meme stocks. But I think the lesson for professionals, I think even if GameStop and AMC are down significantly this year, you know, professionals are still tracking retail investor activity way more than they were before this frenzy. And many of them have gotten more cautious about shorting. So I think there's a lesson for retail and institutional here.
All right, Gunjan Banerjee of the Wall Street Journal, Bob Pisani, thank you very much. And coming up, more than 90% of retailers that reported earnings this quarter mentioned supply chain issues as a problem. So how bad is it? Well, anywhere from $195 to $1,000 worth of additional costs per shipment. We'll break down the numbers and tell you which retailers can withstand that margin pressure best. And speaking of higher costs, former FDIC Chair Sheila Bair says inflation will not peak this year. In fact, it's going to get worse before it gets better. She'll join us to explain why.
Retailers moving from sea to air in order to get around congestion at ports, but it's coming with a massive price. Courtney Reagan is here with more on these big charges we're seeing. Courtney?
Hi, Kelly. Well, the Russian invasion of Ukraine, subsequent higher energy prices, and new COVID cases in China are further adding time and cost to the already clogged global supply chains. Those kinks were never fully worked out. Adidas, Children's Place, American Eagle, Gap, Levi, and Under Armour are among those that have had to use more air freight than typical to circumvent congestion in ocean ports. Crocs said it's using air freight for $75 million worth of merchandise. Air cargo is often more expensive in normal times. Cost is determined by size and weight typically, where ocean is mainly size. Freight booking platform Freightos says the same shipment can cost $1,000 by air versus $195 by sea right now. The cargo rate for air to ship goods from Asia to the U.S. West Coast is 196% higher than it was a year ago. Air freight from goods from Asia to the U.S. East Coast is up 241% in a year. Air cargo rates from Shanghai to Northern Europe, those are up 34% just in March. And if you look at the numbers purely, $8.37 per kilogram now compared to $2.35 pre-pandemic. Why? Well, some carriers are grounded and others, frankly, have to take longer and more expensive routes to avoid flying through or in Russian airspace. 182 of 190 consumer companies that reported fourth quarter results called out supply chain issues. This is according to Refinitiv. And while retailers saw nearly 49% earnings growth for the fourth quarter, earnings growth is expected to fall more than 1% in aggregate in the current quarter, pointing to a slowdown in consumer spending, particularly at department stores, mall stores, apparel, and specialty retailers. So I think retailers are going to have a harder time trying to pass along these higher costs to consumers going forward. Tyler?
All right, thank you very much. Courtney Reagan, so who's best positioned to manage the persistent supply chain snarls, and will consumers really stop spending if prices continue to rise? Let's go to Jan Niffen, CEO of J. Rogers Niffen, WWE. That's not Worldwide Wrestling Federation or anything like that. Jan, welcome. Good to have you with us.
Good to be here.
You know, our next guest, or one of our next guests, Sheila Bair, is going to say that she sees inflation nowhere near its peak and not peaking until 2023. You don't really agree. I think that may put you in a bit of a minority. Explain why you don't think inflation is going to be the sort of discouraging valent that causes consumers to pull back.
Well, I'm really concerned about inflation. I lived through it last time. You know, I was there in 82, 80, 81, all those years when it was really, really tough in the business. So I'm very concerned about it. I think, though, we're about to see a peak, and I'm guessing mid-year this year. Could she be right? 2023, I don't know. But at some point in time, we're about to see a peak. In the meantime, the consumer seems very, very healthy. Everybody has a job. We're seeing actually growth in the workforce for the first time in a long time. People who get a job believe they can keep it. If they lose it, they think they can get a better job. They can make more money. They're trading up. There's a lot of good things happening with consumers. So I don't think we're going to see much resistance to price in the near term. Some point in time we will. When we do, that would be a problem. But I suspect by then inflation will start ameliorating. So it's not that I'm not concerned about it. I just think that the consumer is going to overwhelm it with their $3 trillion of extra cash that they're sitting on, and the fact that they've all got a job and look like they can have rising wages. So I believe we'll go forward and things will be fine. But yeah, I'm worried about it. I'm worried about the fact that it costs more to ship goods. But I also think that's getting better right now. We've got fewer boats on the water, not more boats on the water. I really don't think we're going to lock down for a long time in China. If we were, that'd be a problem. But I don't think that's what's going to happen. I think it's going to be better on that side than it was last year, not worse. And we handled it fine last year.
There are so many variables here, including the possibility of U.S. economic retaliation if China steps in as a major supporter of Russia in Ukraine. But let me ask you about two things that I do think concern consumers right now. One is gas prices. I mean, you fill up an SUV, which almost every American household seems to have, and you're spending at least $20 more than you did, say, a year ago. Do that a couple of times a week, a few times a month, and you're looking at serious money for the average American consumer. That's number one. And I think if you ask most Americans today, Do you feel safe about the world? Do you feel safe? They will say no.
That's my biggest concern. On the other hand, ISI just ran its consumer comfort survey, and consumer comfort is as good as it's been in a very, very long time. Why would that be? Because they have the ability to spend and they're comfortable going and doing things because they're not as afraid of COVID as they were. So we've got things going both ways. I'm watching consumer confidence very closely because I'm concerned about the consumer getting freaked out about the Ukraine, getting freaked out about inflation and gas prices. They are not showing me that that's happening so far. Will that eventually happen? Yes. But that happens when they start feeling like they can't afford to do what they want to do. And right now, what they're saying is, I can afford to do what I want to do, and I'm going to go do it, whether you like it or not.
Jen, let me ask you about your stock picks here, and you're not allowed to say Walmart, Target, Amazon, or Costco.
Well, I did say that I like Levi, I like Contour, I like Capri, I like Tapestry because I think strong brands are going to do well. And I think local people are going to do well. So I like Casey's General Store, I like Boot Barn, I like Tractor Supply. So I had all those on my list that you just said I couldn't say. But the ones I did say, I also like.
Well, we appreciate it because we hear a lot about those big winners, but there are, and we're showing the other ones as well, some really under the radar plays and the local plays as well that should benefit from the trends you're describing. Good to see you, Jan. We appreciate it.
You too. Thanks.
Jan FM. Up next, another sign of the times. FedEx earnings are highlighting a slew of problems in the global economy. They should be benefiting from all that shipping spending. Not as much. We'll dig into the numbers. Further ahead, diamonds also in a rough spot as the U.S. bans Russian imports and prices are beginning to spike for an already rare resource. We've got the details ahead on Power Lunch.
Welcome back to Power Lunch. The U.S. banning Russian diamonds along with other key products. With these in already rare supply, how are the diamond dealers preparing as we head into a key period for the business? Wedding season. Christina Partsenevelis knows a thing or two about the season right now. She's live in the Diamond District with that story.
Oh. Yeah, that's because I've been shopping around, right? But if you're in the market for a wedding ring, an engagement ring, or you just like some extra bling, you've probably set your eyes on some Russian diamonds. And that's because Russia is a huge exporter of diamonds, accounting for 1/3 of the rough diamond market. We know, like you said, the United States has imposed sanctions against Russia, so diamonds are not supposed to come to the United States. And you have several jewelers, too, that are taking a stand, starting with the parent company of Zales and K Jewelers. They said that they're suspending operations with Russian entities. And then Brilliant Earth's CEO on its conference call just earlier this week said that they are proud that they're removing Russian diamonds from their website. And if you just take a look at both of those companies in the past week, both climbing higher. If you're an investor right now or want to get in on this market because you believe demand will climb higher, I guess the easiest way is to get in on the miners. So we have Rio Tinto as a good one too, as well as Anglo American. But you need to keep in mind, this is where it gets a little bit murky. There is a loophole in the sanction. So a diamond can go from Russia all the way to India or China, get cut and polished there, and then enter the U.S. market. Listen in.
These diamonds are now labeled as made in India and not as Russia. Hence, at this point of time, Russian origin rough diamonds do not really have a direct applicable sanction that will stop them from coming into the United States.
And this, I guess, supply ruckus or the supply chain issues right now come at a time when you've got a backlog of weddings in 2022. It's expected to be the busiest wedding season in decades. And of course, you have supply issues, demand increasing, and that's pushed up the price of diamonds. Just in the month of February alone, it was up a little bit over 7.6%, or almost 8% at this point. And so we come from the Diamond District here in Manhattan. It's not just diamonds, Kelly and Tyler. You've also had prices climbing. We talked about it on air, gold, platinum. So may not be the best time to propose or buy those special blings. I don't know, I'm just saying.
Don't let price stand in the way of love. That's all I'm saying.
Well, Tyler, to that point, the reason why I decided to do this story and come up with this idea is because I'm in the market for a wedding band, and the jeweler told me to hold off with diamonds and just go for a plain gold band because diamond prices for her have gone up 30%.
I love that she didn't just say, I'll charge you 50% more, and, you know.
All right.
She's talking away a customer.
I know.
All right.
I know. Well, that shows that she cares about relationships.
All right, and congratulations.
Exactly.
There you go. We're happy for you.
Big time. Let's get to Rahel Sullivan now for a CNBC News update. Rahel?
Hi, Kelly. Hi, Tyler. And here's your news update at this hour. The United Nations says that nearly 6.5 million people have been displaced within Ukraine since the Russian invasion began. That's on top of the 3.2 million people who have fled the country. And new drone footage shows the damage to apartment buildings in Kyiv. Officials say that parts of a Russian missile fell on the homes there. President Biden and Chinese leader Xi spoke for nearly 2 hours this morning. The White House is seeking to stop China from aiding Russia's invasion of Ukraine. China says that Xi deplored the conflict without actually assigning blame to Russia. And a Chinese foreign ministry spokesman criticized the U.S. position as overbearing. The U.S. readout on the talks is expected this afternoon. The readout is expected this afternoon. And the International Energy Agency has laid out a plan to reduce global oil demand by as much as 2.7 million barrels a day. However, the proposal will likely face stiff opposition. It includes restricting personal car use in cities, lowering speed limits on highways, and reducing air travel. All, hopefully to get prices at the pump a little bit lower. Tyler?
All right. Thank you very much, Rahel. And ahead on Power Lunch, Inflation Nation. Is it here to stay? Former FDIC Chair Sheila Bair says inflation is not going to peak anytime soon. She'll explain why she feels that way next.
Yeah, plus what impact is inflation having down on Main Street? How can businesses cope and thrive? Power Lunch is back in a moment. Welcome back, everybody. 90 minutes left in the trading session, so let's get caught up across stocks, bonds, commodities, and the state of inflation in the economy these days. Let's start with stocks, which are higher again right now, a little off session highs, but the Dow's up 58, the S&P's up 26, the NASDAQ, the strong performer, up 182 or 1.3%. We're talking about the largest weekly gains here since November of 2020, up about 5%. Utilities are the biggest laggards today. Tech is leading both for the day and for the week. This is a development to watch. Salesforce, Nike, Visa, and Amex. Those are your Dow leaders today. Let's get to the bond market now, where yields are slipping after crossing some pretty key thresholds earlier this week. Rick Santelli tracking the action for us. Rick?
Yes, Kelly, you know, uncertainty covers weekends, but it also makes traders try to lower their tolerance of pain a bit, and we are seeing some of the selling action in treasuries this week moderate just a bit, but it's been a wild week. So here's a week to date of 2-year. It's up only 3 basis points on the session, up 20 on the week. Here's the 10-year. It's down 3 basis points on the session, but up 15 basis points on the week. But maybe some of the biggest action may have something to do with foreign exchange, and specifically the Bank of Japan today and energy. Bank of Japan decided, heck with all the other big central banks. We're just going to keep piling on stimulus, and we're not going to worry about it for now. Well, what happened? Look at the dollar yen. The dollar right now is at a over 6-year high, going all the way back to early 2016. And if you look at the dollar versus the offshore Chinese yuan, here's what's very interesting. Now, this chart starts at the beginning of February. You know when the dollar bottomed? The dollar bottomed against the Chinese currency the day of the invasion, and it turned up. Ponder that for a minute. And let's stick with the Chinese currency. Here's the yen versus the offshore yuan. It is at the worst level, meaning the yuan's stronger, since the end of 2015. So the yen is finding pressure in every direction. And finally, the yen versus the euro currency. That's a month-to-date chart. You could see it moving down. You might say, why? Well, one of the issues is they don't really have a lot of energy. The other issue is their central bank, but maybe the first one is even bigger. Sakhalin Island, they still have relationships with Russia on energy. Shell pulled out, but Japan didn't. They have an issue, and the market's really focusing in on it. Kelly, back to you.
Yeah, after a strong yen being a problem for so long, definitely some weakness there now. Rick, thanks. Over in the oil space, we're above $100 a barrel to close out the week, but I think we're still in the red. Pippa Stevens has the numbers. Pippa?
Kelly, that's right. Green today, but red for the week. The gains over the last 2 days, not enough to make up for the heavy losses at the start of the week, as China's lockdown spurred demand fears, outweighing supply fears. But as Russia's war stretches on, the amount of oil on the water in what Morgan Stanley calls destination unknown is rising. WTI is up 1.6% at 104.62. Brent crude at 107.73 for a gain of 1%. That is off the highs of the day, and also a second straight week of losses for both. Now, we just got the latest rig count data from Baker Hughes, and oil rigs declined for a second time in the last 3 weeks, despite surging prices. And Barclays saying today that they don't expect a jump in production, and the firm raised its targets for E&P players across the board, saying their valuations reflect oil at $61. ConocoPhillips, Devon, and EOG, Kelly among their top picks. Back to you.
Washington will not be pleased about that, Pippa. Thank you very much. Higher oil prices are just one factor contributing to the highest inflation numbers this country has seen in 40 years. The Fed is now predicting that those numbers will come down to about 4% for inflation by year end. But our next guest isn't so sure. With us now is Sheila Bair, former FDIC chair and Volcker Alliance founding director. Sheila, it's great to see you, and I don't typically think of you as an inflation hawk. So I think the fact that you are saying, look, we may not even peak until 2023, to me is quite striking. How do you see this playing out?
Well, I am very concerned. I think the Fed's being a bit optimistic about this. For one thing, home prices, which have gone up dramatically, housing prices, because of technical reasons, those numbers don't flow through into the inflation measures for some period of time. There's a significant lag. So those are not fully reflected. I don't think those will be fully reflected probably until the first quarter of 2023. But housing prices have gone up. They were up 20% last year, 10% the year before, projected to be another 8% this year. That is not yet fully reflected in the inflation numbers we're looking at. Also, energy and food. We had global supply constraints already. And with the Ukraine war, those have been severely exacerbated. Energy in particular flows through to everything: transportation costs, processing, packaging. And then, of course, the agriculture commodities themselves. The Black Sea ports are shut down. Ukraine's a significant exporter of agriculture commodities, especially in the Middle East, where we're already seeing some food insecurity, significant issues. But again, the market should correct and stimulate production elsewhere, but it takes time for the markets to react, to reallocate the acreage to increase oil and gas production in other countries. So yeah, I think we haven't even started to feel the full brunt of that, and that it's going to take some time. I think 2023 is much more likely to be when we see the peak. I think it's also important not to overestimate the effectiveness of the Fed's tools in combating inflation. A lot of it is demand driven through fiscal and monetary stimulus, but these supply constraints are very real and very difficult for the Fed through the lever of interest rates to address.
Well, you have a lot less stimulus coming into the system, a lot less dollars from the federal government and also from the quantitative easing. But what you seem to be describing, Ms. Baer, is my word, not yours necessarily, are bubbles. Bubbles in housing, bubbles in oil, food, markets, bonds, stocks. Bubbles don't usually end well.
Yeah, well, when it comes down, it could come down quickly. And monetary policy has inflated. Right, we have an everything bubble, so it's particularly acute with financial assets, stocks, and bonds. That's definitely been a factor with commodity prices, real estate prices, both commercial and residential. So yes, over time, as interest rates go up, those valuations are to correct, and that's another real danger with what the Fed is trying to do now. Remember 2004 to 2006 when the Fed was raising rates at about the same pace that they're predicting now. That finally that popped the housing bubble. By 2008, we had a real problem. Now we have an everything bubble. So I do think the Fed needs to be very careful on this. I would not be too aggressive. I would err on the side of living with a little more inflation than precipitating another financial crisis, which would bring recession and would bring a lot of hardship for a lot of people.
Yeah, I mean, the cliche is that the Fed wants to achieve a soft landing. That's what it always wants to do when things get...
Right.
But would you say the odds of that are long?
I think they're very long. Yes, they're trying to both raise rates and shrink their portfolio by rolling off some of the investments they've made. Again, we don't know the details yet, but it sounds like they're going to be pretty aggressive. I think that's very difficult to do. They did the 2017 to 2019. They were trying to do both simultaneously. We had a significant disruption in the markets in December of 2018, which brought on the Powell pivot, where he actually turned and started reducing rates. And so, which suggests to me that they're going to have a hard time holding course on this. So I'm very skeptical they can do a soft landing. And again, I don't want to have a continued inflation. It's terrible. It's eroding real wages. On the other hand, I think recession risk is much worse. So I think they should go more slowly than what they're contemplating. The risk of financial disruptions is really too great.
And Sheila, just to kind of put a point on that, since I always think of you as someone so in tune with how the financial system really works, the interplay between banks and the real economy and all the rest of it, why do you think it's more important for the Fed, to lean hawkish here, to be really hawkish here, and not err on the side of quote unquote caution for the economy?
Well, I think they should. I think they should be gradual on this. Look, I don't like these zero interest rates. I haven't liked them for years. I think the Fed is not acknowledging the bad side effects of highly aggressive monetary policy. It's created significant gaps in wealth inequality. We've had a huge buildup of leverage. Fortunately, it's not in households now. Household finances are in pretty good shape. The companies, governments have really levered up. And then we have all these asset bubbles. So yes, this is all a direct consequence of monetary policy. So over time, I desperately want the Fed to try to get back to a more normalized interest rate environment. But I think that transition is going to be very tricky. And I do think the risk of recession, I worry more in terms of Main Street impact. I worry more about a recession than I do living with inflation a little while longer. So I actually... I think they should be going more slowly than what they've suggested they're going to be doing this week.
It's a needle to thread for them. Sheila, it's been great to have you today. Thanks so much for your time.
Thank you.
Sheila Bair, and we
Happy to
should
be here.
note, Sheila has a new release in her picture book series for kids, Money Tales, out this month. This one is called Shark Scam. I should add it to our growing collection.
You should, yeah. All righty, up next, Main Street's worries, historic inflation, labor shortage, supply chain worries, all driving up Main Street. So how are businesses staying afloat in these uncertain times? We'll take a look at that. And as we head to a break, check out shares of Wingstop, the stock falling after Piper Sandler double downgrades the stock to an the dreaded double downgrade, saying the stock will fall 15% as they struggle to keep pace with peers. It's the first time an analyst has been bearish on Wingstop in more than 2 years.
Wow.
As Main Street businesses are continuing to make a comeback post-pandemic, they are facing down the triple threat of supply chain headwinds, labor constraints, and historic inflation. For some, borrowing to invest, grow, or simply stay afloat is top of mind right now. Kate Rogers here with more.
Hi, Tyler. Data from Goldman Sachs' 10,000 Small Business Voices finds that nearly 30% of owners say they're expecting to take out a line of credit or a loan for their small business this year, and about 31% say they feel very confident in their business's ability to access capital. But Black-owned small businesses reported expecting to borrow at a higher rate of 48%, with less confidence about their business's ability to gain access to that capital at 19%. Letha Pugh ran into this very issue when looking to get off the ground with her business, Bake Me Happy, back in 2013. Pugh says she was offered a loan for a specific piece of equipment, but nothing more.
There was no discussion around like working capital and things like that. And so I think that's the disconnect a lot of times, specifically for Black-owned businesses.
But Pew has worked to build up banking relationships over the years and was able to secure a PPP loan from a community bank, unlike many other owners early on. The bakery, while facing major headwinds that you mentioned earlier, like inflation, has grown its sales over 40% from 2019 levels and even just purchased a new building to open up in. Quite a turnaround from the initial start of relying on hers and her wife's savings to get that business off the ground. Back over to you.
Yeah, that's for sure. Kate, thank you so much. Our Kate Rogers. The Fed finally stepping in this week and raising rates as inflation runs wild. But are they too late to help? And what does it all mean for markets? Ron and Sana weighs in next.
A wild week for the market, but a pretty good one. Stocks adding to a huge three-day rally. Now on pace for the best week since November of 2020. Who'd have thunk? Our next guest, though, says the bull market has been over and the bear market started at the beginning of the year. Let's talk to Ron Insana, CNBC senior analyst and commentator, also a senior advisor to Schroders North America. In this sense, Ron, you agree with our first guest of the afternoon who said that the market really was sort of over-optimistic right now.
Yeah, I think, Tyler, in many ways that's true. And I would guess, at least this is just a guess at this point in time, that what we've experienced here is a bear market rally. Like corrections in a bull market are short, sharp, and scary. Rebounds in bear markets are short, sharp, and alluring. And so I think there are still quite a number of headwinds, including what you see there. What the Fed won't be able to do by raising interest rates is fix all the things that not only your first guest talked about, but Courtney Reagan talked about with respect to retail. And so I'm not quite sure that we're out of the woods entirely. I think the headwinds still outweigh the tailwinds for the moment. And I think we need to see as much time put into repairing this market as price.
We just talked to Sheila Bair, and her view is that inflation has nowhere near peaked, will peak maybe and start to abate sometime next year. I asked her whether, in the classic cliched parlance, the Fed can achieve a, quote, soft landing. She said no.
Well, it hasn't been done before. And I was talking to my colleague, Lisa Hornby at Schroders yesterday, who's on our fixed income team. And she said, when your only tool is a hammer, everything looks like a nail. And, an oft-used expression. But that's really where the Fed is right now. I mean, when you look at the structural imbalances in the economy, we're short 5.8 million homes, all these shipping costs. Things that have absolutely nothing to do with Fed policy have been causing inflation. The Ukraine war has extended everybody's outlook for inflationary pressures, which was something we didn't fully anticipate coming into 2020. So I think it's rougher sledding, and I think the Fed is right to normalize policy. I'm not sure that their policy maneuvers, however, will have the desired effect, given that much of the inflation we're experiencing now has a lot less to do with monetary policy than prior periods.
Is a soft landing so rare, though, Ron? I'm thinking about what Paul Hickey from Bespoke told us last hour, that the market's typically up after a tightening cycle begins. We know, obviously, just looking at the market's performance over time, the last 3 to 4 decades, it generally trends higher every year with a couple of exceptions. So, is it that unreasonable to think the market can digest this, especially given its bullish reaction so far to a pretty hawkish Fed?
Yeah, Kelly, it's interesting when people say that about, tightening cycles. We also, can go back to Edson Gould, who was a technician in the 1950s to the 1970s, who came up with 3 steps in a stumble, where stocks fall after the third rate hike. And I think with respect to the outlook post-tightening cycle, the Fed usually goes until something breaks, then they turn around and start easing, and the markets rip to the upside. Apparently, we're nowhere close to that. The Fed's own dot plot, if you will, suggests not just 7 hikes this year, but an additional 4 next year. If we were to see all those hikes in a row, I doubt we'd have the same outcome in this tightening cycle than in other ones. Usually the market starts to turn when it's anticipating the end of the tightening cycle, not when it starts.
All right, Ron Insana, thanks very much. Have a good weekend, sir.
You too. Thanks for having me.
You bet.
FedEx is facing a slew of issues between inflation, labor costs, and more. Should it be a warning sign to other companies as they report earnings and the season really gets into swing next month? We have more in a moment. Welcome back to Power Lunch, everybody. Shares of FedEx are almost 5% lower today. Take a look at some of these headlines that caught our attention from their earnings report last night, which sent the stock down after they missed on EPS. Some staggering numbers about costs. FedEx's fuel surcharges were over 12% versus just 5% a year ago, but their jet fuel expenses were up 66%. Ground Express up 12%. Then there's the commentary. The company saying, quote, we saw higher rates for both purchase transportation and wages. In fact, it cost them an extra $350 million in the quarter. They also said the big period of growth of e-commerce is now behind us and that the global supply-demand equation has changed a lot with the recent events. By the way, shares of FedEx, Tyler, down 16% year to date, rival UPS up 4%.
You know, you think of FedEx as one of those kind of bulwark companies but you see that they're having to be absolutely transparent and say the big period of growth in e-commerce is probably behind us. I mean, I seem to get some package every day at my house still, but yet it is not the same way as it was. I go to the mall again and so forth.
It's a fascinating flip side to what Courtney Reagan was telling us a little bit earlier on, where companies have to pay up for air, or to ship by ocean or by air, you name it. You'd think FedEx would be such a beneficiary of that, but they can't really stay ahead of this one.
Yeah, and you look at their two largest cost centers, it's got to be fuel and labor, and both are up.
Exactly.
Folks, have a great weekend. Thanks for watching Power Lunch. I had the worst bracket in America, by the way.
Closing bell starts right now.
Stocks near session highs, on track for their best week since 2020. The most important hour of trading starts now. Welcome to Closing Bell. I'm Sarah Eisen. Happy Friday. Here are your top takeaways on the biggest stories. FedEx showing that inflation can cut into growth. In the earnings report, you saw those shipping rate increases. Sales looked great as a result, up 10%. Volumes, not so much. FedEx only shipping an average 16.8 million parcels a day in the quarter, which was a decline and a disappointment. Sure, it could be partly Omicron, but also a sign that higher inflation can take a bite out of demand. What a week for ARK. A big comeback for lots of beaten down parts of the market this week. The Cathie Wood's ARK Innovation ETF up 18% on the week, still down more than 50% from the highs. So is it the start of a longer comeback? Matt Maley of Miller Tabak on the technical says the level to watch here is 65. A break above that would take it above its trend line from November when it really started falling off a cliff. Could be a good sign for the momentum on this ETF going forward if you believe the charts. And all the Fed voters are speaking out and everyone is a hawk now. Wanted to spotlight Neil Kashkari, Minneapolis Fed president, because he's famously been the most dovish at the Fed, Mr. Transitory Inflation. Well, now he's writing he got it wrong and is penciling in 7 rate hikes this year. It just shows how far and how fast the Fed has moved on this issue and how serious it is right now about fighting inflation. Let's get to our top story of the day. The market climbing the geopolitical wall of worry. Stocks pacing for their best week, as I mentioned, of the year, best since 2020. But we are heading into another weekend of uncertainty surrounding the war in Ukraine. Joining us now, Jim Paulson from Leuthal Group, CNBC senior White House correspondent Kayla Tausche. And Kayla, we are just getting some headlines here from the White House on a readout from that call between President Biden and Xi Jinping. What can you tell us?
Well, Sarah, the readout is fairly sanguine, and it comes nearly 5 hours after that call concluded earlier today, or 4 hours rather. And it says simply that the president discussed the Russian invasion of Ukraine and that President Biden laid out the implications of China's involvement in assisting Russia if it were to do so, what some of those consequences might be. Now, we still don't know exactly what those are or to what extent China plans to participate in that assistance of Russia. We know that it's something that the administration has in recent days ramped up its warnings of. But earlier today, we got a very different readout from the Chinese side where they touted essentially the assurances that they received from the U.S. side that the U.S. did not seek conflict with China, did not seek a Cold War, that it would not push for Taiwan's independence, and really issuing sort of a full-throated statement even before the call had concluded, according to the White House, about all of the things that President Xi had secured from President Biden. Now, how heavy-handed President Biden was in that call, we simply don't know. And what happens from here, we also don't know. We're expecting to hear from senior administration officials later today a little bit more detail on the call, and I'll bring you those details when I have them, Sarah. But certainly a tale of two very different versions of this conversation at a very important moment in history, Sarah.
Jim, so much we still don't know. As Kayla mentioned, between the
the Chinese, whether they're actually helping the Russians, what secondary sanctions could look like. They've been threatened. And of course, what happens with this war? And yet, stocks had a really good week and continue to rise despite some crazy moves in commodities like what we saw with nickel today. So is the market just hoping or sniffing out some sort of resolution or looking past it or what?
I think that they are sniffing out a resolution. I mean, we've been in this war now for several weeks, Sarah, and the worst thing about any crisis or anything that's new is that when it first hits out of left field, it just creates nothing but uncertainty. You have no idea what it means or where it's going to go, and you react very violently as an investor to get out of the way, and things move around. But after you've had some time to vet it, I think that the market is suggesting that they're starting to feel a little better, that there's some direction of this thing. Even if the direction is a chronic war that goes on, it does seem like the economic fallout will not be near as detrimental as it may be looked at going in. And I think they're calming down about that. More to the point, though, it does seem in recent days that there's more openness to negotiation and maybe finding another way out beyond just final victory, if you will, for both sides. So I think the market is starting to discount it a little bit. And the biggest thing is just that the energy prices, crude oil prices, pulling way back to under 100 here just earlier this week, and 104 right now. And if you look at that, the energy prices I think are up maybe 20% now since October, and that they had a 20% upward move a year ago at this time. So I don't think it's going to have as much economic fallout as maybe we anticipated initially, although it certainly could take a bad turn. This is more, I think, about world order going forward. Where's Russia going to be in that, and what's going to happen with our relationship to China?
On that note, Michael O'Hanlon also joins the conversation from Brookings Institution. Perfect question for you. How is the world order being redrafted, and what do investors need to know about what that looks like in the economic alliances that we are seeing forming?
Well, thank you. I think there are two fundamental possibilities, and it's too soon to have any real sense about which one we're headed towards. One is a hardening of what was already happening, but perhaps one that could be recovered from, where certainly the Russian attack on Ukraine will be the big news of 2022 in my world of defense policy, but it may or may not still have to be the overriding big news for the rest of international relations and the global economy. That's the happy scenario. That presumes some kind of a ceasefire, let's say by no later than the month of April, with a restoration of Ukrainian sovereignty, but perhaps some kind of an agreement that it won't seek NATO membership. Russia gets to have some of the sanctions lifted. Businesses gradually trickle back towards Russia, although the economy there suffers for a while. That's the good, happy scenario. Nobody's going to ever think the same of Vladimir Putin again after this war, regardless. But you could imagine still Russia as an economy regaining some of its previous role. And over time, perhaps, may take a few years, really getting back to where it was. The less happy scenario, of course, is an ongoing war, where Vladimir Putin decides he wants to conquer Ukraine, perhaps annex Ukraine, perhaps overthrow the Zelensky government, maybe even raise Ukrainian cities writ large en route to doing that. If and when he gains control, moving his own military forces into Ukraine permanently, not only to try to control that country against whatever resistance may continue, but to pose a greater threat to NATO's eastern flank. And in that case, you have really the possibility of a new Cold War if we are successful. And if we are unsuccessful, some small chance of actual conflict between NATO and Russia. So obviously that second scenario is far worse than the first and has much greater implications for the economy as well.
Investors need to weigh all of it. Jim, Kayla, Michael, thank you for joining me on a Friday. The wild swings in metals have certainly grabbed headlines since the start of the war in Ukraine, with another giant move today for the price of nickel. Up next, we'll talk to the CEO of mining company Cleveland Cliffs about how the crisis is impacting his steel business. Steel prices have also shot up. Dow's up about 90 points. We are near session highs. Closing bell. We'll be right back. It has been a wild few weeks for the commodities markets in light of the war in Ukraine. Take nickel, trading limit down again today on the London Exchange after more than doubling earlier this month. Steel prices are up more than 50% since late February. But check out the chart of miner Cleveland-Cliffs, the company managing the current environment well, and the stock is up 40% in the past month. Let's bring in Cleveland-Cliffs CEO Lorenzo Gonsalves. Lorenzo, it's great to have you back on the show. Talk to us about why you think you're in better shape than some of your competitors when it comes to sourcing some of these key metals in steel production.
Yeah, good afternoon, Sarah. Pleasure to be with you in your new show. Congrats on that. As a steel company, and a steel company that is self-sufficient in mining, we are very pleased with the fact that we don't depend on importing nickel and importing anything. We don't import nickel, we don't import iron ore from Ukraine, let alone pig iron. We don't depend on pig iron from Russia. So we are self-sufficient. I have been preparing this company as a basis of American manufacturing, and deglobalization is coming, and we're ready. So it's all good here.
Are you the only one in the industry that doesn't depend on pig iron, which I've read a lot about in preparation for this interview, and realize it is key in making steel, and apparently most of your competitors use?
Yeah, everybody that produces flat-rolled steel needs pig iron. The difference is that as an integrated company relying on blast furnaces and basic oxygen furnaces, and also with the direct reduction plant, the most modern in the world here in Toledo, Ohio, we are self-sufficient. So my competition needs pig iron, but they don't produce pig iron. They need to import pig iron. And a lot of this pig iron comes from, guess what? From Russia and from Ukraine. Ukraine, unfortunately, is being beaten down, and that's a very sad situation. Russia is the perpetrator, should not be allowed to sell a thing in the United States. So we are in a good shape because we are self-sufficient, made in USA.
But one part of your business that is vulnerable and separates you is you are a big supplier to the auto industry. And when it comes to autos right now, they're struggling to meet demand. They're looking for parts. First it was the chips, now it's the key metals from Russia, Ukraine, and even the Japanese earthquake. So what are you expecting in terms of auto demand for your steel?
Yeah, we are seeing an improvement in comparison with last year. The biggest thing with automotive is that we are by far the largest supplier of automotive here in the United States. So these things don't go in sync with all the car manufacturers all at the same time. So when car manufacturer one is not doing well, car manufacturer two is getting microchips. We are the biggest supplier of both of them. And then number three comes along. We are also the biggest supplier of that one. So we are being able to play around. Another thing is that I have some maintenance scheduled for first and second quarter of this year. And when I saw the Russian movement around the borders of Ukraine, we anticipated maintenance to Q4. We shut down units last quarter, and now we are hitting in all cylinders in Q1, and there will be the same thing in Q2. So Q1 is doing well, and Q2 will be even better.
So talk to me, Lorenzo, about where prices are going. Obviously, you've got pricing power right now, and you have to pass on those higher costs. But is the demand keeping up enough for you to continue to raise prices?
Oh, yeah, absolutely. Absolutely. Keep in mind, the American steel market is among all the developed markets in the entire world, the only one that produces less than we need. So we all need imports here in the United States. Imports will always be part of the picture. So in a world that's not really able to trade steel for supply chain issues, for the war in Ukraine, for congestion imports, we are in a situation that the domestic suppliers like Cleveland-Cliffs, being by far the largest supplier of flat rolled in the United States, is in a very comfortable position. And we are playing the game the way it should be played.
Lorenzo Gonsalves, thank you for joining us with the update. Appreciate it.
Thank you very much, and good luck with the new gig.
Thank you. Cleveland-Cliffs CEO. To give you a check on the markets here, we are going strong. This has been a pattern 4 days in a row here and tracking for the best week since November 2020. The Dow up 129, another little surge here. S&P 500 up almost 1%. The NASDAQ, the winner on the week, it has the most catching up to do, up almost 2%. Small caps up about 0.75%. Coming up is the classic 60-40 portfolio in for a rough road ahead. Mike Santoli checking the charts in his dashboard next. And later, Senator Elizabeth Warren announcing a new bill to crack down on using crypto to avoid Russian sanctions. We'll discuss with today's closer, FTX founder Sam Bankman-Fried. We'll be right back. Got almost a 1% gain here for the S&P 500. Tech and consumer leading us higher. Goldman Sachs out with a note today saying stagflation is increasing the risk of a, quote, lost decade for traditional 60-40 portfolios. Mike Santoli here taking a look at the potential shift for the dashboard today. There has been a lot of chatter about how this is not working.
Yes, and in fact, there has been chatter for years, but it has really worked up until now. Of course, it's 60% equities, 40% stocks, kind of a traditional retirement portfolio mix. Here's year to date. This Vanguard Balance Fund approximates the 60-40 strategy, down almost 7% year to date. That's an unusual number. Typically, you don't get these 5% multi-month drawdowns in this area. And of course, that's because bonds are down 5 and stocks are down 6.5 or 7. You're not getting any buffer from stocks. So the idea is if inflation stays high, bonds are going to be hard to perform even in stock drawdowns. And obviously, equities start with a high valuation. So that's the argument.
So what do you do?
So far, here's the question. There are pockets of the market where there's sort of high cash flow or real assets seem to be the two things. So some people say add commodities, but take a look at a couple of ETFs. This is the cows and the moo. So the cows is a cash cows
just like
portfolio. High free cash flow. stocks, okay? It's a lot of energy in there. It's a lot of healthcare in there, but it's basically a bird in the hand type of investment strategy. You're getting the cash today. You don't have to worry about the future. It's not about paper wealth. It's about what you have right now. Plus, the moo is agribusiness. So we know agricultural commodities doing well. These are stocks geared to it. So it so happens they're moving right in sync here, and they're outperforming the S&P by like 14 percentage points.
Stick with the cows.
Stick with the cows, or
with the herd.
Yes, at least ride with the herd to a degree. Maybe add that to your 60-40.
Did you just that's just random that they both have those?
Listen,
and you came up with them
what's
and
the
they
point
both
of having hundreds of tickers in my head if once in a while I can't throw one of these relationships up there?
This is classic Santoli. Thank you, Mike. Up next, the CEO of cryptocurrency exchange FTX reacts to a new bill that would punish crypto companies doing business with sanctioned Russian entities. We'll talk to him next. Session highs for the Dow, S&P, and NASDAQ, which is outperforming again today. What's Wall Street buzzing about today? Burger King wants to close its roughly 800 restaurants in Russia, but it can't. Parent company Restaurant Brands owns only 15% of its stake in a Burger King joint venture in Russia, which operates these locations. The rest is a group of investors led by Alexander Kolobov, a Russian businessman.
The company's international president, David Shear, wrote in an open letter to employees that they demanded the suspension of Burger King operations and were refused. He said they're in the process of divesting from the venture, but it will take time, and it suspended new investments and is redirecting profits to refugee charities. It's not alone. Competitor Yum Brands keeping KFCs open in Russia because the franchises are Russian-owned. It does show how some companies, especially in fast food, are tied to Russia through all sorts of complex, decades-old legal deals and ownership structures, and they're trying, in the meantime, to manage their corporate reputations and make statements. When we come back, stocks looking at a solid 1% gain in the S&P right now. Only sectors lower, utilities and energy, though crude oil is higher on the day, lower on the week. Nasdaq's in the lead. We're building on gains. We're up 2% going into the close. Coming up, crypto billionaire and FTX founder Sam Bankman-Fried on a new bill from Elizabeth Warren, the senator, to crack down on using crypto to skirt Russian sanctions. And later, we will discuss whether there's still time to take a bite out of FANG stocks, which have had a very solid performance this week. We'll be right back. Another strong final hour of trading here. Just want to mention the Nasdaq's up 1.9%, almost 2% gain, and up 8% for the week as a whole. Still got a long way to go to climb back, but it has been a recovery. Senator Elizabeth Warren announcing a new bill that would allow the government to crack down on crypto companies that are conducting business with sanctioned Russian entities, tweeting, quote, "We can't allow Putin and his cronies to hide their wealth and evade sanctions using cryptocurrency." Joining us now, FTX CEO Sam Bankman-Fried runs a big international crypto exchange. Sam, first of all, how easy is it for these Russian oligarchs to use crypto to hide their wealth and evade sanctions?
It's a really good question, and the answer today is that it's very difficult to do so. There are a very large number of checks in place to prevent that, everything from their bank to the bank that they would be wiring money to, that the exchange would be using, doing sanctions checks to the exchanges themselves, doing know your customer processes, and sanctions checks on the banks involved and the people involved, doing sanctions checks on the tokens involved and on any transfers going out as well. There are a lot of processes in place to prevent this from happening, and I think they've been fairly effective at preventing it, although it is only because these processes are in place that it is difficult. A number of years ago, this was a much bigger problem for the space.
Well, and I was wondering because a UN report has said that North Korea, for instance, used stolen cryptocurrency to help fund a missile program, and that Iran mined Bitcoin to help try to evade sanctions. So there is a history here of bad behavior and hiding behind crypto.
Yeah, I think if you rewind to 2017, 2018, the space was a lot weaker in terms of compliance in general and specifically in terms of sanctions checks. This is true basically across the board, and there were also some specific venues that were particularly exploited for this manner. Over the last 4 years, partially because of the work of law enforcement, partially because of the work of regulators, policymakers, and partially because of the work of the industry, a lot of that has gotten cleaned up.
So what about this new bill from Senator Elizabeth Warren? Do you think it is effective in trying to find any of that? And can you trace that? It puts it on the Treasury Secretary to find some instances of Russian oligarchs, for instance, getting around sanctions through crypto.
So, I mean, I'll say, we've been coordinating with all of the relevant sort of enforcement agencies, including people from Treasury on our policies around this. And, I think in general, they've been extremely constructive. I think we've been able to effectively prevent it. We've been able to trace a number of tokens, related to financial crimes and consistently, stop them from being able to cash out, including some of the more high profile ones. So, I think that it is an effective process, although it does take a lot of work, and it's really important that the industry does keep that up and keeps up that cooperation with law enforcement on this so that does remain the case.
Well, and I know your industry has found new lobbying power. You've been a big backer of Democratic politicians, President Joe Biden. Have you backed Senator Elizabeth Warren? And why do you go to Democrats typically? Are they friendlier toward Bitcoin regulation?
So I've given to both parties, and I think there's sort of the high-profile donation to Biden, in the presidential election, but more recently I have given to both sides of the aisle, and some of these are just good governance type donations, looking from both parties at people who just unrelated to crypto, I think will help lead our country in a constructive direction. I think we've also found an increasingly bipartisan approach to cryptocurrencies themselves. I think that wasn't so much the case a year ago. I think there's more of a partisan split, back in 2020 and 2021. But I think both parties have been, in general, pretty constructive on it. And I think that's been reflected in what you see with the executive order. I think it's been reflected in the chatter that you see coming out of Congress, in some of the bills around stablecoin regulation that you see being drafted, all of which I think would help move the space forward. They'd help bring more of the activity back onshore, creating a licensing pathway, while also giving more regulatory oversight and customer protection to the agencies.
What about Senator Warren in particular? Have you given to her?
I don't know that I have. I could look up exactly who I have, and I can't tell you for sure off the top of my head.
Yeah, we couldn't find it either. I was looking.
Yeah, it's she's extremely sharp and extremely well informed on a number of things. I think a lot of the points that she brings up are pretty valid. Around there needs to be a conversation around sanctions, and there needs to be strong enforcement on that. I think, as it turns out, this is something that has happened sort of over the last years with the industry. And I think would love to talk with her about that and about what is in place today and what she would like to see in place that isn't there today. But I do think it's a super important point to bring up.
No, I know you've welcomed the regulation, Sam. Want to ask you about how Bitcoin has performed. It hasn't done a whole lot. The Fed did raise interest rates for the first time since 2018, signaled more on the way. It's acted a little more like a high-tech stock. than it has as an inflation hedge or a hedge against geopolitical uncertainty or even around what's going on with Russia. Are you disappointed in that?
So I think there's a few things going on there. One, I mean, you saw right when, when sort of the war broke out, that Bitcoin got hit along with stocks. And, it sort of was very much acting as a tech stock, which it has, frankly, over the last few years, because, this has been a market where, sort of monetary policy has been driving moves. And that had similar impact on both crypto and on stocks. So that's been a piece of this. However, after it sort of started getting hit, on the beginning of this, it's actually substantially outperformed a number of tech stocks, over the latter, month or so, because I think that fundamentally it has reacted differently to the Ukraine crisis than tech stocks have, acting as more of an international hedge. I think there's sort of confusing factors going both ways forward, which have led to it not losing value net during this, although there was sort of a temporary drop. I also think that, when you look at sort of the, inflation numbers that are coming out, those are just reflections of things that have been true for a while. And so I think that was sort of already reflected in Bitcoin's, price appreciation over the last year or two, even if it took a while to trickle through to CPI.
Well, CPI has gotten worse. And Sam, just for transparency, so are you doing business in Russia? Because some of your competitors, like a Coinbase, have said that they will continue to serve the Russian people. They're not going to pull out like a lot of the other Western countries. So what do you do about that?
So, before there even were any formal sanctions, we cut off all contact with all Russian banks and financial institutions. We do not do any payment transfers in or out of Russia anymore. And as sanctions came out, obviously some of the banks were hit with those. But we don't service transfers from any Russian banks, whether or not they're sanctioned. Because we don't want to be in a position where there's some transfer that started from a bank that was sanctioned, went through a bank that wasn't, and ultimately ended up, on our platform. So we proactively took that step there. We obviously also, don't allow any sanctioned parties or institutions or countries to access the platform, and we do know your customer checks and sanction checks, on all of the assets and people who use the platform.
Got it. Sam Bankman-Fried, thank you for joining us. CEO of
Thank
FTX.
you.
Moderna has been on an absolute tear this week. Now it's seeking approval from the FDA for a second booster shot for adults. Top analyst weighs in when we take you inside the market zone. And remember, you can listen to Closing Bell on the go by following the Closing Bell podcast on your favorite podcast app. Dow is up 190, CRM, Salesforce, adding the most to the Dow right now. We'll be right back. 18 minutes left of trading. Session highs. We are now in the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Needham's Laura Martin here on the recent FANG stock rally. Boy, what a comeback. Jefferies' Michael Yee on the big week for vaccine stocks as well. Welcome, everybody. It has been a strong week for stocks. The Dow, S&P, and NASDAQ are all on track for their best weekly performances since back in November 2020. And Mike, we wiped out a 200-point loss earlier today. It looked like the rally was going to take a pause. It has not. And this final hour in particular, it's been a pattern of very strong performance into the close. What does that tell you?
It's a sign, certainly, of a market where people were under-positioned for a good rally. And essentially, after a 12% 10-week decline in the S&P 500, very depressed positioning and sentiment, I think there was we need to get back in. There's also a few tests that I think the market has been in the process of passing this week. One, Fed rate hike clearly seems like it was priced in over the course of 4 months as investors braced for an aggressive tightening cycle. At least right now, that seems to be the case. You had some bond deals pulled. You had all these excuses for the market to make further lows, and it didn't do that. All that being said, we've rushed right back up to these levels. A lot of these systematic traders that I follow, people who follow these rules about tactical positioning, will say, well, this is now where you sell the market after, on an expiration day, we blew through some of those obvious levels where all of a sudden the hedgers had to chase the market higher a little bit.
Growth stocks have certainly made a comeback this week, despite the Fed hiking interest rates. The beaten down FANG stocks were no exception, all up significantly, led by Meta, which is up nearly 15% for the week. Let's bring in Needham's senior internet and media analyst, Laura Martin. Laura, would you be telling your clients to build positions here after some of these mega cap growth stocks got beaten up so hard?
So the answer is I would pay attention to the fact that the divergence in the FANGs is getting more extreme. So over the last week, you saw Alphabet down 6%, Netflix up 13%, and over the last month, you had stocks with a 10% range. So I think Meta's catching up a little bit. I would not be a buyer of Meta here. But I do like the idea of Amazon because and I'd be cautious about Apple also because of the China risk, because of what's going on in the Ukraine with Russia.
You didn't mention Netflix. You've never liked Netflix. I know it's been one of your big misses over the years, but you've continued to do some new research and have looked at this idea that people are more focused on the news right now, given the war in Ukraine, than entertainment. Do you see that as a lasting phenomenon and issue for Netflix?
I do. I think Netflix, I think we're in the 7th inning of the streaming wars. It's clear you just read my most recent piece. And Netflix is losing. It's losing to competitors with bundles. It's losing to competitors with cheaper price ad light tiers. And it's not doing anything innovative. It created a business 12 years ago. They deserve kudos for that. And it has done nothing innovative since. So I think it's losing the streaming wars. We're back to the price where we downgraded in the 4th quarter of 19. I would call that an okay call, even though I missed a couple of years during COVID of awesome Netflix results.
They're still the first mover. They're still the dominant player. And they've still got a lot of international growth. And these are the arguments the bulls use. I'm sure you've heard them.
I have. I just think they need to be more reactive to their competition because now we're in maturity. Now it's about targeting audiences and it's not just about having better entertainment content. You need sports and you need news and you need a cheaper tier that's $5, not the premium price point of $17, which is where Netflix is.
Mike, what happened this week to the mantra that the Fed is raising interest rates, they're going to keep hiking to fight inflation, and that makes long-duration risk assets like tech stocks vulnerable? It totally flipped this week after we got that message from the Fed. It just was priced in?
Well, first of all, if you buy into that being the key driver, and I haven't really bought it, and I think that's an element of what's going on, what most matters is longer-term rates. If you're talking about duration, then you look at the longer-term yields. They have not been really where the upside has been this week. You have the 10-year kind of stalled out just above 2, and, it's in a manageable range. And when you have the overall NASDAQ 100 losing 20% of its value in 2.5 months, then you're talking about things matter a lot more than a few basis points on the 10-year yield. And arguably, it's sort of a mean reversion relative value trade just to get back into some of those big index stocks as opposed to really trading tick for tick with bonds.
NASDAQ Composite up 2%, 8% for the week. Laura Martin. Laura, thank you. Moderna shares also having a very strong week and building on those gains right now, up more than 25% as COVID cases and lockdowns climb in Hong Kong and in China. The company also asking for approval for a second booster for adults. Joining us is Jefferies equity analyst Michael Yee. You've always been skeptical on this name, Moderna, and this idea that it's sort of a one-hit wonder when it comes to the COVID vaccine. Have you changed the view at all, given some of the momentum that we've seen in the stock and the optimism around potentially vaccinated China?
Hey, it's great to be here, and it's a great question. Good to see you, Sarah. Look, I think you're absolutely right. We've watched this go from 450, 350, 250, 150, and we see a little bit of a bounce here. You know, I think the key here is we're going to have these little spurts of concerns about another wave. China, Hong Kong, et cetera. A stock down 70% off the high is going to have some moves like that. But I'm going to continue to say, at least in the near to medium term, that Wall Street and biotech investors are still really skittish to come back to a COVID name. And I would think you might agree that the street seems to be moving beyond COVID, and we're going to have to start getting used to it.
But is that the right call? Already we're tracking this new variant, BA2. Yeah. What we hear from the medical experts is that this is going to be with us now, certainly in the winter time, and that you know we might have to get boosted. And so this could be a very long recurring revenue stream, could it not?
I think we might get a boost here. Again, it's down 30% year to date. It doesn't surprise me that we're going to have some bumps up, some little rallies here as people, I think, as Mike Santoli said, we're offsides on some of these positions. I think you saw some short covering. I think you have people jumping in to buy a stock down 30% year to date, 70% off the highs. And I do think we are going to have a fall boosting season. I do predict there will be people boosting. I think what people are still worried about is 23 and 24. And quite honestly, I think structurally, Sarah, people want to see something beyond the COVID vaccine. I think we'll get that stuff. I just think it's going to take time to play that out. And so I think the right call here is it's going to be range bound.
What do you like better, Michael? Because biotech actually has had a pretty good week. And a lot of the biotech analysts have waited for this for a long time.
Well, it has been extremely tough for biotech over the last 12 months. And I expect it will continue to be a tough year this year. I think a lot of the structural problems in the group are about too many IPOs, too many bad negative news, too many challenging things, and certainly Moderna going down is not helping. We do like Vertex. I think that is the call. It's actually been a good performer year to date. We added that to the franchise picks list back in December. They have one of the few companies with a multitude of positive events that read out. Huge number this year for cystic fibrosis business. I think they'll raise guidance. And I think that's a stock you continue to want to own in a challenging environment and a good chart and a recovery stock on that one. So we like Vertex.
Michael Yee, thank you for joining us. Vertex down a little bit today, but outperforming, as he noted. E-commerce stocks, check these out. They've been big winners this week as well. The online retail ETF up 16% since Monday, actually tracking for its best week since April 2020, helped in part by Chinese internet stocks like JD.com, which have seen big rallies this week as China stepped in with support. Jefferies initiating on some of these internet retailers, naming Rent the Runway, The RealReal, and ThreadUp with buy ratings. The firm conducting a survey finding that most respondents continue to shop for apparel online more than in person, and that there's growing interest in secondhand and rental offerings. That has been the story for a while, Mike. And it's not like people beat up on the fundamentals of these businesses, just the environment changed so much where a lot of these names, which aren't quite profitable yet and are newly listed public companies, have not done well. Has anything really changed?
Well, no, but I think the side of that is there was a lot of excitement out of the gate for these businesses, and therefore the stocks got inflated, like a lot of other e-commerce and software companies. The chart of that online ETF, the one-year chart, it looks exactly like the cloud ETF. It looks exactly like ARK, which basically means it's been cut in half and has now had a furious rally back up to that sort of line that defines its longer-term trend. So I think that is the issue. It is macro. It is investor appetites for this stuff. Rent, I still think there's questions about, the scalability and the business model there. But other online thrift stores, so to speak, or exchanges, it seems to make a lot of sense. I guess I would call it secondhand experience here. My teenage daughters seem to shop exclusively. Depop is a big one, which is privately held. But in other words, it's still the mode right now is kind of, the status comes in finding, a great undiscovered piece of clothing as opposed to a label.
They would be so proud that you cited them as a stock indicator
They
for
would
what
cringe,
is cool in
basically,
retail.
but yeah.
By the way, it's not just the new IPOs. Etsy is up 22% this week. The
If
major
those-
averages
some
on
of those
track for their
processors,
best weekly performance since November
a
2020,
few
led
months,
by
even a
consumer
quarter late.
discretionary and
But
technology stocks. Let's bring in
nevertheless,
Charlie
if this
Babrinskoy,
supply
Ariel
chain
Investments,
situation, though,
head
if
of
it
investment
persists
group. Charlie,
for quarters,
great to have
right,
you back on.
then
Do
I
you
think you
trust
are-
what we've seen this week as a longer, sustainable move higher for the markets, or is it just a bounce?
So, we're long-term investors. Ariel's motto is slow and steady wins the race, so we're not going to pay a lot of attention to 1 week. But we do think the market was oversold. People were very pessimistic. I'm sure you've seen some of the polls showing some of the highest pessimism among investors in the last 10 years. And we do think that was overdone. Look, a major war in Europe is the kind of thing that should produce a little bit of caution. But fundamentally, we think the 4 factors that we talked to you about are still very much in place, one of which is a very strong economy, one of which is very attractive value stocks. And so those things haven't changed.
We've always asked you for your favorite stock picks. And back in December, you mentioned Apache. That has been a very good call. Charlie, are you sticking with it after a big move higher?
Absolutely. Not only did I mention it, I called it out as my favorite. And it was, I think, 23 the day you asked me, and I think it's in the high 30s today. But
Not
it's
that
just
you're keeping track.
fundamentally, it was trading at about 7 times earnings then. And even with this explosion higher in the price, it's still only trading at about 7 times. Why? Because the earnings expectations have gone up so much. I mean, the market is acting as if these commodity names are having a once-in-a-lifetime opportunity and it's going to go away. And I don't believe that. I think it's going to be very hard for the world to produce the kind of oil and natural gas, it's both, that this company produces. And you're getting a free option on their findings off the coast of South America. They have had some very nice indications of some extremely large possible wells down in South America that could turn this into even more of a home run. So I still absolutely like Apache at these levels.
Energy and utilities are underperforming today. Charlie, you've also liked the fertilizers, which have done quite well as Russia is a producer. It's banned the exports, and now we've got a shortage, along with a lot of other key commodities. Do you see this as a longer-term issue for stocks like this? And would you be adding to positions? I think you have Mosaic and others.
Yeah, Mosaic is my second largest position behind Apache, and absolutely the long-term outlook here is very good. As the world economy, as people eat more meat, which they do when economies get stronger, chickens and hogs and cattle all consume a lot more agricultural products in terms of calories than if you just have those calories straight from the field. And so there's going to be more need, more demand for agricultural products. Fertilizers are very effective means of increasing those yields. And Mosaic has extremely well-positioned mines outside of the turbulent Middle East, very close to the North American and Brazilian activity.
I mean, you're clearly still, Charlie, sticking with the invest around inflation as a key theme and pick companies that have pricing power in this environment and are going to be scarce. But the Fed has started raising rates, and they've totally changed their tune when it comes to the fight on inflation. They've come around to the Charlie Babrinskoy point of view that it is a problem and that they are going to have to be aggressive when it comes to fighting it. So does that make stocks like this that tend to do well in inflationary environments not as appealing because you are fighting the Fed?
It's nice of you to put it that way. I wouldn't say they've come all the way around to my point of view. That still, as of last month, they were still pumping $30 billion into the market with quantitative easing. Now they finally stopped throwing gas onto the fire. They're nowhere near where they need to be in terms of interest rates. The Fed funds rate should be 2%, not 25 to 50 basis points. So they've got a long way to go until you get to my level of concern about inflation. I still think in their heads, they think this is temporary.
Mike, I'm just looking at the market here. We're holding the highs here going into the close on a Friday. Consumer discretionary technology lead. NVIDIA is popping. We've got 2 new additional highs here in the S&P, Dollar Tree and Quanta Services, along with a few other highs, sort of spanning all sorts of industrials to farm equipment like Deere trading at all-time highs. Chubb, the insurance company. Which groups, Mike, would you be watching that will signal that this kind of rally will continue? Is it the ones that have been beaten down the most?
Yeah, I mean, I think that's one element that you have to keep in mind on just in order to gauge whether most of what we're seeing here is just kind of a catch-up and just kind of things that were beaten down too much that have been picked up right now. I do think it's worth keeping in mind the S&P 500 right now in 4 days has essentially regained half of what was lost in total from January 3rd through Monday in terms of up to high to low, about a 12% move. And that sort of tells you that, we're at a point where it looks like it's real. We have multiple 1% days to the upside in a row. That's not to be dismissed, but it doesn't mean that it's going to be a V back to the highs. And so some of those areas that might be charged with being just a bounce, you might want to look at that to see if it's going to be a durable move or not.
10 seconds, Charlie. Have you added any new positions that we should know about so we can track them?
We're buying more and more Madison Square Garden entertainment. In an inflationary environment, great real estate like Madison Square Garden becomes even more valuable. We've been buying that.
All right. It has been an underperformer. Charlie Babrinskoy, thank you for joining us as always. Just under 2 minutes to go here in the trading day. Mike, what do you see in the internals?
Yeah, it's pretty strong under the hood, Sarah. Started off kind of mixed, but if you look at the volume split for the New York Stock Exchange, it really powered higher. Now we're looking at almost a 3-to-1 advancing to declining volumes. Of course, overall volumes elevated by that triple witching. Index rebalancing also going on alongside that. High beta stocks, more aggressive, jumpier, more volatile stocks have started to outperform. Take a look year to date. The high beta S&P ETF against the low volatility one. Of course, low volatility had some time in the sun, and now you have high beta slightly edging it out right now. The volatility index continues its decline. 24 now, so it shows you that this is an indication we have more stability in the market. We had a clenching up of anxiety. It's now released. Those spikes generally are positive, though. You want to see it really stretch down toward 20 to say that there might be more of a chance, Sarah, of it being an all clear.
We've got triple witching as well, expiration of options and index fund options, increasing potential volatility here. As we go into the close, though, we are holding near the best levels of the session. It's been a pattern we have seen for the last few sessions. The Dow up about 250 points right now, 0.75%. Salesforce is the biggest contributor. Visa, Microsoft also going strong right now. The S&P 500 good for a gain of about 1.17%, adding to its gains for the week. It has been a strong week. In fact, the best week of the year. Consumer discretionary and technology lead. That's pretty much been the story. A lot of the beaten down names getting some love.
Yeah, that's been one to watch post-earnings. The early earnings winner here that kind of started really this bullish momentum. I think it kind of began
Overtime. I am Scott Wapping. You just heard the bells. We are just getting started. In just a few minutes, we'll speak exclusively to legendary investor Jim Chanos.
Alex and JB, welcome, guys. All right, Block is the company that I thought curiously kind of put some early injection of bullish appetite into this market when they reported late February, gapped up, rallied. They sold back off, but never made that new low. And then today we see it's one of the first growth companies to break to the upside. And when I talk block, of course, I think blockchain and crypto, which means, JP, I'm watching Bitcoin too, because it seems if we can get Bitcoin to do something meaningful on its chart, then we've got the final all clear for bulls to just spend their weekend drawing up what they want to buy on Monday. What do you think?
Yeah, I mean, look, it's been interesting. I just actually came back from a conference, and the conference was talking almost exclusively about digital assets and the growth and the expansion, and the fact that people maybe are kind of combining the price of Bitcoin with what's happening in the rest of that ecosystem. And look, I think a lot of people have been saying, well, is it going to keep going down? Where is its use case? And I think, unfortunately, they're tying too much this Ukrainian-Russia conflict with cryptocurrencies. But what we've seen is the sell-off that's occurred in these companies has now started to accept back some rallies back to it. You're seeing a little bit of strength. The companies are the ones that are pushing through, the ones that are utilizing the ecosystem in a more significant way. And I think now people are looking at some of these companies and saying maybe they got a little oversold, and now we need to start thinking back to them as maybe this is an opportunity to buy. I think that is one of the reasons you're seeing kind of a lift in some of these, such as Block, who's kind of gotten a nice rally or pop into it after kind of getting hit really hard over the last few weeks.
All right. Nice move in a lot of these companies today. Just like you snap your fingers and suddenly everything is back on. That's what we've come to learn and expect from tech companies like NVIDIA, that can just churn out a 7% rally ahead of the event next week. Square up 10% as we've been talking here. PayPal too. I do like that story Caroline brought us about their extension of services in Ukraine, but also just fitting in the broader theme of today, cloud companies trying to break out. I mean, Alex, this is like a bear's worst nightmare at this point. Or is this the famed, infamous bear market rally we heard so much about? We ticked to a bear market on Monday, and then this started. So does it count? I'm grasping at straws here. Which one do we go with? The tick down for the bear market on Monday, or we just forget Monday happened and says, we cleared through it and now we're up, biggest week since November?
Well, I think the jury's still out ultimately on what will happen, but I'm going to shamelessly plug Your First Trade, which is coming up after this, and I'm hosting it today.
You're hosting it, right.
And on the wrap, I'm going to give you a little bit of a preview. My two movers on the stocks are DocuSign and FedEx, and because they paint a very different picture. One is, I believe, if not the strongest performer in the NASDAQ 100, it was in the top 3 before the show, and that's DocuSign. I know this is one that JB is fond of as well. But to his point of a name,
is that real or sarcasm?
No, this is just one that I know has been under a tremendous amount of under tremendous pressure and is making a tremendous bounce. But you could sort of tie it in. You have an insider buying in terms of CEO that scooped up some shares earlier this week. But when you look at the names that are leading today, Oliver, are these the companies that we can rely on? I'm going to set NVIDIA off to the side. It is a powerhouse company. If you have names like NVIDIA and Amazon out in front, that's something you can probably trust. But DraftKings, DocuSign, Chinese names that are listed here in the U.S., I'm not sure that those are the market-saving forces that the market's looking for. You have, on the other side, you have a company like FedEx that reports quarterly earnings. They weren't that bad. They were all right. They boosted their guidance a little bit, and the stock gets pummeled despite what's been a tremendous rally for the market all day long. There's really been no weakness today in the equities. Yet FedEx couldn't even really get off the mat at all. And you look at what FedEx can say about where this country's economic picture goes, or the global picture, versus what DocuSign is spelling out.
True.
I think FedEx has a little bit more visibility, and if that's what the report is, and that's their projections going forward, and it's not enough, I don't know how that paints a good picture.
Well, I think that to add something on to that I think is a kind of a natural segue, is that there is this instinctive response generally when there's an event from the central bank that's expected, and then it doesn't offer any shock, negative surprise that rates calming down, even with yields, they're not even going down really. The yield just stopped going up, JB, and it seems like when that happens, it instinctively puts a bid into some of these companies that just one earnings report ago looked like they might be zeros to the point of a DocuSign. Not to pick on them, okay? I know that they may not, I don't know. I'm not the fundamental analyst, but the point Alex is making is these companies have been trounced for a reason the last 6 months.
No, but I also think as you're looking at some of these companies, some of them, to use your words, have been sort of trounced too much. And so sometimes it's just opportunistic buying when they're seeing a movement or a reversal. Again, I think to what Alex's point is look, take a company like a DocuSign or some of these other sort of the stay-at-homes that were really kind of high flyers from a technology standpoint. They came out and said, hey, we're going to be guiding a little less. We're not sure we're going to be as optimistic. They got hit really, really hard, and it continued to go down. When the NASDAQ was weighing down even further, pushing down there, they were the ones leading the downward spiral, or leading the downward trend, I should say. Now, all of a sudden, when things have seemed to, quote unquote, sort of stabilize a little bit, there's where some of that opportunistic buying can come into play. So I think what you have to look to see is a trend start to fill. Do we start to see DocuSign, some of these ones, Pelotons, other ones, do they get an opportunity to work their way higher on a consistent basis? Or was this just sort of, I bought the dip and rally up there? I think to his point, when you look at something else like a FedEx or something else that's a little bit larger company, has a bigger role in the whole overall, ecosystem in the U.S., if they're guiding less, what is the concerns hitting them? But remember, for someone like FedEx, energy prices are going to have a way bigger impact on them. So they're going to have commodity costs that are going to weigh them down. But what some of these tech companies aren't going to see the same.
Maybe, yeah, that's a good point, too, that maybe we're also starting to think that if there is a rough patch ahead, which companies are best poised to do it. Originally, if the rough patch was caused by interest rates, then maybe the banks, maybe the energy companies, et cetera, would be the best way through. But now after this week, I do think that we are really starting to pay attention to some of the potential recessionary risk, even with the market rallying. But that's kind of what's weird about this market, is that when we are focused on the Fed not getting even more hawkish, then it kind of puts that automatic search for growth companies back on the table. So I think what we're all saying kind of fits together here. I'll use another example. I think maybe, Alex, tell me if this is fitting into your point. GameStop today, up 4%. I think these earnings were a total joke. I cannot believe that this company is not just crashing right now. They've swung to a loss on their bottom line. They have absolutely no plan that has anything to do with their actual buyer and consumer base. They're going to appeal to the NFT crypto world, which is as ephemeral as their fading hardware world. So to me, when that's up, that is not necessarily, a market saying, oh, everything's changed around the economy. It just kind of looks like people are willing to take a lot of risk today.
I think that's a great way to put it.
That's kind of your point too, right?
Yeah, and I think there's a further point. Yeah, I think GameStop, AMC, any of those meme names, they're going to have a certain type of investor who seeks volatility. I've talked about that before, but they are a good barometer of what some describe as like animal spirits, if you will, or risk tolerance in a marketplace or risk appetite. I'm going to use Zoom so we stop picking on DocuSign and some of these other names as an example. This stock went from $588 to below $100, I believe, in terms of this move. Okay, if you were buying the dip, where did you start? I doubt you waited till it was below $100. So yeah, we've gotten these pops, but how long are these investors looking to hold these assets? My point is, if you've been trying to buy the dip in some of these stay-at-home names or any of the tech names that have been beaten up, you're just looking to get back to even more than likely, unless you had the greatest timing in the history of the markets and you somehow waited this out and bought the absolute lows. And so how can I rely on these companies to be that guiding force for the markets when there's so many sellers that are waiting just to get back to even, is how I'm seeing it. Of course, I don't know that to be sure.
No, but that's the point of the charts, right? That's why we look at the trends. And for some of these companies, it looks like you could easily be catching a knife here that cuts you hard. For some of these other ones, and that's where the technical description gets important, right? Like, for example, just the S&P 500 versus the NASDAQ within itself. The S&P 500 looks stronger. We see this because it put in some higher lows this week. We describe this because it is not in an actual bear market. It's still in a correction and did not fall as far. For the NASDAQ, we made a lower low this week. We bounced back up, but one could argue we are on potential resistance. I look at the Russell 2000 right here. I think the Russell starts to look possibly even the most interesting if you're trying to look at taking a stab, because it's already been in equilibrium for a month and a half. So it's established this. This is kind of where we go down the list, right? Where, yes, there's certainly stuff out here that seems like it's got good turnaround potential, but it doesn't necessarily mean we should think, that some of these awful downtrends are completely in the clear. JB, I'll give you the last word. What are you looking for by the time we get back here on Monday?
I'm looking at the dollar. You knew probably I was going to go to it. I was watching it here today. Again, a little rally after 3 or 4 days of downward spiral. It had come off there. I'm looking to see if it strengthens back up there, especially off of what you heard with Weller and Bullard earlier today of a 50 basis point rate hike that they'd like to see in the market. Does this put it in bullish? Because I think then this could be a headwind that we saw previously for the NASDAQ and some other stocks out there, and especially for the global multinational companies out there that count on dollars. If dollar keeps rallying up, it makes it harder for them. I think that puts that tougher case out there for global growth as well. So for me, really looking at the dollar, how it closes and really then opens up here on Sunday night into Monday morning trading session.
All right, a little preview into the Cut the Cord. I'm going to hit the dollar too. I'm right there with you, Mr. McKenzie and Mr. Coffee. Good convo, guys. Really good analysis. I think we got to some answers here. JB McKenzie and Alex Coffee. Coming up, make sure to catch Alex after MOC here today. Coming up, let's talk home prices. A check-in on a sector that has been our focal point for the economy next.
Let's walk through how to analyze a company's financials on Thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network.
Welcome back to Market on Close. We did get some more housing data this week that suggested the big boom maybe has cooled somewhat, but we're still operating at very elevated levels. Let's talk some more about the sector with Taylor Marr joining us, Deputy Chief Economist at Redfin. We're better to get housing data. Taylor, thanks so much for being here on the show on a Friday. So as we see some of these home starts and mortgage apps start to slouch a little bit, it seems like we can tie it to interest rates for now and not so much some big change in housing.
That's exactly right. So interest rates have been rising throughout most of this year, and we're starting to see little glimpses of what that means for demand, maybe pulling back a little bit. But yeah, there's a lot of movement in the data. Overall, I would say that housing demand is actually holding really steady right now. What we're seeing from our agents, even as late as last month, is record numbers of bidding wars, and the market is still overall supply constrained in the face of these rising rates.
That supply constraint, how much buffer is there when the market has pulled back for U.S. stocks? As those interest rates go up, does the buying appetite fade, or do any of those orders get canceled if they are being weighted? How does that look?
Yeah, we do expect that buyers are hitting their limits on price. According to data we released this week, we're seeing the average monthly mortgage payment up about 25% year over year. And so that's just simply representative of how fast mortgage interest rates are rising, coupled with how fast home prices are growing. And so buyers are likely to hit their limit. We would expect some of them to pull out of the market, maybe cancel contracts for new homes that are already on a very long holding period. But overall, we've been very surprised at how resilient demand has been in the face of even some of these affordability pressures that have really been building for the last year with how fast home prices have been growing.
Are there still clear delineations by region? Are the cities starting to pick up again as we get some life returning back to normal in this kind of hybrid post-COVID world we're in? Are you seeing New York, Chicago, these areas looking strong again?
Not as much. So far, the little glimpses that we can get, and
why the heck they jack my rent up so much?
We expect that we'll start to know more as time goes on, but really we don't see quite a huge rebound in terms of condos, urban houses. We've been surprised that we're actually seeing suburban single-family homes accelerate again in demand this year. So as expensive as they are, we're still seeing demand and buyers flock to those properties.
Looking at the rate of change for pricing in these homes, do we have any kind of historical precedent, basically like outside of the housing bubble? How long can we hold some of these levels?
Yeah, so we definitely do expect price growth to slow down. Prices are growing at about 16% year over year. And yeah, we expect this to slow down slightly in reaction to the higher cost pressures that buyers are facing with higher interest rates. But that being said, we're still in a really tight supply housing market. And so we still expect pretty strong price growth. Even a year out from now, prices growing 7-8% would not be too unrealistic. So we do expect buyer demand to really remain a little bit strong, even in the face of these higher pressures maybe pulling back a little bit. We don't expect price declines and housing to really get any more affordable than it is today.
Wow. Okay, so we're basically stuck in this regime for a little bit. higher prices not necessarily curing higher prices for the housing situation, doesn't sound like.
Yeah, that's exactly right. And even if we start to see people buy fewer homes, we do expect that sellers will react by perhaps not selling. And as a result, you get a little bit more constrained supply when things start to cool off. And that really buoys home prices up a little bit. So that's something to look out for as well.
Okay, Taylor, thanks for the update on this all-important group. Really appreciate the data share from Redfin. A great place to get those numbers and some clarity on the situation. Have a great weekend.
Happy to be here. Thanks.
Absolutely. Taylor Marr, Deputy Chief Economist at Redfin. Okay, we got some overlooked stocks. George Tillis has got an interesting mover for us. And then we've also got a little cut the cord action. I'm watching the dollar and BTC. We'll talk a little bit more about that when we come back and wrap things up. Stick around.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Okay, time for an overlooked stock to close out this week. George Tillis doing what he does, finding some movers that you missed in today's action. GTLB GT. So you got half of your name in this one, George. Goodyear Tires, really your ticker, GT. This is GitLab. You're going software for us. A nice little bounce today, George. What's up?
A nice little bounce, yes, for GitLab, OJ, but going back a few days, the stock has basically doubled. It's really outperforming the overall market and even some of its peers in this recovery rally that we're seeing post-Fed. But it's an interesting company. GitLab IPO'd back in October, so this one really never had a chance. I basically IPO'd at the wrong time as we saw our correction begin in November. It's basically an open source software development cloud-based program that's a DIY. In other words, it allows software developers to develop their own software utilizing their cloud-based tools. And it allows the creation, the review, but also the deployment. And this is important because it's not only a development tool, but it also allows the operations by enterprisers on their platform. So the combined development and operations together, which again makes it unique relative to some of their respective competitors, companies like Teradata, Qualisys, but also companies like we talked about JFrog, which is actually another one of these open source development.
Oh yeah, I remember Frog.
Tools. Yeah, so the interesting company, I will say from a technology standpoint, because again, it allows this development as well as operations under one platform, but it also uses major native cloud platforms like Google and AWS. So if you look at the report, now the report actually was on the 15th in terms of earnings, and so that was, I think, good timing. Again, going against the bad timing of their IPO, but they actually posted some fantastic numbers, and I think it was really underrepresented or underseen because of the fact that we see the overall markets rally. But they posted about 67% top-line sales growth, as well as, again, improvement in the number of active developers utilizing the platform, but also the paid numbers. The paid numbers of folks or companies that are utilizing their platform, companies like Lockheed Martin are just an example of those who use their platform or pay for it. They increased by about 67% year over year. But overall, we got to keep in mind, this is a company that's still not profitable, but it is growing immensely on a year-over-year basis, about 67 to 68% sales. Net losses are still there, but they are certainly improving compared to the same quarter last year.
Okay, interesting, George. 68% top-line growth, definitely above standard, but not unheard of still, though, as we see, punished over the long term. But 27%, even by today's overall move for this group, that one stands out in a very big way. So I think that's a good one for us, George, to ponder. GitLab, and also still looking a lot better than its comparables, its peers that you gave us. Thanks, George.
Yes, yeah, OJ. Overall, if you look inside the company, and there's a reason why it's moving. It's been so oversold.
Yeah.
And like I said, never got a chance. But on top of that top line sales, they actually guide net revenue retention rate at over 150%. And this gives you an idea that the 30 million developers that use the platform, they're getting more dollars spent on a recurring basis for additional services. And that, again, is what you want to see in the technology space. And I think that's one of the reasons why we saw such a nice move in the stock.
Okay. All right, George. Nice find. Reminder for us here that there are certainly winners, even among the winners list. 27% GitLab. Thanks, George, for the overlooked stock. I got one quick thought before we close out this week. Big one for bulls. And, of course, everybody's wondering, is everything back to normal? Is this the ways of the old market returning? Buy any dip on tech and just a broad basket of growth stocks surging. That's what we got again today. It is an impressive move in the NASDAQ. There's a few particular things I'm looking at. As we've discussed in the NASDAQ, looking at 14,500, that's the level that really becomes impressive, that starts to change the downtrend into some kind of reversal. But we've already talked about that a lot. I want to look at the chart of Apple, because Apple, at the end of the day, probably still the most important company. And what we've got for Apple is still a pretty clear trend. What's different here than other dips in this market, of course, is that this isn't just a dip. This is an established now trend, lower lows and lower highs. We ticked to the close of a bear market on Monday and then ramped right back up. That reminds me of JJ saying that the market's got one job: to screw everyone as much as possible. And every way, bears got their clocks cleaned in the second half of this week. But the hope is certainly not lost for fading rallies. As you can see, for Apple, didn't take out any of the general trend, but we are very close, which means just 1 or 2 days could really revive bullish spirits. Even though I do think that the Fed hiking rates does permanently change our paradigm, I think this overall trend will hold. But even if you get a rally, it could really move, because the downtrending market that I see is not one that goes straight down. There's too much strength in the economy, as we heard from Jay Powell, to keep this recovery going. This is a market that is undergoing violent rotation shift because of rising interest rates and recovery, which at its heart is still positive. I don't think this is a market that blows up and crashes. Now, it certainly could have that happen again in the extremely frothy, risky stuff like crypto or high growth businesses. But for that, let's let the price action dictate our view on that too. If Bitcoin can get above 45,000 this weekend, it clears an important hurdle for its chart, and that's almost a certain sign of a green light for taking risk into next week. You pepper in possibly some good news out of Ukraine, this market could really rip and still be in the broader context of a downtrend. I'll also be watching that dollar, because it managed to hold on to a lot of strength. Have a great weekend. I'll see you on Monday.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Wow, what a week. Welcome to your first trade. I'm Alex Coffey, filling in for your regular host, Scott Connor. We got a fun, jam-packed show here for you today. Let's take a look at today's lineup. We're going to kick things off. The chart master is going to stop by, Mr. Ben Watson. We're going to look at Adobe. We'll look at an illustration trade as well ahead of the earnings release on Tuesday afternoon. In the second segment, we're going to be joined by Cameron May, and we're going to go through some widely held trading expressions, kind of a fun, light, but also informative segment here on this Friday as we wind into the weekend. And then, of course, we're going to wrap the market. The wrap will be very focused on the week that was a powerful week for stock market indices and bulls. Before we do all that, let's bring in the chart master, Mr. Ben Watson, joining us here on this Friday afternoon. Good afternoon to you, Ben. Thanks for joining us as always. All right, before we get into the weekend here, we got to look ahead to next week. We spent some time yesterday, of course, looking at Nike. Now we're looking at Adobe. Some of these key earnings events that we're going to have next week. Let's talk some Adobe here. Obviously, the technicals on this chart getting maybe a little bit of a bump here in the improvement given the giant move here today.
Yeah, absolutely. And Alex, you know, it's interesting because Adobe, like so many of the other software names, has been seeing this real shift, obviously, in their trend. I mean, Adobe was in a pretty consistent longer-term uptrend. It's shifted now, kind of end of the year, first part of this year timeframe, into a bit of an intermediate to long downward trend, breaking a couple of levels of support. You see the shift in the 50-period simple moving average there. That's the blue line on the chart, just kind of changing that trend direction. Most recently, over the last couple of weeks, building into this descending triangle above that 414 support line. It's double tapped that and really kind of squeezed between that horizontal support and the diagonal downtrend. Now, that it was in place really until today, and today is the first time that we've seen in the last really month and a half or so that the price of this of Adobe has broken above that diagonal trend line. That's significant because oftentimes the deeper you get into the apex of these descending triangles, the more likely the price of the stock is to make that move back to the upside instead of downward in the direction of that price pattern, or the price pattern implies. That being the case, the breakout here to the 477, then you've got that 50-period simple moving average up around the 483 mark. The other side of the coin, Alex, is if this settles back down on that 414 support or breaks it, you've got support all the way down at 385 that goes all the way back into February 2020, 2 years ago, before you really find a solid level of support there, Alex.
And I know we have a second chart that makes us appreciate just the rally that was going back to that pandemic time frame, Ben, because so many charts, particularly in the tech space, look like the one-year chart in Adobe, but very few names were as strong as Adobe was over the past 3 years, but we're giving back up a lot of those gains.
Yeah, for sure. And I think this 3-year weekly chart really graphically illustrates that fact. In February 2020, when everything started to change, we saw the downward move in Adobe, and then, boy, it just takes off like a rocket to the upside, and really doesn't really change that trend until we get into this last 3 or 4 months following the end of the year, and that's when that change happens. Now, if you look at this chart, this longer term chart, this puts the trend into the context of the fact that we've made a slightly lower low, but breaking that support at the 385 really becomes a significant challenge to this longer term trend. Still, I think you can make the argument, Alex, that if you were to connect the dots across these lows, it's still in the process of making those higher lows. This one just seems to have fallen from quite a significant height to get to this higher low.
Yeah, man, I can't believe just how much damage has been done to some of these names. Adobe, no exception, traded just under 700, and even after this bounce, still only a little bit over 450. Bulls looking for a positive catalyst maybe out of this earnings event next Tuesday. Mr. Watson, have a great weekend. Thanks as always for joining us here on Your First Trade. All right, let's talk trading Adobe going into the earnings event next week. Couple things to think about. Of course, it's a Tuesday afternoon earnings event, so we may have some time to get prepared here. But looking ahead to possible expectations for what the market is anticipating, at least here on this Friday afternoon, we can look at the platform and take a look at the option chains that give us an idea of what those one standard deviation expectations are. You can see 64.7% implied volatility, corresponding to just under, let's call it $32.50 one way or another. Of course, these are not limits, but rather guiding posts to what the market at the current moment is anticipating for a possible reaction to set some expectations here around this. So doing some back of the envelope math, we're looking for around, let's say 420 or upwards of 480 if it stays within that range. But if we've learned anything throughout this earnings quarter, those are very much just guiding posts. They are not limits. We've had so many of these names outperform those market maker move expectations. Let's take a look at the example trade that we have built out. And the reason I went out a little bit further, you're going to notice we went out to April 14th as opposed to just next Friday's expiration, is that Ben really keyed in on that 414 level as a possible level of support. And so if I'm going to subscribe to that technical belief, yet want to lean a little bit, let's say neutral to bullish, I want to give my strategy a little bit of breathing room to possibly allow for a retest at that support. And if it does hold, this trade could still stand to be profitable going through expiration. So what we did is we did a risk-defined trading strategy, the short call vertical, which consists of selling one, or short put vertical rather, which consists of selling one put and then buying another, doing the overall trade package for a credit. The crux of this trade is anchored at that 410 put strike, and so anything above 410 at expiration, which would lead to a possible expiration where both of these options would expire worthless, that would be our best case scenario. An investor in this style trade could stand to make a possible $100. However, we know anything is possible, and if anything, we know that there's been a tremendous amount of volatility and risk so far in 2022. It is risk defined in the event that that support level didn't hold, if it did go down there and retest, and so anything below 405 at expiration, we do cap our losses at $400. Break even on this one is 409, and this is one that looks to capitalize on some elevated implied volatility, yet looks to still lean a little bit neutral to bullish. We take no upside risk in this particular trade illustration. That's going to do it for our first segment here on Your First Trade. We're going to be right back. Coming up, we're going to talk about some widely held trading expressions. Cameron May is going to stop by for a fun, informative segment here on this Friday. Stick around. We'll be right back.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
If you have questions about retirement planning, then you don't want to miss Investor Education Day hosted by TD Ameritrade. It's a full day of free insights from TD Ameritrade education coaches and experts who can tell you all about honing your retirement strategies. And the best part, it's all online. So technically, you can enjoy the webcast from the comfort of your retirement pants, also known as sweatpants. Register for Investor Education Day at tdameritrade.com/education day.
Welcome back to Your First Trade. Today on Your First Trade, we're going to be breaking down some of the common catchphrases that are used amongst financial traders and in financial circles. We're going to have some fun scrutinizing several of these common expressions while also examining their credibility. We're going to learn whether or not these are maybe half-truths or potentially even, in some cases, possibly reliable indicators. Joining me for a deeper dive on some of these often quoted sayings is Your First Trade and TD Ameritrade Network contributor Cameron May. Good afternoon to you, Cameron. Let's kick things off with one that I think we've all heard a time or two, which is this idea that markets, while they rally, they climb what is called a wall of worry.
Yeah, Alex, I think that's a great kicking off point for our discussion here. It's really very relevant for our current market. So let's think of it this way. With all the doomsday headlines that we're bombarded with on a daily basis, why were the indices recently making all-time highs? Well, it's because often markets actually do climb a quote-unquote wall of worry when making moves higher like that. Uncertainty and fear very commonly accompany bullish markets. And, you know, some may argue that cautious optimism can even extend those periods despite the headlines. Now, of course, it's also rare that markets rally when everyone just agrees that they should, Alex.
No, it makes a ton of sense to me. And I guess it's another way of kind of talking about that velocity of risk or the asymmetrical aspect of risk in equity markets. This idea that, you know, you go up, you go up, you go up, and then it's quickly down when something changes, and there's those reactions. Another common one, however, and it kind of ties into this, Cameron, is this idea that the trend is your friend.
Yeah, you know, well, don't buck the trend is something that we hear all the time. Acknowledging, you know, the overall direction of a stock or an index is really a fundamental concept in the world of what we call technical analysis, and it can help traders align their strategies accordingly, Alex.
And of course, you know, that makes sense to me, but as we know, nothing's guaranteed. There's exceptions to any possible rule, but you know, there are countless examples that come to mind to me, Cameron, of, you know, trends that extend for, you know, quite a prolonged period. I was just talking Adobe with our colleague Ben Watson in the previous segment. I have a 5-year chart up on the platform of Adobe. I mean, this stock trended upwards for what was the better part of those 5 years. And of course, it's now kind of started a new downwards trend. So this is a great example in my mind of a trending market. But when that changes, things can happen abruptly. And of course, they can continue in a particular direction for a long time. But of course, there's always exceptions. And I think that's a really important point as well. There's also this perception in markets, Cameron. I think this particularly happens when we're in kind of a bullish market, and it's been one of those more prolonged, you know, periods of rallying amongst equities. It's that the analysts maybe are a little bit more ahead of the curve, that they got a little bit more insight than us everyday investors.
Yeah, you know, hey, if the analysts are ahead of the curve, well, perfect. We'll just follow them, right? No, but seriously, while they do have access to some pretty extensive data, they still have to formulate an opinion. And as we've seen, the release of these opinions can be, you know, less than timely.
No, I love that point, and that's why, you know, you take anything you get in financial markets or life, you know, take it with a grain of salt. It's a piece of the puzzle, but ultimately we're putting that puzzle together. And so while I think there's often great insights in some of those analyst reports, in the end it is ultimately just their opinion in terms of the rating or the price target or even the information that they're relaying. But that of course doesn't necessarily mean that they don't have good information, but it also doesn't mean that of course it's any type of a layup and it's just as simple as, you know, copy everything that they say and it's going to ultimately be positive. But let's also talk here, you know, we're halfway through March already. It was St. Patrick's Day. March Madness is all going on right now. I can't believe just how much time is flying. But that means, you know, summer's just around the corner here. And one of the oft-used phrases within seasonality is this idea of sell in May and go away. Is there any credence to that? Anything that sticks to this one?
Yeah, you know, there are lots of those sorts of general or seasonal market sayings or like that saying. In any event, the bottom line here is that although we can identify seasonal trends that may prove true on occasion, it's statistically really difficult to assign a probability of these events actually playing out, Alex. So trends can fade over time, or they can even just become crowded with trades that work to reverse themselves, Alex.
You know, it's a really great point, and I would just add, you know, just because and let's even say that there was credence to this, which I'm not sure that there is even, but let's say that it has worked in the past. We already know that past performance is not, you know, an indicator of what's going to happen into the future. So just because something's even maybe worked in the past, again, I'm not saying that this one has, doesn't necessarily mean that it's going to continue working into the future. I got a fun one here that, you know, maybe in its name and how we say it sounds a little bit more dangerous than it is, but I think it's an important one. Amongst this list, it's maybe the most important one. It's this idea of trying to catch a falling knife, or as some would say, don't try to catch the falling knife.
Yeah, I knew where you were going with that. Fun and dangerous. Yeah, it's a very popular saying because it's, in this case, it's a reminder that timing a reversal, or what we call picking the bottom, can really be pretty risky. So just because a stock price has dropped and it may even appear to be discounted doesn't mean it will actually continue going lower. Even if a trader's analysis indicates a potential buying opportunity, picking a low point and then going all in may not be the best approach. In this event, you know, the trader might consider something like maybe scaling in, Alex.
No, it's a really important one. To me, that saying is almost like a proverb of sorts. You know, there's a lesson in it, no doubt about it, but it doesn't necessarily give you the takeaway. It doesn't tell you what to do with the information. It just kind of explains that, hey, there's risk when you're trying to, you know, make investments. And again, our Adobe chart, I think, is a great indicator of that. When you look at this prolonged move lower, if you compare that to other periods of sell-offs in Adobe, this one's certainly been a lot more extended and a lot more vicious. So it's not as simple as just buying all these dips, as we've seen so many talk about in recent years. But we've got another one that I think is a bit of a proverb of sorts here, and this is this saying, and I've certainly said it before, this idea of buying the rumor yet selling the news. What do we mean by this one?
Yeah, well, it's another fun one, kind of sing-songy, buy the rumor, sell the news. Well, you know, speculation and rumor can drive the price of a stock and essentially just become baked into its price. But then, when or even if the speculation actually proves to be true, stocks may sell off on that news. And of course, if a popular rumor is, let's say, later denied or, you know, disproven, then a stock price can also correct very quickly. Alex?
Yeah, and the idea being here is that in some cases, the market is, of course, looking forward, has these forward-looking aspects to it. And, you know, there might be speculation amongst the, you know, the investing public and hedge fund managers, institutional managers, and all this money is chasing something. Then the news comes out confirming what the market already thought it knew, or maybe even contradicting what the market thought it knew, and you see a different reaction. So I think that's an important one. Again, it doesn't necessarily give us the information in terms of how to approach markets, but it maybe kind of gives us a lesson in that everything isn't always as simple as it seems. Just because the news is good doesn't mean that the stock's going to go higher. With that, though, some are going to claim, you know, markets are efficient, and therefore the current state of the market must reflect the current state of the world.
Well, yeah, sure, Alex. Markets are efficient in that they reflect the collective opinion of investors through, you know, order flow. However, this opinion it's typically forward-looking, and it's commonly believed to actually extend out about 6 months.
So this is a really, really important point. This is tying into our idea of this buy the rumor, sell the news as well, Cameron, which is, you know, just because the market is efficient and there's a lot of money basically going back and forth in an auction type marketplace determining price, doesn't mean that it's reflecting what's happening right now. The market's looking ahead. I mean, I think you could look back to the pandemic period, Cameron, and we saw the market make its bottom in March of 2020, yet worse just now, if you know, we cross our fingers, maybe rounding that final turn of the pandemic. So the market's not always in sync with the events on the ground, but instead, in many cases, looking forward. Many say that market sell-offs are a past, but Cameron, I don't even think we need to entertain this one that much further. I think 2022's already put a little bit of a fork in that one. Of course, we've seen quite a bit of volatility so far to start this year. So, Cameron, I'll let you go early here. Have a great weekend. Thanks, as always, for joining us here on Your First Trade. Look forward to talking to you again soon. We'll take our final break of the program. We get back. It's time to wrap things up. What a week. We're going to look at the top stories from today and this week. Maybe a little bit of look ahead as well. We'll be right back.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Welcome back to Your First Trade. It's time to wrap things up. Look at the top stories of the day and the week. It's time for the wrap. Let's take a look at where the 4 major indices here in the U.S. close things out. Big, strong green day once again, building on what's been a week of strength. We have the S&P 500 finishing up over 50 points once again, 4463.12 in the S&P 500. Dow Jones Industrials up 274, 0.8%. Dwarfed by its NASDAQ peer. Look at that, 2.14%. The Russell, a healthy 1% higher as well, 2086, up 21 points. But all of these moves are minuscule in the scheme of what's been a ginormous week. Let's take a look at what the week-to-date performance as well. We have Dow Jones finishing up 5.5% on the week. The S&P up 6.15% on the week. The NASDAQ 100, 8.4% on the week. And of course, the Russell not far behind there, but the laggard up 5.38%. So just incredible performance. Volatility getting down to multi-week lows as it's down below 25 now. We're actually down below 24, 23.87 for the VIX. Take a look at the commodities. We got the 10-year yield. This is going to become another big part of the story. Obviously lower here today by a fraction, a little bit over 4 basis points lower, but we're going to watch this yield curve. That's going to be a big story, I think, as the rest of the year rolls on. Dollar index bouncing back after a day of weakness, putting a little bit of pressure on the gold market. Crude oil, this is the other mover. This is the commodity that is on the minds of the everyday investor, the everyday member of our society, as fuel prices continue to surge, stabilizing here just over 100. It's been a volatile couple weeks for crude oil, and we're really starting to see some of that volatility be sucked out. But 103.72 certainly going to hurt our pocketbooks when we go to fill up the gas. Bitcoin, though, I think those who are looking at risk assets this week and looking for something to help confirm that move, Bitcoin showing some strength here, probably helping that a little bit. Let's take a look at the stock movers, because while it was easy to find some stocks that were doing very, very nicely today, I also got one on the list that wasn't so hot. Let's start with the good one, though. Let's look at DocuSign, one of the strongest performers in the NASDAQ 100. But keep in mind, this has been one of the weakest names in this market for quite some time. But a massive move higher, 9.45%, back over 95.5. Just a massive move in DocuSign. And this also on reports of the CEO buying some more shares, a little bit over $5 million worth in the last few days. This combined with a very strong tech sector today made that one of today's strongest performers. FedEx. Wait, is that red on the screen? Down 4%. FedEx. Disappointing on earnings, but you look at the earnings, they weren't that bad. It just, hey, it's a tough tough crowd these days. Markets not impressed with what they saw in FedEx. Stock was lower despite really strength across the equity market. So sending two different pictures here as we go into the weekend. And you look at the sector breakdown in terms of performance here today. You had a market that was led by some of the growthier parts of the market, some of the areas that have gotten beat up the most. Things like information technology, things like consumer discretionary names. So really important to see some of those names bounce back. Can they sustain it? That's going to be one of our biggest questions as we go into next week and have two major earnings announcements kind of as our key note pieces of next week. We're going to look ahead to next week. Not a whole lot on the economic data front, but we got Nike, which we previewed a little bit yesterday with Ben Watson, and of course Adobe, which we previewed with Ben Watson today. So a discretionary name in Nike and a tech name in Adobe, possibly setting an early tone for what's going to be a fairly light week. As we always say, Nike officially, unofficially marks the end of an earnings quarter, and we look for those banks to start things back up. So big week next week. We'll see if bulls can follow through. Thanks as always for tuning in to the TD Ameritrade Network. I hope everybody has a great weekend. That's a wrap.
market. Yeah, as she just mentioned, Russia, Ukraine. But what I look at when you look at Bullard's comments, I look at what the sell side did. 3 hikes, 5 hikes, 6 hikes, 7 hikes. They were tripping over themselves to be the highest on the street. That's what these guys are doing. They want to say they were ahead.
So the Fed governors are tripping over themselves like sell-side analysts.
Yeah, I think they're trying to distance themselves, especially Bullard. I love what he says. I think he's very credible. But I think at this point, it's not helping.
Or they're sending them out to jawbone the markets, which, I mean, which would be an odd move, though, given the proximity to the Fed meeting, Guy. I mean, that's what's so fascinating to me about the comments today that we're digesting, is that we just had the chairman of the Fed earlier this week talking about the path of hikes. And then we've got these 2 other governors out today. What do we believe? And why would the markets believe the 2 governors just days after the Fed meeting, unless the Fed had a credibility problem?
We've been together 13 years now, Melms, and you're starting to think like me. I agree with you. I mean, it's not conspiracy theorists. They say, look, the market's done well. Let's trot some of these guys out and see what the market can withstand. Let's push the envelope a little bit here and test the waters. I don't think it's that ridiculous. I think they realize how behind the curve they are. And, you know, some people think they're a couple months behind. They're literally 3.5, if not 4 years behind, without question. And they got a lot of ground to make up. But I think, to your point, why not push the envelope when the market seems to be on somewhat terra firma right now? I think that makes a lot of sense.
And so let the market take the next step forward. And if you look at the 10-year is at a 225 intraday high on Fed day. And before we got into the Powell testimony, and we marveled and we were mystified why it fell a little bit, fell that much more today. Yeah. So is the market already telling you that they're concerned that the Fed runs us right into growth? Why? I mean, Amazon's up 28% in the last 8 days. Mega cap tech, we're going to talk about NVIDIA. We're going to maybe have a mini debate on it, and I'll save that. But the point is, I think what the market is doing is saying, on one hand, applaud the Fed for credibility in fighting inflation, because everybody knows we need it badly. It's a blunt instrument. But I think the market is actually saying, I want to be in defensive, slower growth, lower multiple tech names that we've seen are basically the new flight to quality.
So is the market, I'm sorry, but is the market actually digesting the idea that a 50 basis point hike could be coming as suggested this morning? Or
yeah, I think it is. But when you see the 7s, 5s, and 3s invert, doesn't that tell you that growth is going to be lackluster? You said the 10-year is doing nothing.
Yeah.
So why not take a powder? Why not over-speak and do less?
But isn't that a market? So isn't that a market if, and this is Rick Santelli, great line on Wednesday, we're seeing a traffic jam in 3s, 5s, 7s, and 10s, meaning the curve is getting very flat, and you're seeing all those yields bunch up. That's a market that's telling you they're worried about growth. I mean,
that's a market that's telling that the rhetoric, I think he's so aggressive, hawkish, that the short-term rates are really pivoting on that rising, and the long-term, he's beating growth out of it.
Here's my question. If you're worried about growth, do you want to be in the names that give you idiosyncratic growth? Because that was the formula for being in the mega cap tech trade before, Courtney. That a name like an Apple and a Microsoft, you know, these names have good balance sheets, but they also have idiosyncratic growth. They will still grow even if the economy slows.
They will, but I think the question is, are they going to have as much growth as other sectors of the economy right now, right? And I think the economy is on good footing. That is why the Fed is saying that they can continue to increase rates here. We have really good balance sheets for households right now. People are spending. So I think you want to look at some of those companies that have pricing power right now. And with the fact when inflation's kicking in, I just think there's some other things other than your tech firms that might be better opportunities. It's not that they're going to not do well. I just think there might be other sectors that take off even further.
Okay. Meantime, retail, that soared this week. The online retail ETF, ONLN, how clever, just wrapped up its best week since April 2020. And take a look at Nike, shares popping 3% today, ahead of the company's earnings report on Monday. The Chartmaster says there is upside for the sports apparel name. Let's get to Carter Worth of Worth Charting. Carter, what are you looking at?
Well, it's a good precondition for a move higher, which is exceptionally weak preceding price action. And it's not just Nike, of course, it's footwear across the board. Let's look at a few stats and a few charts. The first here, this is year-to-date numbers for Crocs, for Puma, Deckers. You see it right there. I mean, the S&P's down with its recent bounce, now only 6.8. These things are still down 20, 30, high teens %. So the first chart, Nike, this is the, I mean, talk about a mathematically perfect 45-degree angle. That is the channel in which Nike has lived. It reached a low of 950 in the financial crisis low and hit a high of almost 180. And we've lived in that channel. Now, this pullback, take a look at the next chart. We are right down to the midpoint of the 2009-2022 channel. Does it mean you have to bounce here? No, but I think we will. Next chart. This is simply the current here and now. It peaked, it dropped 34%, and the question is this recent bounce enough to suggest that not only are those lows in, but there's upside? Final chart. So we know the high was 175 or thereabouts November 5th. The low was 116 on March 14th. You got a 4-month sell-off of 34%. And right now we're trading, well, are we going to get to 170? No. But can we get to that overhead supply? Yes, that's at 145. And so right now we're 131 and change, 145. That's another 10, 12%. And I think it's a trade one should be getting involved in.
All right, Carter, thank you. We'll see you on Options Action shortly. Steve Grasso, is Nike a buy in your view, or does it have a potential China problem, a potential supply chain issue problem?
Yeah, I think Vietnam. I think that's the issue, and I think all of those footwear stocks that he put up on the screen probably have the same supply chain issues as well. So you have to be very careful about that. But I think that's probably also in a lot of these numbers as well. So Under Armour looks like it might be a trade, because I think we're just going on a reversion trade for all of these names.
Yeah. During a period of crisis and a market dislocation, relocation, Nike's the first name you want to buy. And it was the first name to buy in the lows of COVID. And they were the first ones really to give you some insight into what they were seeing in China. They report on the 21st of March. I mean, this is a company that I think really will be the first to give you some sense of where gross margins are going, especially in discretionary, with all of these factors. I'm a shareholder. I expect to be a shareholder the day after earnings, but I get very concerned, even with the innovation and the tailwinds in fitness and whatnot. So much demand has been pulled forward. There's been so much pent-up demand. There's been so much discretionary free money thrown at the world. And Nike is one of the great beneficiaries, because you could be lower middle class, you could be middle class, you could be upper class, and you can buy a $150 pair of sneakers, and it can make your day.
But how many sneakers do you need?
Exactly.
And how many sneakers will Nike have? I mean, that'll be, even if you don't own Nike, I would imagine that this conference call is going to be key. As Tim had mentioned, it had talked about supply chain issues. It talked about all that stuff back in December, Courtney.
Yeah, and I think it's a lot of short-term issues you're seeing with Nike. It's the supply chain issues, the issues with Vietnam. There's now COVID increase in China, which is going to affect their sales in China. Their sales in Russia and Ukraine are going to go down. But I think when you look at this from the longer term, a lot of these things are going to get resolved. So if you are of the view that these things will get resolved, and I think we all are, I do think there might be some good opportunities here. And I do think, especially when you look at their sales abroad, about 70% of their sales in the next 5 years are expected to be outside of the U.S., and they already do have a foothold in China, which I think is fascinating. I think these are great things to take advantage of.
Quick, would you rather, Guy? Nike?
Oh, wow. We've done this in a while, by the way. I don't think
I haven't asked him.
That luxury.
All right, here we go. More global Nike or more domestic Lulu?
Listen, I'll tell you one thing. The last couple times Carter Worth's been on, it's been spot on. I mean, look at that square call he made the other day, the Sox call. So 145, 50% retracement of the all-time high and that recent low. I'm in the Nike camp with CB Dubs, Melms.
All right, let's move on. GM just announcing it is acquiring SoftBank's stake in the self-driving startup Cruise. It will make an additional $1.35 billion investment in the company. After the deal, GM will own 80% of Cruise. There's a couple ways you can look at the story, Tim, and you're a shareholder here. GM is increasing its stake in a very valuable component of the company of Cruise, or SoftBank, for whatever reason, needs to sell.
Look, SoftBank, at various times, we've seen them be way over their skis on a couple investments. We saw with Airbnb. We saw a couple other ones. I think you've got a case. Actually, WeWork is really the case I'm thinking of. I think with GM, $2.1 billion, $1.35 billion to throw into it, with all the money we've heard at them throwing at EV and in this case autonomous, and where they've been already on autonomous and robo-taxis, this makes so much sense for GM. I don't think this is a game changer, except for the fact that people who are looking to remultiple this company, this is exactly what you want to see. This is not a significant outlay based upon the cash flow generated last year. Next year may be a different story.
When you compare Tesla, GM, and Ford, Tesla's leaps and bounds ahead of them on battery, ahead of them on autonomous, but not so much anymore. I should have said used to be ahead of them. Now GM is really making a lot of headway, and I think this differentiates GM from Ford, and they're hot on the heels of Tesla, if you will.
Coming up, Coinbase is dropping after hours. A notable short seller just announcing a bet against the name. We got the details next, and later in options action, mortgage rates may be on the rise, but that's not stopping one home builder. We lay out the trade for one construction company that may be building up for big gains. Fast Money's back in 2.
Coinbase is what I'm kind of talking about. Coinbase is what we would call one of the bubble stocks. Obviously, it's got a unique market niche as the pretty much the only public crypto exchange, and consequently has the valuation to go with it. But we think as competition increases amongst the exchanges, you're going to see fee compression. And as it is, Coinbase will probably not be profitable this year with a $40 billion market cap.
That was short seller Jim Chanos just a few minutes ago on closing bell overtime, announcing his latest short position in Coinbase. Shares are down about 1.8% in the after-hour session. Guy, we've talked before about this notion of sort of the Robin Hoodization of all trading, including crypto. Those fees go away, but Coinbase does have other businesses, custody business, et cetera, to offset that.
And Jim said, I know you listened to it, he said, you know, look, if people are just going to invest in this based on Bitcoin, if they're going to take a very one-dimensional approach, he understands that this stock could go higher. He's obviously drilling down a bit deeper. I'll say this about Jim Chanos. I mean, I happen to think he's probably going to be right about Coinbase. A lot of people think Mike Mahaney talks about it being the bank of the metaverse, but that's probably 5 to 8 years away. I think it can go lower from here. It's just a $150 stock. It's bounced pretty significantly over the last week or so. But Jim does extraordinarily thoughtful work. Go back and look at his work on DraftKings when everybody, including myself, by the way, was tripping over themselves to be long the name. So good for Jim Chanos on this one as well.
Well, I agree with that. First of all, I agree certainly on Jim, but I agree on the concept of this is a company that's really not going to make money, and I just don't know if I want to own stocks like this in this environment. I believe Coinbase has a legitimate business, and I believe that they are certainly taking a major demographic, have an enormously sticky market, people that are going to continue to grow their crypto experience through Coinbase. They're going to trade multiple currencies. They're going to begin to trade NFTs. I just wonder, in this environment, is this a stock I want to own? This is not one of the ones that call them the high multiple tech stocks that have crashed that are going to be my first in.
Yeah. Courtney?
No, I have to agree with that. I mean, I think I want to focus on companies that have real earnings, real dividends. I was actually one of his points on these, and it's nothing that I'm really trying to throw my money into right now.
Yeah, it's more environment, more macro environment versus stock specific at this point. But no one's reaching in a higher rate environment for a quote unquote growth stock. It's been in a declining trend line since November of 2021. It has to break above 200 to break that.
Embedded in this belief, though, Tim, as a trade on Coinbase, as a short, is there a belief that Bitcoin does not go higher?
I think you have to have that. The correlation of Bitcoin to Coinbase is over 0.9. There have been periods where it's broken down, and those periods have been in the last 6 months. So I'm not going to say they're mutually exclusive, but I would say that you have to see a major decline in Bitcoin to really see the stock fall out of bed.
All right, coming up, a semi-standout, the chip stock that is staging a massive rebound, putting its best week in nearly 2 years. We'll bring you the name of the trade, and later, shares of Eli Lilly having a monster March. Will the love continue in this name? The options experts will break it down ahead. Much more Fast Money in 2. Welcome back to Fast Money. NVIDIA ripping higher. The chip stock up 6% today, posting its best week in nearly 2 years. Major catalyst coming up next week, Guy. One where some people are expecting maybe new products from the company. Jensen Huang will address investors and analysts.
And that's going to probably be the sell the news event, is my sense. So we talked about this on Monday. Obviously, while we were on hiatus during the Olympics, NVIDIA reported great quarter, better guidance, stock traded lower. Good news, bad price action. We talked about it subsequently when we came back. But we saw something Monday we haven't seen for a while. The stock cratered, reverse traded higher. We pointed that out. We said there's probably significant upside here, and that's what we're seeing. I still think there's a little bit room to the upside. I think the 50% retracement of the recent all-time high and this sort of $200 low gets you to about 275, 280. I know that's not a lot in percentage terms, but I still think there's room.
Do you like chips, Court?
I mean, I think NVIDIA has been a strong, it's something you can't really bet against, right, recently over the last couple of years. And I do like their balance sheet. I mean, they have over $21 billion in cash on their balance sheet and less than $11 million in debt. 11 billion, sorry about that. But I think they're really strong here. And I do think it's going to be really interesting to see what they're announcing next week, because we could see things like buybacks. We could see things like their sales on electric vehicles in China. And all those things, I think, could potentially be a catalyst for it moving forward. But we'll have to really see what they say next week.
It's hard to bet against NVIDIA. I just would bet against NVIDIA more in this environment. I'm a short-term down trader. I'm a long-term investor. I'd rather own Marvell or one of the names that I think has a combination of 5G infrastructure plus cloud networking, cloud acceleration, and I think are cheaper stocks. That's really what it comes down to. In a semi space where I think, look, semiconductors led the market higher. They've led it lower. They led it higher back this week. I just don't think we're off to the races yet.
We're in a declining trend line as well in NVIDIA. It started back in November 2021. The price breakout is right here, 264. So I think I'm going to be in everyone's camp here. I think it's going to reverse back, probably run a little bit, and then high growth stocks probably not going to be where you want to be.
So in this environment, Tim, would you rather? Oh, I did it again.
Yeah, can't help
And here we go. Can we get a graphic up there?
Intel, maybe an Intel value
Definitely.
turnaround embedded here.
I could get buried in this grave at some point, and at times felt like I have. But the $35 billion infrastructure spend, what we're doing in terms of all of the infrastructure build out, where I also think Taiwan Semi is kind of a naughty word in this country at this point, despite their dominance. So, yeah, I think this is a case where Intel, the valuation, the expectations, and I don't think the bar is extremely high. It's certainly not high on valuation.
I mean, Taiwan Semi guy, it has been or had been a desk favorite, but is there some sort of, I don't know, discount that should be embedded in its multiple because of potential China risk?
Discount is there without question. I think we can all speak to that, and maybe it needs to be further discounted. But at a certain point, Taiwan Semi, I think they're 5 or 6 of the most important companies on the planet. I think Taiwan Semi is probably one of those 5 or 6. So I think the discount it currently has may be enough to start dipping your toe.
All right, final trade times. Go around the horn. Guy, over to you.
Eli Lilly, Melms, you got to stay with the big cap pharma.
Courtney.
I was at XLE. I still think energy is a really good sector to play right now.
Tim Seymour.
Southern Copper, SCCO. You could go Freeport, you could go Southern Copper, but commodities pulled back. They're not pulling back much more here. Inflation means reflation.
Stephen.
Do you know where you want to be? I think you want to be. I should say, do you know where you think you should be? It's value.
What?
You don't want. I don't know. But I'm going to take 2. You want to be in value, not high growth here. And I'm playing it with chemicals. It's a name that I've been in. Trinseo, TSE. The chart looks like an EKG. The patient is not dead. I'd be a buyer. I'd be loading up here. I think value is going to be where we're going to be running to.
Do I know where I would want to be?
Yeah.
Is that what you asked initially?
Yeah,
I want to be right here.
I was trying to be a philosopher.
And you will be.
All right, that does it for us here on Fast Money on this Friday. Do not go anywhere. Options action is up next. It's Friday and it's time for Options Action. I'm Melissa Lee, live at the NASDAQ market site in Times Square. Here's what's coming up.
In a market with still more questions than answers, Carter continues his offensive-defensive series with another healthcare haven that just hit a 52-week high. Then, Tony is looking at a home builder that could be a discounted catch-up to a larger macro rotation. Finally, not everything that bounces back is worth holding on to. Mike is hedging one specific sector that's traveling out of step with its own history. It's time to risk less to make more. Options Action starts right now.
Let's get right to it. Despite the market's winning week, investors are still facing many large unknowns. So Chartmaster Carter Worth is continuing his offensive-defensive theme. Also, just like UNH last week, he's continuing to favor the healthcare sector for best bet. So Carter, what's next here?
You bet. We're going to look at a name in particular, but I think it's important to state that the objective here is to find something that can participate in market upside, but has some downside protection. So just as United Healthcare, a very idiosyncratic pick, we're going to look at Lilly. But first, I want to look at some sector charts, the healthcare sector relative to the market. So here is the first one. Now, all we're looking at is a ratio. We're looking at the sector's relative performance to the SPX depicted in one line. And you can see where I've drawn an arrow. That looks totally random. You could say, well, Carter, you could draw an arrow anywhere. Now that line, remember where that line is drawn. That's late November. And look at the next chart. Now, that line is the trend line that's been in effect for the past 15, 18 years. So we're looking at the relative performance line of healthcare to the S&P, and it is bounced off that trend line to the penny repeatedly. Let's look at the next chart. Now, this is the all data chart going back to the beginning of S&P sectors as we know them now in 1989. And so simply stated, every single time that the relative performance line has come down to this trend line, it is bounced. And it bounced again in November, 4 months ago, and it's been outperformance ever since. Healthcare is outperforming the market. Now, Lilly, final chart. Is that not what a breakout looks like? It doesn't matter what you call it. It's an ascending wedge. What we have is a strong stock that just now is moving out of a range it's been mired in for 6 months. And one could say, well, aren't we chasing this? Here's the thing. You know, Lilly has underperformed the healthcare sector going back to the inception of the sector in 1989. So you have a marquee name that's underperformed its sector long term, that's outperforming its sector right now. That's a good setup play for the breakout.
All right, Carter. Mike, what's the trade here?
Yeah, so I mean, there's several things I like about Lilly. There's a few things that worry me a little bit. So let's start with the things that I like. So first of all, just in terms of what they've got going on the drug side, which is the business they're in, they have some very promising stuff going on in the diabetes area. In fact, they have some drugs that are going to be released mid-year this year, and that's obviously a huge market segment. They're delaying the accelerated filing of their Alzheimer's drugs, but they also have an adolescent dermatitis drug. I'm not going to try to pronounce any of these things because I've tried practicing it and I couldn't figure it out. But a lot of these things obviously represent, some potential growth in the future. And that's obviously a positive. The thing is, a lot of that is also priced in. The company right now is trading about 32 times full year earnings for 2022, just under 30 times 2023's 972 a share earnings estimate. And that is essentially 20-year highs in terms of valuation. And of course, obviously, we've seen the market bounce back quite sharply, and this one's trading at all-time highs. I think there is some fundamental backstory to the strength that we're seeing right now in the price action, but in a way that we can take a bullish bet, but mitigate the risk of a potential pullback. I was looking at the May 290, 320 call spread. When I was looking at that earlier today, that would cost about $10, about 1/3 of the distance between the strike, risking about 3.6% of the current stock price. And obviously a way to get into it if you were looking to get into a round lot for considerably less than the $275 or so that the stock was trading at as of the close.
So, Tony, what's your take on the trade? What's your take on Lilly?
Yeah, so from the charts perspective, I think you have the hallmarks of what you would consider a great technical setup. Not only do you have the breakout that Carter is showing you, but when you look at the relative terms, not only is the sector outperforming the market, the stock is outperforming its sector. So you really have everything you're looking for from a technical perspective. But I share the same concerns that Mike has on the fundamental side. You have revenue growth that's largely flat, that's expected over the next couple of years. Earnings growth is starting to decelerate here, and when you're trading at those 27 to 30 times next year's earnings, which is at its historical upper bound of its range, these are some of the concerns that I have from a valuations perspective. But that's exactly why using a debit spread that Mike is using is the only way that I think is worth trying to play this potential breakout. When you use a debit spread like this, it's one of the most capital efficient ways to take upside exposure while reducing your overall risk. Here he's risking only about 3% of the underlying stock's value. And by using a debit spread here where he's paying about 30% of the vertical's width, he has a risk to reward of almost 2 to 1, actually better than 2 to 1 if Eli Lilly does rally and breaks out higher to that 320 level, which is, I think, a conservative target from a technical breakout perspective.
Carter, your final word here on this trade.
Right. Valuation is always important. And yet, as all will know, valuation is not a timing tool. Let's play the chart.
Okay. From healthcare to home builders, the XHB Home Builders ETF on shaky foundation in the last few months, down more than 12%. But Tony is laying out a trade on one name he says could construct some gains by building on the greater industrials rotation. Tony, take it away.
Yeah, exactly. Home builders have lagged behind, but I think that's the opportunity here. So if we first take a look at a chart here of XHB, which is the home builders ETF relative to the market and the industrial sector, we see that home builders has outperformed both since the pandemic by nearly double. But we really have seen home builders struggle here over the last 6 months or so. But as we start to see a bit of a silent rotation into industrials over the past month or so, I think this is an opportunity for home builders to play a little bit of catch up. And there's quite a few different names or ways that you can potentially play this. So the one that I want to take a look at here is DR Horton, because it is by far the most liquid from an options perspective. And if we look at the chart here for DR Horton, it broke out from that $80 level in March of last year. And despite a strong year from both a profit and revenue growth perspective, we're back at that $80 level. So I think right now the timing is specifically great for a long exposure from a risk to reward perspective. And if you consider the housing market right now, there's certainly a sheer number of risks that I currently see here, whether you're talking about a potential recession coming up, rising interest rates, and even inflation. These are all headwinds for this particular industry. But when you consider the valuations that DR Horton is currently trading at and utilizing an option strategy to try to reduce my overall risk, that's how I get comfortable with taking on the risk of this particular sector. So when I look at the trade structure here for DR Horton, I'm using one similar to Mike on Eli Lilly, using a debit spread. I'm going out to May. I'm buying the 85.97.5 call vertical, spending about $4.72 for that May $85 call, and I'm collecting about $1.17 for that 97.5 call, paying $3.55 for this debit spread. That's just about 4% of the underlying stock's value. That will give me about, again, a 2 to 1 risk to reward ratio if we see DR Horton resume back towards its recent highs around $100 or so.
Mike, what's your take on this trade? Do you like home builders here?
Yeah, I mean, first of all, demand for housing remains quite high, and the pace of anticipated rate hikes is relatively low and relatively slow. In fact, I would argue it is too low and too slow. But if you're a borrower, I suppose that's a good thing. Now, just in terms of the trade, I want people to sort of think about this. When you buy a debit call spread, and Tony's chosen the same structure that I selected in Lilly, this would be comparable if you already owned the stock to owning a downside put at the 87.5 strike and selling the upside call. I mean, the 85 put and the 97.5 call. So essentially a collared stock position. And when you consider where we are right now, I think that's a position that makes a lot of sense. Why? Because options premiums aren't really cheap. I mean, we've had some very shaky ground recently. That justifies selling the upside call, not to mention, I mean, what was 7.5% below the all-time highs as of the close today. That's not that far off of them when you consider what's happened. And owning some downside protection, given everything that's happened, also makes some sense. But this is one of those areas where valuation, I think, does lend itself to potentially getting into the name. So I like the structure, and I do like the space.
To the man who says forget about valuation, look at the charts, Carter. What do you see in the chart for D.R. Horton, and does it stand out in any way versus other home builders?
Not so much. A couple things. Well, relative performance, relative strength, something we all talk about as a group. It's very poor compared to consumer discretion as a sector. It's poor to the market. We also know, and this is fundamentals or evaluation, what do you want to call it? 1 year ago, 30-year fixed mortgages at 2.8. They're now at 4.5. Still low, but that will start to bite. My hunch is that it doesn't have a lot of downside, but it doesn't have a lot of upside. I think this sector, this area, this stock, about where it belongs.
All right. For everything Options Action, check out our website, optionsaction.cnbc.com, and sign up for our newsletter. Here's what's coming up next.
Still to come. As Professor Coe often reminds us, you buy insurance before the house burns down. He's hedging one major sector that could soon see its recent bounce back extinguished. Plus, calling all Options Action fans. Reach into your pocket, grab your phone, and tweet us your question at Options Action. If it's nice, we'll answer it on air when Options Action returns.
Welcome back to Options Action. The XLF Financials ETF has rebounded sharply during the last few weeks. Exceptional volatility, but that's not quite an all clear for the space because there's a lot of nuance under the surface here. Professor Coe is getting to it once again. It's that important right now to remind us of one of his favorite adages: you buy insurance when you can, not when you have to. Mike, explain.
Yeah, I mean, it does very little good if, your neighbor comes to you when your house is burning down and says, you might want to think about getting some insurance. Of course, when you're already in trouble, you know that full well. The time to buy insurance, of course, is, when things are looking pretty good. It's going to cost you less, and the protection it's going to afford you is significantly greater. Now, I know that financials were basically one of the favored sectors for full year 2022. And in fact, if you'd asked me 6 months ago, it probably would have been one of the things that I had said. But, net of the big rally that we've seen, we had Powell's comments earlier this week. I think we need to put some things in perspective. First of all, rates are still very low. And one of the things that people have talked about as a reason to buy financials was they were talking about expanding net interest margins as an example of how financials could see greater profits if interest rates rose. Now, while that's true, that doesn't necessarily correspond to higher share prices. There's a couple reasons for that. The other thing I would quickly point out is that the pace of rate increases is looking incredibly modest, especially when you consider that our most recent inflation data is looking like 8%. And here we are hiking 25 basis points at a time, which I have to say is really probably a joke. It just is not very effective. And that could potentially mean that we're dealing with a stagflationary environment where we have inflation that's essentially exceeding the pace of economic growth. That's not good for C&I loan growth. And one other quick point I would make is that when we think about rising rates, oftentimes we can talk about net interest margins. We also need to talk about multiples. Stock multiples will tend to decline in that kind of an environment. That is not bullish in general, not for financials and not for anything else. The other thing we need to talk about is financial assets. When rates rise, what happens to the value of a financial asset that is paying you fixed amounts of money over time? The longer that period of time, the higher the duration, the worse it's going to be. And the lower rates are where you start from, the higher the convexity. So none of those things really get talked about that much, but that is a potential area of weakness as we look at the space. And I think when we take a look at the rally that we saw this week, that's an opportunity for us to potentially hedge. I was looking out to May, the 39.35 put spread. Now, normally when I'm looking at vertical spreads, I'm usually looking to spend about 25% on the downside with put spreads, and oftentimes you can get that. Part of the reason this was a little bit more is that XLF was just under 39, so this was actually slightly in the money when I was looking at this today. That was about $1.20. Still, the payoff better than 2-to-1 if we see further declines, in the future after this nice bounce that we've seen in the space. I think that's an opportunity to put a hedge on, frankly.
Carter, what's your take here?
Well, I would characterize it simply as a rally to a difficult level, but let's look at a table or two and then one chart. So the sector, it's important to say this, right? Financials, it's the lifeblood of the system. They're the transmission mechanism, the big banks for the economy. But it's 67 stocks in total, 4.6 trillion. You see it there on the screen, and it's 11% of the S&P. But here's the thing. Next slide. The biggest names dominant, and here's the thing. Berkshire is the biggest of all. And is it a financial? Well, it is because it's insurance, but it's also railroads, and et cetera, and so forth. So Berkshire at 14, almost 15%, top 5 stocks at 40%. When we make a bet on the sector, we're often the case making a bet on just a handful of names. But finally, look at the chart. If there ever were a pair of twos, this is a one-year chart. That line drawn is the actual midpoint of all of the trading over the past 12 months. So we have a 52-week high of 41.50, a 52-week low of 35.50, and we're right at the midpoint, having bounced 8.5%. A great time to take measures to look into insurance.
Tony, what are your thoughts on the sector?
Yeah, I think nuance is the right word here, because if you look at XLF, it is a very broad ETF with a huge number of sub-industries within it. And two, I think, are important to point out, and Mike pointed this out. One is asset managers. You have declining asset prices. That's going to put a fairly significant limit in terms of the upside for these asset managers. But the big banks, not only is interest rates what we should be looking at, but really the curve of the interest rates. And we see a flattening rate curve. We have the spread between the 2 and the 10-year at about 20 basis points, the spread between the 5 and the 10-year at about 20 basis points. That's going to put downside pressure on net interest margin that Mike was referring to. So when you consider that, I think the upside here for XLF is extremely limited. And worst case scenario, you could see this heading significantly lower, especially in the inflationary environment that we're heading towards. So as you take a look at the put debit spread that Mike is looking at, what's quite interesting about XLF right now, as he said, because right now things are calm, the implied volatility of XLF is actually quite low. The IV percentile is only at 19%. So he's actually able to buy an at-the-money strike price, the $39 strike price on XLF, for a relatively cheap price and only spending about 30% of the vertical spread. Normally, when we look at these types of hedges, we usually buy an out-of-the-money option to do so. So by using an at-the-money option, he has a higher delta. He's getting better protection for a relatively cheap price with a 2-to-1 risk to reward ratio. Again, if XLF does decline down to that 12-month low around $35 that Carter was referring to.
All right, up next, we're mowing into a trade that is near and dear to our hearts. Options Actions back in 2. Welcome back to Options Action. Last week, Carter and Mike laid out a way to play deer.
The stock has been resting for a year. It is exactly the same price as it was 12 months ago. In fact, March 18th of 2021, it was at 392, and here we are, March 11, 2022, it is 389. Punch and ready to break out.
I was looking at the April 420 calls. You could sell those for $5.70. I always, when I'm looking at buy rights, you want to keep that expiration relatively near dated. You want to collect in general more than 1% of the current stock price.
There is a lot of time left on this trade, but the stock has already hit a new all-time high. That prompted one of you to ask, I put on the deer buy right last week with the stock moving quickly higher. Is it time to roll out of the 430 calls to higher ground? So, Mike, how do you manage this one?
Yeah, that's a really good question. So, this is a situation where, you typically when you do a buy right, your hope is that the stock rallies to that short strike. Of course, in this case, the stock's up more than 12% in a very short period of time. Still not quite to the strike that we're short. But here's an important point. The stock is up materially. I think we closed close to $414 a share, something like that. That call option, which we sold for $570, was about 10 as of the end of the day. So you could indeed consider rolling that strike up if you choose, because here's what's going on is that as we approach that strike, the upside of this trade, as this diagram shows us, is essentially capped. If we roll that, we are going to pay a small penalty in terms of paying $10 for that call, but we will give ourselves a little bit more upside. Usually, though, when I do that, I also like to extend the life of the trade so that it's about the same length of time as what I put on originally. So in that case, we'd probably going out to month end, April, or even possibly to May expiration.
Is there more upside to this spike, Carter?
Sure, in the sense that if the concept of a breakout is the precondition is a long sideways quiescent period. Once you start to break out, this is only session 1 or 2 making new highs, it usually is not contained to 1, 2, 3 sessions. It's the kind of thing that goes for weeks and months.
All right. Up next, you have your tweets and the final call. Welcome back to Options Action. We've got time for a tweet. One viewer asks, what's your take on metals mining? CMC, Vale, Tony, you want to take that one?
Yeah, so my view is fairly simple. I think the inflationary forces driving these stocks higher is not over. So I think my view is to remain long.
Yeah, Carter, how do the charts look on this?
Well, the Spider XME is up 50% in 4 weeks. I think it's the kind of thing where you want to be long, but you want to be selling premium, have calls written against it.
Is that the way you'd approach it, Mike?
I mean, we do see, when you start seeing these kinds of moves in commodities, to the upside, you often will see increases in implied volatility. That's uncommon in a lot of other sectors. So I think that probably makes some sense. Also, if you think that the rally is starting to get exhausted, that's a trade that you might take a look at.
All right, time for the final call. Carter Braxton Worth, what do you say?
Healthcare generally, Eli Lilly specifically on the long side.
Tony Zhang.
The risk-reward ratio favors D.R. Horton buying a call debit spread.
Mike Coe.
I also like debit spreads. Call debit spreads in the case of Lilly, and put debit spreads in XLF.
All right, that does it here for us on Options Action. We'll be back here next Friday at 5:30 p.m. Eastern Time. Meantime, don't go anywhere. Mad Money with Jim Cramer starts right now.
My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer America. I'll be one of my friends just trying to make us some money. My job, not just to entertain, but to educate, teach you, put days like this in perspective. So call me at 1-800-743-CBC or tweet me at Jim Cramer. Nice, mean, I don't care. Eternal or not, hope actually sprung this week, and you owned hope. If you own stocks, instead of dumping them into the misery of the week before, this week was a huge boost to your portfolio, with still one more terrific rally day. Dow gaining 274 points, the S&P jumping 1.17%, and the Nasdaq surging 2.05%. This week is the perfect reminder that you can't afford to flit in and out so easily. Sell. You can't just say, you know what, I'll sell everything and get back in when things are better. Remember, I told you that all week. When you do that, you end up missing a week like this, which is about as big as it gets. There's always a major reason I'm always telling you to stay the course, even if so many other commentators want you to head for the hills. Sell. It's why I presented constructive work from some of my favorite chartists this week, because they're unemotional about the state of the world. The charts have no feelings. More on that later. Remember, most of the big gains each year happen on just very few days. You have all these trading days of the year, but most of the gains occur in a cluster, and then they're over. So we must ask ourselves, will that be the case next week? Let's take a look at our game plan. All right, we start Monday as we started every Monday since the Russian invasion of Ukraine, with a slim, small hope that there's some success in the peace talks. So far, so bad. And I don't see why anything will stop Putin's advance, except maybe Mother Nature, which could make it too rainy for him to bring in the new equipment he needs if he wants to start leveling major cities. That's actually true, by the way. It's hard to imagine that sanctions alone will bring him down, but this was supposed to be a short, victorious war for Russia. So the longer it drags out, the worse it'll be for Putin's regime. I know each week can be different, and we've no longer oversold in the SB oscillator. I just checked. So it's so different from last Friday, huh? Wait for the remarkable run. But we won't have to wait long to find out if things are going to continue, because we have a big company that reports after the close. Dow Jones, Bellwether, Nike. And I've got to tell you, I think the quarter is going to be complicated by myriad issues, mostly involving Chinese spending. I know the Chinese stock market was good, but are they buying things? I don't expect Nike will actually have good numbers, but that's now the conventional wisdom, which leaves open the possibility of an upside surprise. All right, Tuesday. Once a year it happens. Once a year. Tuesday, CEO Jensen Huang, keynote at GTC. Tuesday's huge. This is the man I call Leonardo da Vinci. He's the CEO of NVIDIA, and he speaks at this conference for developers. I know this sounds like pure idolatry. I mean, whoever would name their dog after a company? But, well, this speech will define where tech is, where it's going, and what are the boundaries that must be smashed. And he'll smash them. Now, here's what I do. I watch it live, first of all, and then I watch it again. And perhaps because I'm just not smart enough, I watch it a third time. I am not at this man's level. Actually, no one's at Jensen's level. Even though he speaks in plain English, it's very hard to grasp what the future really looks like. The fact that he's fun, that he has a zest for life, and he's kind, and a personality, all of it will come across. I need you to watch this. Jensen doesn't make you wish that you were smarter. He does make you wish you were more curious. I find him amazing. His thinking should define your thinking. It's how I get some of my best tech ideas. After the close Tuesday, we get an incredibly important quarter from Adobe, also one of my favorite software companies, filled with creativity, as a CEO who understands how the web is a force of democratization that inspires people to tell the stories they know. Remember, we're all storytellers. We all have stories. Adobe lets you tell them. Adobe's got a real sense of purpose, which is unusual. Right now, the long knives on Wall Street are out for them, several analysts saying there's limited upside to the quarter. I think it'll be better than that, but the standards have gotten ridiculously high for this fabulous company. Wednesday, we find out if the market has an appetite for other food stocks besides the incredible Hershey's, which is amazing stock. When General Mills reports. Mills has a storied career, but I think it's no longer the Mills of old. It's become way too episodic for my taste. My view, the food stocks are a diminishing group. Why? Well, they're hurt by inflation in every part of their manufacturing chain. A lot less defensive than they used to be. After the close, we hear from KB Home. Now, I keep waiting for a home builder that says, you know what, we have slack in demand because interest rates have gone higher. Mortgage rates are now 4%. It sure has not happened yet. Given that Lennar talked a very good game about how the world's shaking out right now, and that was a very good conference call, by the way, I bet KB Homes blows away the numbers and even gets some recognition for doing so. As for the response to higher rates, they'll probably predict that demand remains rabid for homes in California. All right, next up, a little curious, I know, Ollie's Bargain Outlet Holdings. Now, I am a proud member of Ollie's Army, meaning I belong to a club that gets special deals from this down and dirty outlet chain, one that sells markdown merchandise that is basically offloaded from other retailers that need cash that Ollie's has. And they buy the stuff for next to nothing, and they sell it to you for a little next to nothing. Now, speaking of bargains, I just bought a terrific book about the last days of Nazi Germany for under $1 at Ollie's, even though it was water-warped and could have doubled as a door jamb. I think it was a bargain. The key thing for Ollie's, how do you think I made money? Wait, by going buying books full-time on Amazon? I go to Ollie's. Anyway, it's whether they can get their hands on enough inventory. I mean, they exist to take unsold inventory from other retailers. But what happens when consumers are willing to pay full price for pretty much everything and there's nothing to sell? Well, maybe you go get water-damaged books, right? Bad news for Ollie's Army. Next up, earlier this week, we went to see Steve Squeri. Remember, he's the excellent CEO of American Express, who talked about how people are going out. And again, they've been cooped up for ages. Now, I want to know, are they going to Capitol Grill? Are they going to Olive Garden? Are they going to Longhorn Steak? We'll find out when parent company Darden reports on Thursday morning. Stock's been acting a little funky lately. Given that they have all different demographics attending, it gives you a fabulous sense of where we are. I had a really good brunch at Longhorn recently. They have killer just absolutely killer Bloody Marys. I'm not kidding. I mean, my wife doesn't even like them. She tried one. After that Baconator thing, I shouldn't have mentioned that. We'll take it out in post-production. Friday, we get the Michigan Consumer Sentiment Report, and I'll be glued to this one because the level of dissatisfaction with this country seems mighty high. This is an important number for J-PAL because the desire of Americans to spend their darn fool heads off is surely waning. I regard this number as a great arbinger of Home Depot and Lowe's, as we'll soon turn the page to gardening and outdoor living season. And I'll tell you that gardening season is like Christmas for them. And if things are gloomy, well, their numbers won't make it. By the way, I still like Lowe's really much. Now, after this huge week, it's normal to expect some profit taking, so it wouldn't surprise me if we have some bitter days ahead. I need you to steel yourself. But I will say this. After the gains we've had this week, you got to go over your portfolio. The dip buyers, or at least the few left, the ones so disdained by professionals, they might be back, knowing the Fed is a month away, but you don't have anything of consequence until another week's time. But here's the bottom line. If you still own the stocks of unprofitable companies that don't even have any good cash flow and sell at high price multiples to sales, I'm begging you to use this chance, started by today, to do some selling and reposition yourself into more tangible companies with much cheaper stocks that I will give you in tonight's show. I'm going to give them to you. But if you own good, profitable companies, buckle up. It's your time. Let's go to Derek in California. Derek!
Booyah, Jim. First-time caller, long-time listener. You're
I like
a national
those.
treasure,
I like
sir.
the first-time, long-time. That's what they call them, guys. First-time, long-time.
Right. Earlier, you were discussing Northrop and LMT and Raytheon, and you said LMT had the shoulder fire. I recently heard a report saying that the military is going to be spending 35% less on the F-35. Jim, how do you feel about ticker symbol LMT?
All right, look. Sometimes you have to look at these companies. You have to say, who is the CEO? And the CEO for that company is Jim Takelett, Remember him from American Tower? When that stock was at 50, he came to me and said, listen, there's people betting against me, making up lies, doing this and that. You know what? He's darn right. I think Lockheed Martin's a buy. I want to go to Bo, who is in Florida. Bo.
Booyah, Jimmy. I hope all is well, my friend.
It's not bad, actually. It's not bad. I'm going to be hanging with my daughter this weekend. We're going to be streaming. You know what people do. We binge, but just on product. Look, we're thinking about looking at the Theranos thing. It looks good. All right, what's up? What's up?
So I've got a problem, Jimmy. My girlfriend will not stop begging me to buy Lululemon. I mean, honestly, it's getting ridiculous. She's got the Lululemon leggings. She's got Lululemon golf outfits, Jim. She doesn't even play golf. They're coming out with this new shoe line, and, you know, Lululemon being down 33% from its highs, 47 PE. I think it's a great company. I remember when it was in the 70s, I was like, man, I should have bought it then. Coulda, shoulda, woulda. What do you think about it now?
Have you thought about counseling? I think this is a tough one. You know, that you could go together, you could go separately. Lulu's very hard. It's an expensive stock. But I will tell you this. I believe in Calvin McDonald. I think that she's right. I'm sorry, man. You're on the wrong side of this trade. Bo, as they say, doesn't know. Hope springs this week, no doubt about it. After big moves higher, I wouldn't be surprised if there's some prize profit taking. But next week, it's my favorite week of the year, other than like my anniversary and stuff, or like my wife's birthday. This is the real deal. All right, so I'm urging you to do some selling if you own some of the stocks that are unprofitable companies that moved up this week. But I'm going to give you a good one tonight. A company called Vacasa. I didn't know them either. Gives guests a taste of paradise, but could paradise bring profits? I'm checking in. This is like an under $10 stock, man. Off the charts has become an American favorite. I'm checking in on some of the old favorites with another guy who's so right, Larry Williams. You're going to do exactly what he says. And it's not just because I'm Svengali. And there have been a host of new listings over the past few years. Which of them actually have some free cash flow and are not a bunch of jokers you got to stay away from? I'm going to give you my favorites. So stay with Jensen and stay with Kramer.
Don't miss a second of Mad Money. Follow @JimKramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
don't look now. But as I told Scott Wapner earlier, some of the SPAC stocks are finally starting to make a comeback after spending ages in the penalty box. Take Vacasa, which is a software platform that allows owners of vacation properties to rent them out for extra income. Unfortunately, Vacasa came public by merging with a SPAC late last year, and as soon as the deal closed, the stock sank like a stone, falling from $10 right before the close to $5.40 a week and a half ago. Since then, it's caught fire, climbing just under $8 today. Part of that's because of the broader market-wide strength, but a lot of it's because Vacasa reported a terrific quarter earlier this week. Unlike so many SPAC names, and remember, we're on the hunt for good ones, this is a real company that should be able to generate $1 billion in sales this year. I like this. It's not quite profitable yet, but it's getting close. So is it time to give this one serious consideration? Let's check in with Matt Roberts, the CEO of Vacasa, to learn, get a little bit better sense. And also, I'm going to ask Matt to talk about his previous background before we get to this. Matt, welcome back to Mad Money. Matt, you're a moneymaker. Tell people what you did before this so people know why I think that you know how to do it right.
Thanks, Jim. It's great to be back on the show. I used to be the CEO of Open Table, restaurant and reservation.
And that was one of the greatest hits Mad Money has ever had. So we wanted to thank you, thank our viewers. En masse bought this stock, and it matters. Now I'm thinking maybe they should buy Vacasa. Now I say this because I was checking with Brian Chesky, who is the CEO of Airbnb. A lot of people feel you're a competitor. The first thing he says to me is we got a great relationship with them. So tell me how it works that you, who a lot of people are saying is a second banana to Airbnb, are actually partners and doing great together.
Yeah, we're great, strong partners with Airbnb, Booking, Vrbo. So the focus for us is on the supply side. This is bringing availability online, and it's really our primary focus. We're focused on making homeowners the most amount of money and making it super easy for them. So we are the product on the shelf, if you will. We are providing critical supply that fuels the whole growth engine of alternative accommodations, which is growing fantastic, as you know.
Okay, so my wife's down in Delray because, hey, you know what? We're older. We're snowbirds, all right? And she went to a person, rented the place, but there was no Vacasa. The person who rented it to us wanted very much to be hands-on. Now, that's not necessarily the way. If you can't be hands-on, maybe there's another way. Maybe there's you.
Yeah, absolutely. You can rent out your home yourself, or you can work with Vacasa. We're a full service. Think about it from a homeowner perspective. They just hand us the keys. They book the nights they want to use for themselves, and we write them a check each month. And we write them a big check, too. When they switch over to us, they earn, on average, about 20% more the first year they're with us.
All right, well,
so we take care of everything.
It said to me, Matt, is younger people who can get, have enough money, some means to be able to buy a vacation place somewhere, but they can't afford it, might be able to afford it by going down, say, 4 or 5 weeks a year, and then give it over to you to make the money to be able to pay for it.
That's exactly right. We're seeing more and more people contemplating how much money they can make by the rental income as a determinant of how much of a house they can actually afford, which actually obviously creates nice lock-in for us because we're a critical part of how they afford the home. So it's exactly right.
Do you have a team? I mean, someone who can show you the place, or at least virtually show you, someone who can clean it up after someone else had it, give you peace of mind that the place is good if you own the place?
That's right. We take care of everything. We set up the home we create the marketing copy, we set all the pricing, and importantly, we handle all the guest reservations. So we take care of the guests before, during, and after the stay. We make sure that the home is well maintained and clean. We actually take care of everything that you would need. So you're not getting that
cable when we couldn't get Netflix. I'm not kidding. We couldn't get Netflix. We didn't know who to call. I mean, that kind of thing is like.
Call us.
Wow.
You would call us. Yeah, you would call us.
I knew it. I knew it when I heard you were doing something, that it would be like how great Open Table was. All right, so we discovered during COVID that we were afraid of hotels. All right, because you got to get in an elevator with someone. I still don't like it. I'm hearing about this whole new strain. To me, staying at a house has turned out to be the safest way to vacation. Are you seeing that?
Yeah, obviously during the pandemic, we became the accommodation of choice. Absolutely, for all the reasons you just talked about. But it's interesting though, this is really not just a COVID thing, right? This started over a decade ago. Like, we had about 10% of the people staying in alternative accommodations. That grew to 30% by the end of the decade. So this is not a new thing. It's an accelerant to the trend during the past, pandemic period of time. But it's not a new thing. It's actually just, it's a nicer way to travel.
Okay, so I'm a wealthier person. I'm watching Kramer. I got this guy, Matt. I'm thinking, you know what? I'm going to go start that business tomorrow. What edge do you have?
It's really hard to do what we do. It's a very logistics-heavy business. The most important thing, though, is it's technology-enabled. Like, the entire foundation of the business is technology-based. The only way we're able to do and scale and run the business so efficiently and effectively is because we have a bunch of proprietary technology. That's everything from a homeowner app to a guest app to a field service app. So they check all the things are done before they leave after each clean. We have revenue management tools with AI and a lot of algorithms that actually maximize the revenue that homeowners get. That stuff takes time and expertise to build, and that's what we've done, and we built it to scale.
All right, well, I'm going to tell people, I usually don't do this. This guy made everybody a lot of money, okay? Matt Roberts made a lot of money for people. I think he's going to do it again with Vacasa, all right? I don't do that typically. I'm saying it now. Matt, great to see you again.
Thanks, Jim.
Guys, small dollar stock. I immediately called my wife. I said, should we be looking at property? Because we got this guy on our side, just like we did when we opened our restaurants. Mad Money's back after the break.
Coming up, sharpen your sweet tooth. Kramer goes off the charts with a wham-bang breakdown of Bang and more. Next.
All week we've been doing some crazy stuff here, right? Well, look, this was a fabulous counter-trend rally after months of hideous action. And that's especially true for all the beaten down tech stocks that have been able to bounce back. Kind of glorious. But regular viewers know that I still feel some trepidation about this market. While there were a ton of stocks that came down too far too fast, the overall backdrop of this rally is still suboptimal. You know why? There are still far fewer winners than I'd like to see, and they tend to be clustered in a couple of industries that we've learned to be more treacherous than we thought. So that's why all week we've been consulting technicians. Yes, people who look at charts to get a better read on the situation, because their methods help take our emotions out of the equation. Now, in the last week, Wall Street's going from despair to euphoria. And you don't want either of those feelings to guide your decision-making, because that's how you make mistakes. So let's go to someone who has been around so long. I love the guy. I'm talking about checking in with Larry Williams. He's a legendary technician and market historian who's been trading stocks, futures, and commodities since I still had a safety blanket and diapers that you didn't dispose. Larry's written more than a dozen books. He's created a ton of his own proprietary indicators. Everybody uses them. And most importantly, he's got a magnificent multi-decade track record that's only gotten better since COVID threw the markets in disarray. I don't know if you remember, he actually called the exact bottom in the COVID sell-off. So rather than focus on the averages again, I said, hey, Larry, what are you looking at? And he said, well, let's drill down into some specific names from both the market's old guard and its new leadership, with the last one being one that I think everybody who's watching is going to get comfortable with. We're going to start with the old guard, which is FAANG. You remember that acronym I came up with? Facebook, now Meta Platforms, Amazon, Alphabet, Netflix, and Google. Now, I mean Amazon, Apple, all right? Now, look, listen to me. While these are formerly hot names, they've struggled since the Fed started getting serious inflation back in November. Some have held up better than others. But just like I have a lot of those, a lot of the tech stocks that are profitless, these guys also peaked too. They all peaked. They've all been hurting. Williams points out that nearly all of the FAANG names have consistently made lower lows. And that's a telltale sign of weakness. I have to own this, because you know that most of the Charitable Trust owns these stocks, and they've not been good actors. I mean, Facebook's been the weakest. Apple made a lower low earlier this month. Amazon did the same thing. Netflix is so ugly that it's challenging Facebook as the weakest in the cohort. This isn't the way it used to be. But now take a look at the daily chart of my favorite. Take a look at the daily chart of Alphabet, which we actually bought more of for the Charitable Trust when it dipped. One of the few that we did. This is the artist formerly known as Google. Unlike the other FAANG plays, Alphabet's got a stable floor of support. It hasn't made a lower low. Look at this. It hasn't made it. This tells Williams that the stock's been in strong hands. It's under accumulation, meaning the big institutional money managers never truly stopped buying. Whereas the rest of FAANG experienced moments of mass capitulation where tons of shareholders threw in the towel and became sellers, Alphabet's shareholder base didn't go anywhere. According to Williams, when a stock holds up like this while the broader market's getting hammered, it's one of the strongest patterns he knows. This alone should make you own some Alphabet. But we're not done. Take a look at the blue line at the bottom of the chart, okay? This is the on-balance volume indicator, all right? It's a cumulative indicator that measures volume flow, adding the volume on up days, then subtracting the volume on down days. For chartists, this volume is like a lie detector. With Google, you see what's known as a positive divergence here. While the stock tested its January low in late February, okay, and March, the on-balance volume line held substantially above those levels. This is such a bullish pattern that it shakes me to see how great this one is. Next up, take a look at the action in Google plotted next to one of Williams' proprietary indicators that measures professional accumulation. Here you can see Google made a couple of peaks going back to November, all right, when the stock went higher while the professional accumulation line went lower. That told you big institutions were selling. Right there, buying of just, we don't know who's buying it, but we know the pros, because of the Williams index, the pros were selling. All right, now keep that in mind. Now Williams points out that we have the reverse. The stock's moving sideways while the professional accumulation line is headed higher. Again, this is so bullish. Now, I'm going to blow your minds with this one. Williams also likes to look at seasonal patterns. Actually, that's one of his favorite things to do. How stocks typically do at a given point in the year. Now, check this out. With Google, there's a strong seasonal pattern where the stock tends to rally from April through July. Late March tends to mark the stock's seasonal bottom. Well, guess what next week is? Late March. According to Williams, in the last 14 years, if you booked Google on the first day of April and sold it 20 days later, you would have made money, take a guess, 92% of the time. 92%. Don't you want in on that? There's one other FANG name that's held up better than the average, although not quite as good as Google, but, I like this one, too. It's called Amazon. All right, the stock's now bouncing hard off its lows, and Williams is betting that it's got more room to run. First, check out the daily chart of Amazon plotted against the seasonal pattern. Here we go again. Just like with Google, this is exactly the time of the year when Williams would expect to bottom based on the calendar. In the last 12 years, if you bought Amazon on the first day of April and held it for 35 days, Williams says that you would have made money 11 out of 12 times. Even the one time it didn't work, you only had a small loss. I love these kinds of things. I love these correlations. I think he's making a compelling case. But, of course, Google and Amazon are no longer the leaders of this market. Other than this week, even mega-cap tech has struggled. So you need to be a bit of a contrarian to bet on these right here. Not everybody wants to stick their neck out like that. But there's one defensive stock, and this is incredible because it was the same one that worked in the year 2000 when we had the dot-com bomb. One defensive stock Larry likes that may be more fitting for this current moment. It's a company that's so well run with a great CEO. And that company is Coca-Cola. Can you imagine? Good dividend, good buyback. How about good chart? Take a look at the daily chart coupled with the on-balance volume. Okay, Williams points out that a ton of volume has come in here on the long side, even as Coke has pulled back from its highs over the last couple of weeks. Now, this is an extremely positive sign. It tells you that big institutional money managers are buying it aggressively. Made me want to buy it. When I heard about that, I said, geez, I got to put this in the bullpen for the Travel Trust, for the investing club, because it just makes so much sense to me. Coke is exactly the kind of stock that hedge funds love to own at this point in the business cycle, which is a key reason why it's been able to outperform the major averages. Williams is betting that outperformance will continue. Next, take a look at the action in Coca-Cola versus seasonal pattern in red. Just like Google and Amazon, Williams points out that this is precisely the time of year when Coke is likely to bottom. The stock tends to rally nicely from April through June. Now, Williams also looks to search for all sorts of correlations in order to find reliable trades, and he's found one with Coke. I want you to take a look at this chart. This shows you Coca-Cola in black. This one blew my mind. And sugar prices. Sugar prices push forward about 1 year in blue. Almost all of this company's products are based on sugar, and what Williams sees here is that there's a powerful relationship between Coke's share price and the price of sugar. In fact, it's almost uncanny how closely Coke's stock follows the action in sugar from a year ago, okay? You might expect the stock to go down after sugar goes up because it's a major input cost for them. When you push the data forward 1 year, Williams finds that Coke's stock follows sugar. If the pattern holds, it means that Coke can continue to rally. The bottom line, oh man, is this a confusing moment for everybody, right? But like I tell you every night, there's always a bull market somewhere. Right now, the charts, as interpreted by Larry Williams, suggest we've got incredibly bullish action in Google, very good bullish action in Amazon, and money in the bank action in what we call knockout Coca-Cola. I would not bet against Larry Williams. Let's go to Mark in Florida. Mark.
Hi, Jim. I enjoyed the talk by you and Jeff this morning.
Oh, thank you. Our 10:20 morning meeting. I am telling you, everyone should be in the club. It's the most candid, and we talk about personal stuff in order to make you money, which I love. Let's go to work together. Mark.
Okay, my question's about Unity Software. I bought it at 130 and sold it at 176 as it declined. It's bounced back a bit the last few days. Independent analysts rate it poorly, but I value your judgment more than theirs. Do you think it's worth repurchasing at this point?
Unity is a company with John Riccatello that's come all the way down, was up 4.7% today, to the point where I think that it can make 20 points for you. I don't think it's going to go all the way back to 210, but Mark, I do think it can rally. But remember, it doesn't earn money, and I'm focused on companies that earn money. Companies like Coca-Cola, companies like Amazon, companies like Google. I have to tell you, If you don't buy the Coke or the Google, if you're a trader, I think you're making a big mistake. You're betting against Larry Williams, the best that's ever been. All right, I say it every night. There's always a bull market somewhere, and the chart suggests that what we're seeing in Google, Amazon, and Coca-Cola is real. Much more made money in. Could there be some winners among the IPO class of 2021? I found one. No, I'm sharing an important screener that I'm using for the group. We got a couple. Then last week we were wondering when the great bear market would come to an end. But after a week of green, now we have to wonder whether the great bull market is going to come to an end. I'll give you my cake. And all your calls rapid fire in tonight's really fired up edition of the Lightning Round. So stay with Kramer. You know me, I spent a lot of time trash talking the 600-odd companies that came public last year. More than 400 traditional IPOs, over 200 SPAC mergers. I think a great many of these stocks are absolute garbage. But I don't want to paint with too broad a brush, especially because this whole edifice has collapsed over the past few months. It's a little late to get out of them. With more than 600 newly public names, some of them are worth picking at now that they've come down so dramatically from their highs, right? I mean, that's my feeling. If you know what you're looking for and you're bold enough to take a chance in them, you actually might be able to spot some real good opportunities, but it's very difficult. We've tried being opportunistic with this group before. It worked out pretty well, frankly. The key is to be rigorous. In late January, we ran a screen of newly public stocks. We were looking for companies on track to earn money this year with reasonable price to earnings multiples. I highlighted 12 of them. Fast forward nearly 2 months, and 9 of these 12 stocks are actually up, despite this being an incredibly difficult period for the market in general, and newly minted stocks in particular. In fact, the group's up roughly 10% on average. So this worked. This screen worked for us. So let's go back to the well, right? We're going to go back to the IPO and SPAC well with a more refined approach this time, though. Last time we picked among the rubble, we were looking at earnings. This time we're looking at cash flow. Why cash flow, you ask? Because we're taking our cue from Bill Smith, the co-founder and CEO of Renaissance Capital, perhaps the best IPO expert out there right now. Every Sunday, Smith puts out a free newsletter that we read religiously. By the way, you should sign up for this. This year, they've become pretty dour. But a couple weeks ago, Smith included a throwaway line that really caught my attention. After a ton of gloom and doom about the hideous performance of recent IPOs, he pointed out this quote: 2021 IPOs with positive free cash flow have higher returns than the rest. That's why we're looking at free cash flow. Since November's Investing Club meeting, I've told you the new Mad Money party line. At this point in the business cycle, you want to own companies that make stuff and do things, turning a profit in the process, ideally enough for profit they can turn some of that profit to you via dividends and buybacks. That's a big ask for a company that just came public. They're usually in growth mode, so it makes more sense for them to invest in the business than waste money on dividend payments. Free cash flow isn't an easier lift, and it still gives you a clear idea of what a company's really doing, whether it's making money or not. So let's go to work. On the traditional IPOs from the class of 2021 and 2022, along with the 151 stocks in the CNBC Post-SPAC Index, only 380 of them are still large enough for me to talk to about on television. From those 380 new listings, excluding the 42 where we couldn't find enough data, there were 125 names that had positive free cash flow in 2021. Discouraging, but not surprising. A lot of junk came public last year. Next, we considered valuation. So we cut anything that's trading at more than 40 times its free cash flow. Then we also threw away some Chinese and Russian and Cypriot stocks that are geographically tough to own right now. That left us with 60 names. There were some surprises. For instance, I didn't expect to see Wheels Up in there. That private jet rental club at a post-SPAC stock, been a horrific performer. Yet they had positive free cash flow last year. Even with the stock at $3 and change, though, I'm not tempted. I'm not tempted because they're set to keep losing money until 2025. Not good enough for me. We also found some overlap with our January screen based on positive earnings. Playtika, Open Lending, Traeger, Solo Brands, all of these continue to have my endorsement, but tonight we want some fresh ideas. After poring over the 60 newly public stocks that passed the test, there are 5 that I think are okay. First is Hayward Holdings. This is a maker of pool equipment and related automation systems. I've been watching since it came public a little over a year ago. I love the pool business. It's one reason I've been recommending Pool Corp for ages. Hayward Holdings occupies a similar position, but is a very consolidating industry. Now, when Hayward reported its most recent results, they took a bit of an earnings hit because of rising costs and supply chain disruptions. But the stock barely skipped a beat. While their guidance was allegedly disappointing, they're still forecasting 9 to 12% EBITDA growth this year, which many of these companies would kill for. Plus, the stock trades at less than 14 times this year's earnings, making it much cheaper than Pool Corp. That one works for me. Second is a little controversial. It's called MarketWise. I watched the numbers this week. Post-SPAC name. It's sunk like a stone since it completed its merger last summer. I know these guys from my old business at TheStreet.com. MarketWise is a subscription-based investment research tool. I think it's gotten too cheap here with a stock of $4 and change. At these levels, it's trading at 9 times next year's earnings, and I see it as a pure value play. The most recent quarter caused one final lurch down because they refused to offer full-year guidance. They had a long thing about it on the call. It was kind of cumbersome. They gave a somewhat grim commentary on the current quarter. But I think that's washed out all the weak hands and created a good entry point. I read some of those newsletters. Look, it's dicey because it's about the stock market. If the stock market keeps going down, no one's going to buy the stock of MarketWise. Well, few will. Third, Orion Specialty Group Holdings. Now, these guys provide specialty products and services to the insurance industry. Ryan Specialty is one of the few 2021 IPOs that's defied the gravitational pull of the broader group. Came public at $23.50, and even after getting slammed post-earnings this week, it's at $36 and change. I think the sell-off was excessive, given that the numbers were fine, the guidance was better than the analysts were expecting. I like the stock here. Generally speaking, leaders in boring industries can give you some tremendous long-term gains. Fourth is a company called Sovos Brands. Now, here's a packaged food company you might recognize as Rayo's pasta sauce. I like going to Rayo's. This one doesn't require you to stick your neck out. Sovos just had the misfortune of coming public too late in the IPO cycle last September, so it got abandoned like everything else. But this company just reported a magnificent quarter, and the stock's been rallying nicely this week. Even after this move, though, it's trading at just 20 times this year's earnings estimates, and the stock is off a few bucks from its IPO price. Finally, there's Vivid Seats. Now, this is a Ticketmaster competitor that came public via a SPAC deal late last year. I think Vivid can make for a terrific reopening play, even though it's the most expensive new issue on our list. Trading at 50 times next year's earnings estimates may not be your cup of tea. However, when you look at its free cash flow basis, it's only selling for 10 times last year's numbers, which is a lot more reasonable. Stock's had a nice move during a difficult time for the market. I think it's got more room to run. Vivid Seats. Bottom line, if you're willing to be disciplined in your approach, you've got my permission to sift among the rubble of last year's IPOs and SPAC mergers. That's why I like Hayward Holdings, MarketWise, Ryan Specialty Group Holdings, Sovos Brands, and Vivid Seats. Mad Money is back after the break.
Coming up next.
Let's make money together. What do we got?
Kramer's bringing the thunder and answering your burning questions in today's edition of The Lightning Round.
It is time. It's time for the lightning round. And then the lightning round is over. Are you ready? Ski guy, tell me the lightning round comes over. Jordan in California. Jordan.
Hey Jim, thanks for taking my call.
No problemo.
I was looking at this company that specializes in niche health products and services that targets Gen Z millennial consumers. Management team is strong. Subscriptions grew by 95% in 21, and customer retention rate was a healthy 80%. Sitting at a price to sales ratio of a little over 3, I think it's being grossly undervalued, partially due to inflation destroying impossible high growth. I was wondering, Jim, what are your thoughts on Hims and Hers?
Him and Hers lose money. And even though it seems low on a dollar basis, I'm not recommending stocks that are losing a lot of money. They just don't work for me. Let's go to Michael in Florida. Michael.
Hey, Jim, big booyah to you from Florida. The stock I get a question about is a stock that came down huge after a special dividend payout a while back. It has a dividend of 12.94%, and it's only at $5.40. What is your opinion on Two Harbors?
When I see something like that, that's what I call a definitive red flag. I'm not going there. We've seen a lot of companies like that over time. They usually have like residential mortgages that nobody knows about. I'm not playing. Let's go to David in Ohio. David.
Big booyah from Cleveland. Got to get you out to it.
All right, partner. What's going on?
I'm calling about Shell Midstream, SHLX. Bought it for the dividend. It's since been reduced from $1.84 to $1.20. Stock took a hit, but there's a buyout offer from an affiliate, Shell Pipeline Company.
I don't think we need to do this. I think that this is, I want you to do enterprise product partners. I want to give you some upside. EPD, that's the best one if you want to be in that group now. And it's got a 7.7% yield, and it's really well run. How about Steven in Georgia? Steven.
Hey, Jim. Thanks so much for taking my call.
No problem.
I'm a senior at the University of Georgia, and I've been a fan of Mad Money for a few years now.
Thank you.
I wanted to hear your thoughts on the recently announced strategic combination between Healthcare Realty Trust, ticker HR, and Healthcare Trust of America, ticker HTA. The stock is down around 13% year to date. Are you a buyer?
I don't know. I thought that made a lot of sense. By the way, I like Ventas, too. I'm trying to figure out how many guys from Georgia Defense are going to come public. I think that you've got to go, and I like it, and I like your attitude toward the stock market. I need to go to Philip in Georgia, please. Philip.
Booyah.
Booyah.
First-time caller, long-time listener.
Excellent.
Hey, look, I invested about 18% of my portfolio in DraftKings.
That's too high. I mean, I even like, I like Jason Robbins. I work for DraftKings. I think that Jim Chanos says it's a great short. I think the time they're shorted, the stock was much, much higher. They're going to be a winner, but I think you got to cut that to 10%. That's too much. You have too much in that one stock. Let's go to Jorge in California. Jorge.
Thank you for taking the call.
Of course.
I'm interested in what you have to say about GILD.
No, I know it looks very, very cheap. But you know what? That's not why we buy drug stocks. We buy drug stocks because they've got growth, and Gilead has none. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by TD Ameritrade. Coming up, has the Bears' roar become a bore? How did the Bulls trample doubters in a week locked with uncertainty? Find out next.
1 week ago, we thought the great bear market of 2022 would never end, for good reason. We knew the stalemate in Ukraine couldn't end well, right? We knew we were on the cusp of a big, bad Fed meeting, with prospect that Fed Chief Jay Powell going hard, throwing us into recession. He had inflation everywhere, every commodity, especially oil. And we expected a collapse in the Chinese stock market that made it seem like their whole country was falling apart. A week later, and it's a different world. As crazy as it seems, the drag in the war is now cutting against the Russians. The outpouring of international support for Ukraine now has Putin surrounded, just like he's got the people of Kiev surrounded. The difference being that short of nuclear weapons, the Russian military seems like a Potemkin army. Rather than worrying about Zelensky's survival, the question is if Putin can stay in power, and will the West even consent to it? Because the West is going to have a very big role in his future. And you must remember, every tyrant ends. Every tyrant ends. China, President Xi caused a bottom in stocks with an aggressive buying push. He caught the shorts leaning the wrong way, and he crushed him. Big week for him. The Fed. Just like I expected, the event was well telegraphed, and Chairman Powell handled things with aplomb, admitting the Fed has a lot of wood to chop and suggesting that he has to stay aggressive unless inflation slows down. That's exactly what we needed to hear, right? Then, as if by magic, the high-growth stocks that have reasonable prospects, even if they're losing money, saw their stocks soar, because anything that can tamp down on inflation makes their future earnings more valuable. Of course, then again, I do want you to take profits from the ones that are losing big money. How about oil? It was up on a spike, like so many other commodities, and slinked down quickly to a still high but more reasonable level. At least it didn't spike to 120 like the bears told us it would. So how can we go from bear to bull in 1 week? I think the answer is pretty simple. What we previously viewed as an unthinkably positive scenario turned out to be the more rigorous view than the bearish view. The slowdown in Russia's invasion had more to do with a false estimation of their military capacity and an underestimating of Ukraine's abilities, including that of its leader. At the same time, we've seen oil spike, but we also know that the oil futures are often irrational. It's not a good market. So we could have negative pricing, remember that? Once real sellers came in, the actual producers, not just futures traders, the price dropped. As for Powell, I have no idea how to get it across to people. He's a different kind of Fed chairman. He's thoughtful, he's prescient, he's well-grounded, and he's smarter than the 20-odd people in that Hollywood Squares thing he's got going when he does that press conference. Put it all together and you have a remarkable turn one that was accelerated by the tremendous amount of negativity it simply added fuel to the fire. What's the real lesson of this week's incredibly bullish action? I think it's that the bears are incredibly effective getting their message out, while the bulls want to stay silent because they don't want to look like idiots on YouTube if they turn out to be wrong. Nobody ever mocks the bears. They're always taken seriously. So they don't care about looking like idiots. But a blown positive call can kill your career in this business. A blown negative call, it does nothing. So I need you to think about who you listen to and remember that some person's agenda might be very different from yours. Maybe they want to be able to raise money for their hedge funds, which means they need to temper their bullishness in public. You want to make money. It's not the same. Never has been. I like to say there's always a bull market somewhere, and I promise to try to find it just for you, right here on Mad Money. I'm Jim Cramer. See you Monday. The News with Shepard Smith starts now.
President Biden warns President Xi, do not help Vladimir Putin. I'm Shepard Smith. This is the news on CNBC. President Biden's high-stakes call with China's President Xi.
The implications and consequences if China provides material support to Russia.
What we're learning about the nearly 2-hour talk. Russia attacking Western Ukraine. The new strike as a defiant Vladimir Putin delivers a message at a fiery rally.
The anxiety level of everybody in the hospital is on high alert.
An American doctor saving babies in Ukraine. His story in his own words.